YouTube videos, pick what confluences you like. For example, the 4 steps I just gave you, and then make it your own. That means going to the chart, backtest, and journal, build data that what you are doing with your entry model actually gives you the results you want. And it also helps with your confidence. Just like you have a lot of confidence that you can drive a car because you have thousands of data points, proof that you can drive a car. Same with your trading. If you have hundreds of examples, hundreds of data points that your model works by journaling, by backtesting, you have a lot of proof that what you're doing works. And because you have proof, you become more confident. And it helps with, for example, not taking your trade off like we saw in the previous trade example. And if you want to steal my entry models, there's a playlist on this channel with my entry models, all of them. And you're going to see that core 4 I just explained, you will see them back in all my entry models, but then with different nuances. So go to that entry model after this video. I'll leave the link inside the description, and then watch them all and find your favorite entry model and start building data on this to make it your own, get the confidence and get better results. The second mistake I see traders make is waiting for all the stars to align, for all their confluences to align. Because some entry models not only have a liquidity sweep, a market structure shift, a fair value gap, and a kill zone, but they also have inversion fair value gaps, reapers, market maker models, N-box, N-dogs, CRT, some support resistance, some EMAs. And some entry models just have a checklist of 15 different confluences. And if you need to wait for all those 15 stars to align, you're going to have a very low volume of trades because there's not many occasions where all those 15 confluences come together. So the first step you need to do is reduce the amount of confluences you need to take a trade. The most healthy entry models I've seen have between 4 and 7 confluences. I just gave you 4. That means you can add 3 of your favorites to it. And don't wait for all 7 all the time. Most decent setups from those 7 confluences have like 4 or 5 or 6 of them. Of course, if it's only one confluence, you're gonna take a B setup, don't take it. You don't always need to wait for all those 7 stars to align. 5 or 6 is already enough. And the third mistake is changing your entry model every time you are in a losing streak. And that is called strategy hopping. You think your model doesn't work anymore, so you buy a new course, watch a new model, and you keep being stuck in that cycle. But the thing is, let's say my entry models I give you have a 50% win rate. If you shoot a 1 to 2, that's pretty decent. You can make a lot of money with that. But if it has a 50% win rate, that means over the next 100 trades, you're still gonna lose 50. And even while you lose 50, you're still making money because your winning 50 trades are gonna outperform your 50 losing trades. And those 50 losing trades can come in sequences called losing streaks. So that means you can have a 10 losing streaks by doing everything right and still make money in the long run. But if you're in between that 10 losing streak, gonna buy a new course or just change your model altogether because you think it stopped working, you will never become profitable because there's no consistency in your trading. The one thing that needs to be consistent is the model you execute. So the moment you start hopping, you actually self-sabotaging your own trading. So maybe think twice for getting another entry model inside your trading. Maybe go back to your last 10 or 20 winning trades and see what's already working for you and do more of what's working. And the fourth mistake is not trading with the higher time frame trend. In this example, we have a very bullish market. We are trending upwards. But what if inside this piece of price action on the higher time frame, we think, oh yes, we're now going in a reversal. So on the lower time frame, we drop, for example, from the 1 hour time frame here to the 1 minute time frame here, and we catch the first bearish fair value gap, get our hands on. When we do that, and obviously we will get stopped out because the market was super bullish. Trending higher, shorting a bullish market is not very nice. Same with longing a bearish market. It is lower probability. So your entry model does still work, but the trend is still your friend. So just take your model with the trend to make your own life very easy. And I'm really ashamed to share you this, but this is also a trade I took this week, making this mistake. So we are hyper bullish on NASDAQ. We are at all-time highs. We just went up for a few thousand points. And here we are at the New York Open. So I was trying to be fancy because I was like, going to the 4 hour time frame, I think we can rebalance at least to this 4 hour bullish fair value gap. So that was my target for a potential ping pong. First lower, then higher. That was my idea. So then during the New York Open at 9:30, I was aiming to trade back towards these lows, towards that 4 hour bullish fair value gap. So I was just waiting for the model. And you know the model by now. It's a liquidity sweep. And there was no liquidity sweep here, but there was an SMT. I'm not gonna go deeper in what SMT is, but that means if two correlated assets do not follow each other, so ES, the correlated asset, made a higher high. This made a lower high. And I was like, hey, I see SMT, I see a fair value gap. What is the last swing low that made the high? Well, the SMT that was this low. So we have a liquidity sweep for SMT. We have a market structure shift and PD raise. So when I saw this reaction, I took a trade right here. TP at that 4-hour fair value gap, stop loss is high for a 1, 2, 2. And let's see what price did. It went up and up and up without any retracement. And if you want to make it even worse, look at what happened after. Like, this was my target. Look at what happened in hours after. I just shorted low of the week. So please don't make this mistake too. Don't short trending markets. So now you know my 4-step entry model and you know the biggest entry model mistakes. Now it's time to look at the entry model secrets. And the first secret is going to be time frame alignment. Your entry time frame, it doesn't matter if that's the 1 minute, the 5 minutes, the 15 minutes, the 1 hour. It needs to be always 1 or 2 levels below your key level time frame. Let me show you. The first thing you need to know in time frame alignment is that price is fractal. What happens on the higher time frame happens the same on the lower time frame. So if we look at this example where we have a bullish fair value gap and we have a target that is this high, we are trading from internal range liquidity, a fair value gap, to external range liquidity. So what we expect on the lower time frame is a market maker model, where we first trade lower into that fair value gap and then trade higher towards that high. I have a dedicated video on market maker models here on this channel. I will leave the link to that in the description. But for now, what you need to know is that a market maker model has a sell side of the curve where we go lower, and have a buy side of the curve where we go higher. And inside a key level, you find a market structure shift. Just like you saw in my entry model, key level, liquidity sweep, market structure shifts, and then we start trading the other direction, a reversal. And once we reverse, you can see it right here, with a market structure shift, we start creating those blue boxes right here and right here. Inside these boxes, you can find actual entries in the time frames below the structure. So what I mean by that, if this is the higher time frame structure, let's say the daily or the weekly or the 4-hour, inside those blue boxes, you can find mini market maker models on lower time frames. And there's where time frame alignment comes in. So we have market maker models inside market maker models, market maker modelception. And how we can use the time frames in that, if you're a swing trader, you can use a monthly internal fair value gap to external to the old high. You can use a daily structure, or you can have a weekly internal to external and use a 4-hour structure, or a daily internal to external and a 1-hour structure. If you're a day trader, for example, trading futures, what I like to use is a 4-hour internal to external. So I'm looking for that 4-hour move to happen. I use a 15-minute market maker model. And inside that 15-minute market maker model, I'm using a 1-minute mini market maker model. That's where the 10 AM game comes in. That is where the FTS model comes in. And basically all my entry models you see on this channel. And if this went too fast for you, let me explain it one more time without all the colors. This is the key level. We trade from internal range liquidity to external range liquidity, all high. This is the lower time frame structure with the liquidity sweep, with the market structure shift, with the fair value gap or the order block, and then we trade higher. Inside that lower time frame structure, in these moves, there are fair value gaps created. Where do the fair value gaps trade to? Towards old highs. That's the same move, but then the mini version. So in this move, you can have on the lower time frame the same structure. So for example, if this is a daily fair value gap, and this is a daily high, so a daily internal to external. With the time frame alignment, what I showed you right here, in a daily internal to external, we need a 1-hour structure. So this structure is the 1-hour time frame. And then we go back to the time frame alignment. In a 1-hour structure, you can have a 5-minute mini market maker model. So we go from the daily to the 1-hour structure, and inside that 1-hour structure, we find 5-minute mini market maker models. But the structure is always the same. It has those 4 components: a liquidity sweep, a market structure shift, some PD arrays inside a kill zone. And another tip here is the more time frames that align with your trade idea, the higher the probability. That means if not only the 1 minute, the 5 minute, and the 15-minute structure is bullish and you want to take longs, what if the 1-hour, the 4-hour, daily, weekly, monthly, everything is bullish? If all the time frames are bullish, your long idea is going to play out very sexy. But vice versa is also true. If the monthly, weekly, 4-hour, daily, all the time frames are bullish, and your 1 and 5 minute entry on the lower time frame are bearish, you're gonna see that those setups do not play out as you want because the time frames above that are super bullish, or the other direction is counter trend. The second secret you need to know for entry models is using the second PD array rule. And you've seen this too in the Fair Value Gap Secrets video, but here's how it works. Here we have the exact structure again, with the liquidity sweep, the market structure shift, the PD arrays inside the kill zone. Before I can tell you what the second PD array rule is, I need to explain you what the first PD array rule is. The first PD array area is this area where we had that market structure shift, the liquidity sweep, and then we have that first batch of PD arrays. It can be fair value gaps, order blocks, breakers, inversion fair value gaps, whatever you prefer. I like to use that first area as my test area to see, do we actually move away from this in the direction I want? Or we don't do that and start just trading lower. I don't like to get faked out in my moves. So what I then do is wait for the second PD array area to occur. And that means that there is a reaction from this level. And that looks exactly like this. We have a reaction from that first PD array area, and now there are new extra PD arrays created. Because with this move away from that first PD array area, there is a new order block created, there's a new fair value gap created, and that is the second PD array area. And then we can use this first PD array area as our defense. There's an extra structure created for our trade idea. And for actual executions, that looks like this. So if you want to use the second PD array rule, your entry is going to be in that second fair value gap or that second order block. And if you want to 1 to 3, you can put your stop loss below the first PD array areas low. If you want to 1 to 2, you can be even more safe. You can put your stop loss closer to the low of the structure. Both is good regardless of what risk to reward you are shooting for. And the third secret is don't just trade individual PD arrays. Use them together. So not only trade fair value gaps blindly or order blocks blindly. Use them together with the liquidity sweeps, with the order blocks, with the market structure shift, with the market maker models. We talked before about that there's multiple stars that need to align. That is this. Don't wait for too many stars to align, for all the stars to align all the time because your volume will be too low. But never trade just one PD array. Trade them together. And the fourth secret is use your entry model on one then more asset class. So if you now, for example, only trade NASDAQ, there can be a problem. Let me show you. If we go back to the NASDAQ example we showed that I was shorting the very bullish move. If we go to the daily here, look at what happened here. There's just one big energetic move upwards without any retracements. So the entry model I showed you before with a liquidity sweep, a market structure shift, and then go higher. If you have a hyper trending market like NASDAQ here, this model will not come for one simple reason. There is no liquidity sweep. We just go higher and higher and higher. There is no sweep. And because it's one of the core 4 of my entry model, it needs to be there. I did not take a lot of trades in this move. And that's a problem because I want to make money. I want to expose myself to the market. I want to take trades to start making money. But if my model is not there, I'm not going to force my setups like you saw me doing on that short trade earlier. You need to sit on your hands. But because we need to expose ourselves to the market, to risk money, to make money, the secret I'm showing you here is use more than one asset class. So what I like to do when NASDAQ is like this, I like to go to, for example, to ES or YM, the other conference. Well, ES did exactly the same. So also ES, it was not nice. But YM at the same time had cleaner, higher time frame fair value gaps where we could trade from and order blocks. And we know that if there's a higher time frame fair value gap, like for example here on the lower time frame, we can find our structures because price is fractal. So YM here was more sexy to trade. Same for if you trade futures, gold. In that move, where NASDAQ was trending, we had some nice fair value gaps here on the 4-hour time frame. We also had some nice fair value gap. It's a nice bearish fair value gaps here to take shorts towards the low. So even this looks like consolidation, lower time frame in these moves, I made some nice money because in these moves, I was on the lower time frame trading the model. Liquidity sweep, market structure shift, PD arrays in a kill zone. And now you know my entry model, the biggest mistakes trading entry models, and the secrets to execute your entry model like a professional trader. This is everything you need to start going to the charts and executing your model. But if you want more of this, make sure you check out the video that's now appearing on the screen because it's going to be the start of my entry model playlist. You can just steal my entry model so you can use the secrets I share with you right now to or steal my entry model or make your own entry model even better. So make sure to check it out right now. Don't forget to subscribe and hit the notification bell and leave a like if you learned something from this video. Thank you for watching, and I'll see you in the next one. This is time, this is price. And it's the only two concepts you need to become a professional trader. And this video, I'm going to show you how to use time, when to trade, and price, how it delivers to the target, to skyrocket your win rate, and basically just take better trades. And with better trades, you can make more money, more funding. So no time to waste, let's go. If you only look at technicals and only buy courses trying to find a new entry model, you're making a huge mistake because you need to combine price with time. You can have the best entry model in the world, but if you're executing it on the wrong time, you will have a big problem and you will not get the results you want. And when talking about time and price, we need to talk about the when, the time, when do you trade, and the price. How do you trade? How does price go to the certain target? And if you dive deeper into the when, into time, there are two things you need to master. And it is how to trade news and how to trade the kill zones. And news is very simple. It is the red folders. And for the red folders, use forexfactory.com. You'll see a screenshot here. If you go to forexfactory.com, you will see this exact page. And this is not enough. Like, you need to filter a little bit. But this is only today. If you press here and you do them this week, you will see a lot of red folders. This is too much. We need to filter right here. Go to filter, and you can turn off the CNE, the Chinese yuan, and you can turn off the yellow and the orange one. The gray one is always with bank holidays or daylight savings. Keep that on. It's the week of February 22 until February 28th. And here you see the red folder. It's a low news week. If you go to the next week, you will see that there's NFP. And every day before you trade, you need to know, is there a red folder coming? So for example, right now there is an 8:30 red folder coming up. So that means I'm not going to press the button until 8:30. I'm going to wait for 8:30 to most likely sweep some liquidity into a key level. After that, I'm going to execute my trades. Very important here, you don't need to know what the exact red folders do. It is good to have a higher time frame perspective of what the economic situation is. So for example, if the economy is really bad, of course the NASDAQ will sell off. When it's really strong, of course the NASDAQ or the markets will go higher, but you don't need to know the exact details. You can, but I can promise you, I don't know all the red folders and I make money, so you don't need it to. And if you know how Forex Factory works, how you can filter to the red folders and to the certain assets you're trading, you need to ask yourself the following question. Do I trade before, during, or after the red folders? Because if you trade before the high impact news, you should know that it's very low probability. Price will accumulate or manipulate. You will see that before big news events, you will see price just ranging. And then when the news drops, for example, this screenshot about CPI, then the liquidity will be taken out and then we trade lower. This also can be recognized as the accumulation, manipulation, distribution. And you don't want to be in a trade before the manipulation happens. And that's why it's important to not trade before a red folder. And what if you trade during the news, when it actually comes out? Please be aware that that is just straight gambling. You don't know what the news will bring, if it goes up or down, how big the candle will be. So trading during the news, avoid it at all costs. There's a reason why prop firms ban news trading, and it has to do with the high volatility and high unpredictability of the candles that are printing during the news. And your risk profile will not be followed because the risk to reward you're going to take, the size of your stop loss is going to be so big when you need to account for the move of a red folder. And if you want to trade during the news, you most likely will see that you will get wigged out during the news and then we make the real move. But what if you wait? You don't trade before the red folder, you don't trade during the red folder, but what if you wait until after the red folder, when accumulation and manipulation probably already happened? What then? That is the best thing you can do. The market already showed its hand and it becomes obvious where it wants to go. In this case, there was a news event. At the news event before that, we accumulate, ranging. It's a news event. We manipulate, taking out liquidity. And then with the news after news, this is where when the fair value gap and the market structure shift is created, there in this piece of price action is the market showing its hand that it wants to go higher. And this is also the A+ setup and the 10 AM game that you can find here on this channel under the playlist of entry models. But you must have seen Forex Factory by now, and some days there's not one red folder but multiple. And what if you have two red folders, one before the open and one after the open? The New York Open is 9:30 AM EST, New York time. Then what is the best approach? Because every month there are days with the, let's say the 8:30 red folder or the 8:15 AM and then the 9:45 or the 10 AM red folder. How can you trade that? And it's very simple. use this as your rule of thumb. If the pre-New York Open red folder will sweep liquidity, the 830 or the 815 red folder sweeps liquidity, then the post New York Open, so the 10 a.m. candle, 10 a.m. news candle will be the push to the target. That's very important here. But what if the 830 news event does this and there's no clear liquidity sweep? Then it's best to wait for the post New York Open red folder to do the liquidity sweep before getting into the move. So the thing you need to remember from this is you need to be waiting for the manipulation, for the liquidity sweep. And if it happens at the 830 red folder, you're probably going to take your trade at the next red folder. If it doesn't happen with the 830 red folder, just wait until price sweeps that liquidity before going to the target. It needs to manipulate before distribute. And right now, I want you to pause the video and make sure to put these two rules in your trade plan right now. These are the most important ones. One is no trading before the three big boys. And the three big boys are NFP, non-farm payroll, the first Friday of the month. It is CPI, that means inflation data, and FOMC. FOMC is the interest rates decision. NFP and CPI are always at 8:30 a.m. EST, and FOMC is always in the PM session at 2:30 p.m. EST. So that means in the sessions before NFP, CPI, and FOMC, you can expect low probability conditions. And low expectations mean you can still trade, but there's a strong possibility of weird or choppy delivery to your targets. So instead of price going very clean to a short target, for example, it'll probably just seek and destroy and do nothing. And then at the actual news event, then it will make the move. And the second rule is when there's no news days, also have low expectations, because we want the red folders to sweep that liquidity, to take out the liquidity, to manipulate before the real move. If there's no news, most days there's also not that big liquidity sweep, and we need to wait for the next day for when there is a red folder to then make that low or high that sweeps the liquidity. And I know how overwhelming trading can be. That's why I created the ICT Bible. It's a 500-page PDF where I go from A to Z to all the concepts you can learn about trading. I spent hundreds of hours on this document, and this document will save you thousands of hours of ICT videos and studying. It is all for free, and I will leave the link to this inside the description. If you want to skip those thousands of hours of studying, make sure you check it out right now. Back to the video. So when talking about time and price, you now know how to trade news, but we also need to talk about the kill zones. What time do you trade? And the kill zones are very simple. They're also referred to as sessions. If the Asian session, the London session, the New York session. And for the indices, what we trade the most, NASDAQ, ES, and YM, we also have the PM session, the afternoon session. And these times are all in New York time. It means EST, Eastern time. And there's a little nuance difference between Forex and the indices. The Asian session is the same. That's from 8 p.m. until midnight. London session is from 2 to 5. The New York AM session is different. Forex New York kill zone is from 7 till 10. Indices is 8:30 until 11. And the PM session is not per se a thing for Forex, but you will see the indices moving during the PM session from 1:30 to 4. And inside these sessions on the indices, you have silver bullet windows. There's where most entries are forming. And for the London session, it is between 3 and 4. For the New York AM, it is 10 and 11. And for PM, it is 2 to 3 p.m. And my best performing entry model, the A+ setup, is the 10 a.m. game. And now you also know why. It's because most entries are around 10 a.m. New York time, the window after the New York Open that starts at 9:30. And why do you need to remember these kill zones? Is if you go back to your losing trades, most likely your trades are taken at the wrong time. So your structure was there, like the price was pretty good. You see your setup, but the timing was way off. And to give you some nuggets here, you should pair the asset you are trading with a certain kill zone. So if we talk about Forex, if you want to trade the Asian session, you should trade pairs that move in the Asian session. Well, what is the Asian session? It's the JPY, the Japanese yen, it's the Australian dollar, and it's the New Zealand dollar. Those are in the Asian session. So those pairs, those assets, those currencies move. For London, well, which currencies are in London session? It is the euro and the GBP. And the New York session obviously is the dollar and the Canadian dollar. And that is why if you have, for example, euro dollar, you will see the euro dollar moves in London and New York AM, because euro is from London and the dollar is from the New York session, New York area. You will see euro dollar not moving in Asia. It will most likely consolidate, waiting for the London session, because there is where the big liquidity comes to the market. And same for the indices. If you trade the NASDAQ, the S&P, ES, or YM, the Dow Jones, those are the New York stock markets. So that means you will see that those indices move during the New York session, because there's where the US money comes into the market. If you want to trade, for example, indices during London session, you can look at the German stock market, the DAX, for example, or the UK 100 from England. So when you start matching the kill zone with a certain pair you're trading, your win rate will go up. And if you're confused about the kill zones, there's an indicator on TradingView you can use to mark out these exact kill zones. If you go to indicators and type in ICT kill zones and pivots, this one from Trade for Up, it will show the exact boxes of the kill zones. If you go to the settings of the indicator, you can even adjust this. You can pause the video and just copy these settings. I have the Asian session, the London session, New York AM. I also have the London close, but if I'm trading the indices, I don't use the London close. It's the yellow one right here. I use the New York AM and the PM session. And you also see in this exact example that for this NASDAQ trade, we just accumulate the whole day. This is Asia. This is London. And then in New York, we sweep the liquidity and start making the move to the upside. Especially if you're new to trading kill zones, make sure you put this indicator on your chart to make your life easier. So now you know when to trade. You know the time element. But now you need to talk about the price. So when we know when to trade, we also need to find a certain patterns, certain technicals we can pair to that. So now we're going to talk about how does price go to the target. And it's very simple. You need to know the daily bias. Where is price most likely headed next? Are we going up or down? And how we're doing that is very simple. It's by combining few different elements. One is the AMD, the accumulation, manipulation, distribution, and the other one is the open, high, low, close. The understanding of the AMD or the power of three is very simple. The accumulation is the consolidation. It's right here when we just consolidate. Intraday, very important from a daily bias perspective, Asia on most assets, euro dollar, the NASDAQ, is accumulation. So trading the Asian session, you will most likely trade the consolidation of the day. You don't want that. You want to catch the big expansion moves. There's where the most money is. And after that, you will see, after the accumulation, you will see a fake move. So if you want to go up on the day, you will see a move lower before going higher. So the fake move in the opposing direction of the target. And then the distribution starts. That's literally boom, to the target. Pro tip, mark out the midnight open. And the midnight open is the New York midnight open. And if you are bullish, and let's say this is the midnight open, try to buy below the midnight open. So most of the time in the manipulation, there is where the buy structure will form. In this schematic, most of the time, this will be a fair value gap or an order block or a supply and demand area. There will be some nice structure forming below that midnight open. And of course, vice versa when you are bearish. And here's where you already need to combine time with price. So most of days, this will be Asia. The manipulation will happen during London, and New York AM session is on most of the days, or the manipulation, or when the manipulation already happened in London, it's just going to be the expansion. That is why most traders, the biggest traders, only trade the New York session intraday, because there statistically is where the biggest moves, the biggest ranges happen. So now you know how to combine the kill zones with the AMD schematic, but how do we know if we're going to go up or down? If it's going to be a green candle, an up candle, or a down candle. And there's where the open, high, low, close comes in. Because when you expect a bullish day, play a bullish AMD. It means if you expect the next candle to be green, you wait for price to open, then drop lower, creating the low of the candle, and then start trading higher towards the high of the candle. And here you see again, accumulation, manipulation, distribution. Expect the next candle to be bearish, then we're going to do vice versa. Wait for price to open, accumulate, then manipulate higher, and then start the distribution lower towards the low of that candle. And there's dedicated videos on daily bias on how to predict the next candle to be up or down on this channel. I'll leave the link to them in the description. Also, just find them here on this channel. But right now we're going over the service level of those daily bias videos, because price only does two things. It is go to external range liquidity, that means old highs and lows, or it rebalances. And the golden rule is, that should be in your trade plan, you should try to always have in your mind, I trade from internal to external or from external to internal. What does that mean? It means this. External range liquidity, meaning trading back to an old high or low. So in this schematic, we leave a old high behind and then start trading lower into internal range liquidity. Internal range liquidity is a fancy word for a fair value gap or a supply demand area. Just a price inside a range where we could react off from. So we go from internal back to the high from external. Ideally, use premium and discount in this. So go from swing low to swing high and try to catch that move into discount of the range. The second thing price can do is rebalance, both from an old high back to or a fair value gap, the internal range liquidity, the imbalance, or back to 50% of the range. remember, premium and discount, then you can just short back to discount of the range. And if it's overlapping with a fair value gap, that's a very nice target to trade towards. That is the only thing price does. Or go from internal to external, or from external to internal. With that golden rule, where you only can trade from internal to external, or from external to internal, you only can have 3 types of days. The first one is the easy day. There's where I make the most money. It's the expansion day. And that happens the day after price trades into a key level. And when it trades into a key level, then it reacts from it. And then the day after that, so this candle is the most easy day because you already can anticipate that this low is going to hold. And then you have that exact green candle you expect. And then intraday, during the day, you just wait for price to accumulate, then trade lower below the midnight open and start creating the distribution, the buy structure. Those are the easiest days. Then after that, where you can also make money, but it becomes a little bit more tricky, it is on the reversal day. That is the day when we actually trade into that fair value gap. And then we try to trade the wick of this daily candle. So that means here is that fair value gap, that yellow box right here. And we just wait for price to make the manipulation move into the fair value gap and then trade higher. This most likely happens during news. And then your entry will be somewhere around here and during the catch the distribution move. And that's why it's so important to always have higher time frame fair value gaps and old highs and lows on your charts, because you just wait for or the easy day, the trending day, or the reversal day to happen from those key levels. And it's nothing more than old highs and lows and fair value gaps on the daily, weekly, and monthly. And the third day, the low probability day, is the doji day. There is where most of the time we are in between 2 highs and lows or 2 fair value gaps. It's trapped order flow. Price just doesn't know where it wants to go. Very important, the word trapped order flow, that you anticipate that if there is a, for example, a bearish fair value gap and a bullish fair value gap very close to each other, and we're just in between there, then that is a very low probability condition where you should expect consolidations and just wait for one of the two to be respected and one of the two to be disrespected. And this schematic is the only thing you need to remember on how price delivers to a target. You use the AMD, the accumulation, manipulation, distribution, together with the open, high, low, close, together with if you anticipate price to go up or down. Combine this with executions during the kill zones and executing around the red folders. That is exactly what you need to take way better trades than you're doing right now. And now let's see the kill zones in action. Here we're looking at NASDAQ at the 5-minute chart, and we have Asian session here in the blue. There is London session right here, and New York session is the green one. You're used to me showing everything before it happens, but I want to make sure this depiction of the kill zones is very clean. Because if you know the power of the kill zones when time, you will recognize the setup when it needs to happen. Because if you would not know the kill zones, you don't know where to trade. You see this happening and you see price trading lower, creating fair value gaps. You're like, okay, cool. We're now going to take shorts towards here, stop above this high or above this high, towards the low right here for 1 to 2 or 1 to 1.5, and you'll be stopped out before the real move because you ignore that NASDAQ moves after the New York Open. If you know that because you used the indicator, then you knew that you need to wait until 9:30, and there is where there's the A plus setup. There's a liquidity sweep. After that, we have displacement, breaking structure, and there is where the entries can be taken. And if you're not convinced yet, let's go to the next day, where there is the PM session here. There is Asia, London, and New York. Same story. If you would have not known the kill zones and we're like, okay, cool. I see here aggressive sells, aggressive buys. I see an order block. I see a small fair value gap here. I see it moving away. So somewhere here, you take an entry, stop below the low for 1 to 2. You again would have been stopped out before the real move because you don't use time in your trading. Do the kill zones again. That's the 9:30 at the open. We sweep the liquidity, then we break structure, and there is where in this fair value gap is where you can take your entry for 1 to 2, 1 to 3. The exact same scenario 2 days in a row. And these are the exact trades I took myself as well at the time of recording, because this is a live chart right now. It was yesterday. And of course, if you want to learn more about how this exact entry model works, on this channel is a playlist called Entry Models. This exact model is inside there, so make sure you check it out right now. Here on this day, on February 12th, we have an 8:30 red folder. And you see before that red folder, we do not do anything. If you zoom out a little bit, the price is not very nice. But then we can just play a very classic open, high, low, close. And AMD, accumulation, manipulation, distribution. Can be bullish, can be bearish. But let's see if the 8:30 AM candle gives us the manipulation we are looking for. So here at 8:30, we move upwards. And after that, we create a 15-minute bullish fair value gap here on the expansion of the news. So let's drop to the lower time frame to see what we get. So we trade into that 15-minute busy, but then we don't move away. Then to New York Open, Price chops around a bit. We sweep the liquidity right here. Then we start trading lower right here. So in this change state delivery, you could already have taken your trade around here, stop above the high for 1 to 2. But most importantly, it is so important that you wait before the red folder, because the red folder push price up before going lower. If we zoom out on this price action right here, this candle is the 830 candle. So we have the accumulation, manipulation with news, the 830 manipulation, and then we start the distribution higher towards clear targets or these swing lows right here. And that is how you combine time with price, when to trade and how we trace towards a target. If you got value out of this video, make sure to check out the video that's now appearing on the screen, because using this exact method about time and price in combination with the A+ setup that happens almost every single day, you are ready to start making money, get funding, get payouts. Don't forget to subscribe and comment your biggest takeaway. Thank you for watching, and I see you in the next one. Is it possible to trade profitably without using 20 timeframes? Oh yes, and it's the only way I went from losing $60,000 to trading full time. Most traders think they need to analyze the weekly, the daily, the 4-hour, all the way to the 1 minute just to take a trade. And they're frozen by analysis paralysis. This video is not about adding more lines or more timeframes to your charts. It's about deleting them. I'm going to show you the exact timeframe alignment framework I use to skyrocket my win rate, ignore 90% of the noise, and got me to over $1 million in funding. No time to waste, let's get into the video. You have so many timeframes you can look at, but to execute a trade today, you only need 3 buckets to align: the higher time frame, the intermediate time frame, and the lower time frame bucket. This is the higher time frame bucket, and it's the daily, the weekly, and the monthly. This bucket tells us if the casino is open. If this bucket is empty, so there's no clear setup, we do not trade. And a pro tip here is to look for trending conditions down or trending conditions up for the most clear setups. If you know the context up or down, the next step is to go to the second bucket. That's the intermediate term time frame. It's the 1 and the 4 hour. So inside this down close candle, if we drop then to the 1 and the 4 hour, this will look like this. It's the structure. So we have the context is down, but inside the down context, we are going to find structure on the 1 and the 4 hour. This structure, you see a value gap, there's order block sitting here, it changes a delivery, and we start trading lower. And if you know the context and the structure, inside that structure, so inside here and inside here is where you drop to the lower time frame. That's the 1 minute, the 5 minute, and the 15 minute to find your entry model. This example, there's an order block sitting here and a fair value gap, so the entry can be taken right there, and just trade the context and the structure. But the context is lower, structure is lower, and the entry model is going to be short. You have a very high probability trade on your hand. Imagine you trying to rob a bank. Bucket 1, the higher time frame bucket, is the intel, the information. Is there even money in the vault today? Is there not a lot of security? And if that doesn't look nice, you of course not going to rob the bank today. Bucket 2, the intermediate term time frame, the 1 and 4 hour, is the alarm system going down and you getting in through the back door. It's your path to the vault. So when bucket 1 looks nice, bucket 2 looks nice, and then bucket 3, the lower time frame, is just you walking in, grabbing the cash at exactly the right time. But your problem now is you're walking into the bank in the middle of the day when there's a lot of security guards and all the cameras are rolling, and you're wondering why you do not make the money. You could not have just sit back in your car and wait. You were bored. And the same with trading. You're trying to force a trade when you're bored. You need to wait for the 3 buckets to align to take the highest probability trades. If the buckets do not align, we sit on our hands. But now you know the 3 buckets, you still have more than 10 time frames you can choose from. But to show you exactly which one you should focus on, I will show you a table I use to nail this every single time. Here's the framework. Make sure you screenshot this right now. And this alignment works as follows. If you have a weekly context, you look at the 4-hour structure. If you have a daily context, you look at the 1-hour structure. 4 hour to 15 minutes, 1 hour to 5 minutes, and 15 minutes to 1 minute. And if you have a weekly context and a 4-hour structure, if you then want to take the entry, bucket 3, it needs to be taken on the aligned time frame. And what's the aligned time frame with the 4 hour? Is the 15 minutes. So if you see a weekly context, you use the 4 hour and the 50 minute. If you, for example, have a daily context, you use the 1 hour structure for this. And if you want to take an entry on a 1 hour structure, you need to find the aligned time frame of the 1 hour, but here's the 5 minutes. So you go from a daily context to 1 hour structure to 5 minute entry. Similar with 4 hour to 50 minutes to 1 minute. And if you see my previous video about trader identity, you know by now if you are a day trader or a scalper. If you're a day trader, you can use the following time frame alignment. It fits your exact identity. A day trader looks at a daily context, at a 1 hour structure, and a 5-minute entry. So you cannot go blindly to the 5 minutes. You need to have a story created in a daily and a 1 hour before you can take a high probability trade. Similar, if you're a scalper, you need a 4-hour context, 15-minute structure, and 1-minute entry. And if you, for example, know the 10 a.m. game, my favorite entry model, in that entry model, I use this exact alignment where we predict in step 1 the buys of the 4-hour candle. I use a 15-minute structure and a 1-minute entry to make money almost every single day. I created an entire dedicated video about the 10 a.m. game. I will leave that in the description and also somewhere here on the screen. But one very important note here, pick only one protocol. Or you're a scalper, or you're a day trader. Don't be a hybrid. You need to master one of the protocols. And please, if you're scalping the 1 minute, don't care about what the weekly time frame does. It is just noise. Keep the data set small. Especially with time frames, complexity is the enemy. And if you don't know how to identify key levels, create a top-down analysis, or just want to steal all my entry models, I created a free video course called the Market Maker Blueprint. It covers the exact technicals and the exact frameworks I use myself in my trading. If you want it, the link is inside the description, and go get it. It is free. We're now looking at the NASDAQ chart on the 4-hour time frame. It is an example of the scalper protocol where you have a context on the 4-hour, the aligned structure is on the 15-minute, and the entries on the 1 minute. If you look at this 4-hour structure, the context is pretty easy to determine. We have aggressive sells right here into a 4-hour bullish value gap, a liquidity sweep, and we have aggressive buys. Up here, we have these relative equal highs sitting here, also this high. So the buys is going to be higher to these highs. So the context is going to be higher. Then what we need to wait for is 15-minute structure. Ideally during, because NASDAQ, ideally the structure is going to be formed around the New York Open, around 10 a.m. Now let's drop to the 15 minutes. Right here, we look at the 15-minute chart and the time now is 8:30. So we're going to open very quickly. And during the New York Open here on Tuesday, January 6th, you can backtest yourself as well. There's a massive expansion. So the context is higher and the structure with the displacement is also going to be higher. And most of the times when this move happens, you will miss the move. But then you need to just wait for the structure, for value gaps, order blocks, all that stuff. So once 10 a.m. starts, there is on the 15-minute time frame, there's a fair value gap sitting here, also a fair value gap sitting here. So all we wait for the structure is price to come back into this 15-minute fair value gap. Can be this one or this one. And then on the 1 minute for the entry, we just wait for a reaction. So price comes back into one of these and then starts creating buy structure towards the target. So now let's drop to the 1 minute to see if we can find an entry based on the 4-hour context that's higher and the 15-minute structure, there's these fair value gaps. And then on the 1 minute, let's see for the entry. Now look at the 1 minute time frame and let's see what price gives us. So there's accumulation here. And now we're trading lower into the 15-minute bullish fair value gaps, both the top one, but also now the bottom one. So we're going to remove this. So we're going to play around here. So in this case, we just wait for buy structure to be created. We can zoom in on this price action and we need to wait for it. Do we see bullish fair value gaps? I do. Right here. Also an order book sitting there. And see if we move away from that. We do. Second fair value gap right here. This is already enough for me to take the entry. I don't care if we chop around here. This is the entry. You know the 10 a.m. game. Links in the description. You know PD array 1, PD array 2, this PD array 2, this PD array 2. So long in this fair value gap, TP at the target for a 1 to 2 or 1 to 3. Say you want to do a 1 to 2 right here. And let's see what price gives us. And in the PM session, it gives the take profit point. So you see at the start, we chop around a little bit and that is normal, that can happen. But your focus should be on the scalper protocol where you saw the 4-hour context was bullish, the 50-minute structure we're in right now. And inside that 50-minute structure, there is where you wait for the 1 minute entry. And most of the time, price will not go immediately to your TP. It will hang around for a bit. When the higher time frame bucket, the context is nice, the structure is good, the entry will follow through. Now, I know what you're thinking. Dion, this looks so easy. Is this actually the only thing I need to make money? Of course not. Here is why time frame alignment alone won't save you. To be a profitable trader, you need 4 core things. You need technicals, you need data during a backtesting, you need a trade plan, and you need the mental frameworks. 90% of traders only focus on technicals. So when they hit a losing streak, they start strategy hopping, hoping a new course will fix their problems. And that's a losing game because you're ignoring the other 75% of the trader pyramid. You need proper mental frameworks. You need a trade plan that says if XYZ is happening on the charts, then I press the button. And you need the data, the proof that what you're actually doing with your trade plan works in the long run and makes you money. Technicals are only 25% of the equation. And the trading industry sells you a technical solution to a psychological problem. And you understand this logic about time frame alignment, but tomorrow morning you wake up, you see the candles moving fast at the 1 minute, and your monkey brain will wake up like, oh, what do I need to do? And you will ignore the daily chart, the context, you will ignore the structure on the intermediate term time frame, and you'll just start chasing a move again. But please remember this. Time frame alignment is not about lines or some magical holy grail entry model. Time frame alignment is about patience. It is about a discipline to say no to a trade because the 3 buckets aren't activated yet. We are trading like the casino, like the house. And the casino does not guess. A casino waits for its edge to play out. And for that, you need to sit on your hands a lot of the times. In this next example, we're looking at ES at the daily chart. And for the day trader protocol, we need a daily context, inside a daily context, a 1-hour structure, and a 5-minute entry. So let's see how that looks on the charts. Here there is a daily bullish fair value gap, and we create a swing low inside a daily bullish fair value gap, making the bias for this day bullish, ideally towards this high right here. So inside this daily context, we need 1-hour structure. So now let's drop to the 1 hour. We're already forming structure on the 1 hour inside this daily fair value gap. Aggressive sells, aggressive buys. And we displace already on Monday right here, leaving a 1 hour bullish fair value gap. Inside this 1 hour bullish fair value gap, we can maybe look for structure on the 5 minutes. So now the time of day, it's the Asian session is coming up. Let's fast forward towards the London session and the New York session. Here in the London session, we trade into the 1 hour bullish fair value gap. Usually ES, NASDAQ, and YM, the US indices, the futures, trade in a New York session. But we can already look if we see some structure forming for the entry on the 5 minutes. From the daily context, we went to the 1 hour structure that's right here. And now we're on the 5 minutes to see if there is maybe an entry coming up. So right here, there's not much. I'm waiting for clear displacements. For example, right here, this is already pretty nice. Right here, a fair value gap. But look at the time. Entries on the US futures are around the New York Open. So I'm waiting. Another fair value gap sitting here. That is nice as well. Price trades into that. Does not respect it. And this is the exact reason why I don't trade before the open. Because then I was like, okay, let's take a trade right here towards the highs. And I got stopped out. So this is not the correct move. Please don't be stubborn about this. Just wait until the New York Open. Now we're approaching 925 and we start displacing higher. Probably the real move is coming right now. So at the New York Open, there's now a 5 minute fair value gap. I'm waiting for the entry for price to tap into here and then respect it. So I want a wick created inside that 5 minute fair value gap. Exactly here. So in this candle, well, let's do the candle close is where I would take the entry. That it would be right here. So it's a little late to the party. Put it right here. Stop below the fair value gap or below the low. Because we already moved away so aggressively, I'm okay with putting it below the fair value gap for a 1 to 2. And let's see what price gives us. And we go to TP in 1 go. Cool. This is very fast and aggressive. Maybe you see this is 935 and the TP is hit is so fast. What if you miss this move? And if you see my previous video about the FTMO protocol, when this happens, zoom out because there probably will be another entry. So this was already TP, but let's say you missed this. Now we're going back to the 1 hour time frame. We zoom out. And what is created on the 1 hour right now? There's a new 1 hour structure created. Same daily context, but the 1 hour structure, new 1 hour value gap. So let's do the same. Let's see if we can catch an entry inside this 1 hour for value gap to catch the continuation. Back on the 5 minutes, price comes back into the 1 hour for value gap. And let's see if there's a reaction. We do not move away from this yet, but once we start creating buy structure, once we create up close candles and especially trade above these series down close candles, I'm open to press the button. There's a small fair value gap here. So the entry would be from here. So again, we wait for price to come back into it, reject, just like this first example, where you wait for that candle to close, take the long up there, stop below the low for 1 to 2.
and then price goes to TP as well. So with the day trader protocol, with the daily context, 1 hour structure and 5-minute entry, you could have had 2 entries right here on a single session. And you also should know that if you trade before the session, you will probably get faked out before the real move. And it's a very nice example of this. So make sure you don't do that and sit on your hands. You need to be patient for the 3 buckets to align. So stop trying to predict every candle. Use the 3 bucket framework. Wait for the time frame alignment to play out and execute only when the 3 buckets are aligning. If you want the exact technicals and entry models I use in my trading to get over $1 million in funding, make sure you check out the Market Maker Blueprint. The link to that is inside the description. And if you like this video, make sure you check out this video that is now appearing on the screen, because combining this video with the one you're now seeing on the screen will make you grow even faster. So make sure you check it out right now. Thank you for watching, and I'll see you in the next one. Bye-bye.
What if I told you that everything you think you need to learn about ICT, the break blocks, the order blocks, inversion for value gaps, the silver bullets, is actually holding you back? I've traded for 5 years and I found that 99% of traders are drowning in complexity. They're trying to learn it all and it's killing their results. In this video, I'm going to reveal the 1 core concept that underpins all of ICT. Master this and I promise you, the charts will finally start to make sense. Stick with me because it's the video I wish I had when I started. The concept is the market structure shift, or MSS, but not just any break of a high or low. I'm talking about a specific type of shift that signals a true change in order flow. Let me show you. Forget anything else for a moment. This is the tell. This is the moment the algorithm reveals its hand. It's a starting point for every high probability trade you will ever take. And most traders get this wrong because they're looking for any old break of structure. They're looking for random highs or lows to be taken and classifying that as a structure shift. They're not looking for the character of the move. And that's what we're going to break down right now. So what makes a market structure shift valid? It's one word: displacement. This is what most traders see, but this is what you need to see. This right here is displacement. This is an aggressive move that leaves behind inefficiencies, fair value gaps. This is the clue that big money has stepped in. This is where the magic happens. The fair value gap is your new point of interest, and it's where you'll be looking for your entry. And on this bad example, you see a little bit of displacement, but the last swing high that made the low did not get ran. So there's no valid market structure shift. And you will see those most of the time just failing. Just like you see here in this example, you see a fair value gap, but we fail to take out that last high before the low. We stay under that. So eventually you'll see that we start to break down. So how do we trade this? It's a simple 3-step process. Step 1 is you identify the market structure shift with displacement. For example, here you see a liquidity sweep during a kill zone is 930 is the open. If we zoom out a little bit, we see that we are in a massive fair value gap here. So also a key level. So we have a liquidity sweep, then we displace higher. Displacement is characterized by fair value gaps. I see one here and I see one right here. And the last swing high that made the low, that is the one that needs to be broken right here. So you see a valid displacement. So step 1, the market structure shift is right here. When we break this with this candle, we break the low. The candle that makes the market structure shift, if in that candle is a fair value gap created, that is a high probability fair value gap. So we wait for step 2 is when we come back into this fair value gap right here. And then step 3, wait for price to come back into this fair value gap, which we do here at 1045. And then you can take the entry from the start of this fair value gap. I will put my stop loss below the bottom fair value gap, and you can trade for 1 to 2 or 1 to 3. I like to shoot 1 to 2s. And you would have here a 1, 2, 2. And it's also overlapping with a nice target. There's this bearish fair value gap. I spent hundreds of hours studying ICT concepts, and I broke down every single concept with my own personal notes in this 500-page PDF. It goes over everything from entry models to the different concepts, from interest rates to everything you need. So if you want to save those hundreds of hours, want to get it right now, I will leave the link to this PDF in the description. If we look at that same price action a few days later, we see that we have a liquidity sweep right here. Then we displace. How do we characterize displacement? It's because of fair value gaps right here. And we come back into the fair value gap. You can take your entry into fair value gap, stop below this bottom fair value gap for a 1 to 2, and you would not get it here, but the next day you would have your TP and even a 1 to 3 or a 1 to 4. We're waiting for the market to show its hand with a clear, energetic shift, and then we're looking to get in on the pullback. Simple, clean, and effective. Now there's a few traps you need to avoid. The first mistake is taking every break of structure, because every time you see displacement, you think there's a break of structure. You see price creating a high. We swept it high with displacement. So you take this trade because you think it's a break of structure and you are getting stopped out very quickly. A quick tip here is to add a liquidity sweep
to this framework. So you're trading higher probability market structure shifts. I have a video dedicated to finding liquidity here on this channel. I'll leave the link to that in the description. You basically have a few types of liquidity. You have session liquidity, London low, New York low, Asia low. You have daily liquidity, daily highs and lows, and weekly liquidity. Those are the liquidity pools I'm looking at. And for example, in this example, we didn't take any significant liquidity. The only liquidity we took was from a PM session here on Euro US dollar. That's not enough liquidity. Ideally, liquidity pools are all daily higher low or weekly higher low. The second mistake I see traders make is trading on the wrong time frame. I use time frame alignment for my highest probability time frames. So if I have a weekly level, I'm looking for a 4-hour structure. If I have a daily level, I'm looking for a 1-hour structure. And if you're an intraday trader, you're most likely going to do from the 4-hour level, a 1-hour level, or a 15-minute level. So intraday, most of the time, you have a 1-hour bullish fair value gap where you can wait for the price to come back into. And once price comes back to the fair value gap, then you can drop to the 5-minute to find your 5-minute market structure shift. What most people do is they just chill at the 1 minute like we're doing right now. We see some candles print and randomly we try to find the next market structure shift and hope that it's going to work out. That's not how it works. Use time frame alignment in your favor. So the first mistake was trading every market structure shift. Try to add a liquidity sweep to that. This second mistake is trading every time frame. Use time frame alignment to get more structure into your market structure shifts. And the third mistake is ignoring the higher time frame narrative. All your trades should be based on a daily, weekly, or monthly narrative. At the start of each week, I mark out the daily, weekly, monthly for value gaps at all highs and lows. Just like, for example, here on USD JPY, where there is a clear monthly bullish for value gap. And this is a trade I actually took. And from this monthly level, we can go to the daily, to the 1 hour, to the 5-minute. So let's drop here from the monthly to the 1 hour to see like, hey, how can we incorporate all the traps, the 3 mistakes to find a higher probability trade. It starts for mistake 1 is finding a liquidity sweep. We got this inside a key level. The key level is the monthly bearish fair value gap. What is the last swing low that made the high? I would say that's this one. But if you want to be very complete, you can even do this one. So you're only going to mark it out as a market structure shift once this swing low is broken. With what? With displacement. Characterizing by fair value gaps. Big energetic move to the downside. And here, this swing low gets violated by this small fair value gap. So this already could be your first entry right here. And we're trading here at the 1 hour. You can drop it here to the 5-minute in this level to find your entry. So right here, you could already have a 1 to 2. What if you thought, hey, I don't think this is enough for my market structure shift. I would rather wait for this to happen. Cool. When we have this displacement, so you missed this first move. Here, there's another displacement breaking the low here, closing below the low. What is the candle that made the displacement? There's a series of these 2 candles. So right here, you can do this one or you can make it bigger like this. Here is where your entry is. Remember the steps? We have the last swing low that made the high. Gets broken with displacement and energetic move. We wait for fair value gaps to be created and we wait for the pullback to get in to trade the fair value gap. So here you could take your entries in all these moves. It was a long wait. It's an hourly. It's a long wait. But you can trade here and here during the London session, another displacement, during Asia and London, another displacement, and you can even take another entry in this fair value gap. If you miss that one, we can even drop lower here. We have short-term liquidity here, taken by this high. This high trades into this bearish order block, and then we displace lower. What do we leave behind? Fair value gaps, because this looks pretty bullish, right? Pretty bullish, but we change structure to the downside. Last swing low that made the high got broken. And why are we not looking for bullish market structure shifts here? Is because we have a higher time frame narrative. That is from the monthly, we expect a reaction. Let's zoom out again. We expect a reaction from this monthly bearish fair value gap to the downside. So our structure shifts, the high probability structure shifts should be to the downside. So when we see a liquidity sweep right here, we see displacement leaving fair value gaps, market structure shift. So here, these candles is where you can take your entry. And then we retrace, displace again. Let's see how many entries you could take inside this move. And this is a live, we're looking at the live chart right now. Then we displace lower again. And you just follow the fair value gaps into this sell model. Look at this. You can, this, of course, it didn't hold exactly, but pretty nice entries. And now we are just trading lower. All starting from that higher time frame narrative, the monthly bearish fair value gap, we drop down with time frame alignment to the 1 hour. And the 1 hour, we see liquidity sweep, we see displacement leaving fair value gaps. We wait for the pullback to get into the fair value gap, and then we take the trades. And this whole sell move from the monthly SIBI to the downside, you could have taken 5, 6, or 7 intraday entries. So no matter if you're watching this as a swing trader or an intraday trader, you can use the concept we are discussing right now in all of your trades. And because of that, pass more challenges and get more payouts. So why does this one concept beat everything else? Because it simplifies your trading into one core pattern. It forces you to be patient, to wait for the right high probability setups. If you got value from this video and you're ready to simplify your trading, subscribe to the channel and let me know in the comments what your biggest aha moment was. And if you want to see me trading this concept live, check out this next video where I break down how I use this concept to pass prop firm challenges and get to over $1 million in funding. Thank you for watching, enjoy the next video, and I see you on the charts.
This is a fair value gap, and these are the 5 secrets that will determine if your fair value gap is going to hold or not. Understanding this about fair value gaps is the shortcut to become a professional trader. In this video, I'm going to show you everything you need to know about how to use fair value gaps. Fair value gaps together with time frames, liquidity, volume imbalances, gaps, the biggest mistakes I see my students make trading fair value gaps, and of course, the 5 fair value gap secrets. No time to waste, let's get into the video. A fair value gap is a 3-candle pattern that shows a gap between the first and third candle's shadows. And if you clicked on this video, you probably already know what a fair value gap is, but let me break it down in the next 10 seconds. A fair value gap, in this example, a bullish fair value gap, is also called a busy buy-side imbalance, sell-side inefficiency. If a bearish fair value gap, you call it a SIBI. B for buy-side, S for sell-side, SIBI busy. And you'll see that the first candle's high does not overlap with the third candle's low, creating a gap. That is fair value gaps 101, but we need to dive deeper into this to fully understand why we need to use fair value gaps. And the first area inside a fair value gap that you need to know is the consequent encroachment, the CE. That's a fancy term for the 50% of the fair value gap. The 50% level of a fair value gap is important to see if the fair value gap will hold or not. It means if you have a candle and you see that the body is closing at the top of the 50%, then you can conclude that the fair value gap wants to hold and we're just going to trade higher. And how you can use the consequent encroachment is if you have the next candle, it trades into the fair value gap, but it closes above the 50%. So this is the candle you will see. You see that the wick comes to the 50%, but the body closes in the top 50%. Then you can conclude that it's most likely want to hold. And you will see the next candle being up as well, continuing the trend. But there's also a scenario where price does close below the consequent encroachment of the fair value gap. And when that happens, it hints that we're most likely not going to hold the fair value gap and just going to trade lower, most likely towards a recent low. And fair value gaps are family of the imbalances. And an imbalance in the market is where price likes to come back to before continuing the move. And other forms of imbalances are volume imbalances and gaps. Where the volume imbalance is the gap between the open and close of the bodies with overlapping wicks. So in this example, you have the body here and the body here, and the volume imbalance is when there's no trading in between those bodies. In a gap, there is space between the two candles' wicks with no trading activity. You will find these imbalances together with fair value gaps on the chart, and they are all forms of imbalances. And screenshot this exact depiction, pause the video so you know the exact difference between a fair value gap, a volume imbalance, and a gap. Fair value gap, 3-candle pattern when there is no overlap between the first and the third candles. Wicks, volume balance, 2 candles when there's no trading in the bodies, and gap when there's no trading between the wicks. Keep in mind, very important, fair value gaps, volume balances, and gaps are not the same, but they can be used for exactly the same liquidity purpose. Let me explain what that means. If we talk about liquidity, price does only 2 things. And that is, one is grab liquidity, external range liquidity. External range liquidity is another word for old highs and lows. I have dedicated videos on liquidity on this channel. I'm not going to break the exact liquidity concept down in this video, but the only thing you need to know regarding fair value gaps is that price has external range liquidity and internal range liquidity. That's the only 2 places price wants to go back to. If we talk about internal range liquidity, those are the imbalances. So fair value gaps, volume balances, and gaps are internal range liquidity. And old highs and lows are external range liquidity. So that means price goes back from old highs and lows back to imbalances, fair value gaps, volume balances, and gaps. So no, they are not the same, but they will be used for the exact same liquidity purpose. When price goes back to internal range liquidity and moves away from internal range liquidity. And now you go to the chart and you're trying to find your fair value gaps. You're on a 1 minute, you find fair value gaps, on a 5 minute, on a 1 hour. And all of a sudden you have 20 different fair value gaps on all different time frames marked out. But that's the question. When do you use which one and on what time frame? And there are a couple of rules for this. The first rule is
The higher the time frame, the more reliable the fair value gap. It means if you have a fair value gap on the 4-hour and a fair value gap on the 1 minute time frame, you must understand that the 4-hour fair value gap is way more likely to hold or to move away from than a 1 minute fair value gap. The second rule is overlapping time frame fair value gaps are powerful. For example, if you have a fair value gap on the 1 minute, on the 5 minute, and the 15 minute all at the same place, you can mark that out as a very strong fair value gap. And you can see that price is like a magnet that wants to move towards that target, but also it likes to move away from that target. And the third thing you need to understand is that price is fractal. So you need to understand what happens on the 4-hour time frame, that there is a whole concept below the 4-hour time frame on the 1 hour, the 15 minute. Let me show you how that works. This is a depiction you've seen in my market maker model video. And this shows exactly why price is fractal. Because if you have a market maker on the higher time frame, and to understand price is fractal, you don't need to understand what a market maker model is. But in that video, I explain if you have a market maker model and you want to enter here, let's say this is the 1-hour time frame, your 1-hour market maker model, and inside here you want to drop to the lower time frame. You go from a higher time frame to lower time frame. So let's say this blue area is a 1-hour fair value gap where price comes back to and it wants to move away from. From the 1-hour time frame, we go to the 5-minute or the lower time frame to look for the exact same schematic, but then on the lower time frame. So inside a higher time frame fair value gap, you can find lower time frame structure, lower time frame fair value gaps to trade off from. That is how you also do a top-down analysis. You go from the higher time frame, your fair value gaps. Inside those higher time frame fair value gaps, you drop to the lower time frame, find fair value gaps inside fair value gaps, because then you can discover the second powerful rule about overlapping time frames. 4-hour, 1 hour, 15 minutes fair value gaps on the same level are super powerful. I've been helping traders for over 3 years now. And based on hundreds of data points, these are the 3 biggest mistakes I see my students make when trading fair value gaps. The first one is not trading with the higher time frame trend. And what that means is that if price is super bullish, you want to take longs. You don't want to trade counter trend. You will see that those trades are just very low probability. But if you zoom in, let's say this is the 1-hour time frame, and we zoom in on this piece of price action, specifically down close candles, if we then drop to the lower time frame, you will see that it creates sell structure. You will see a bearish fair value gap, and you're like, hey, I see a bearish fair value gap. Bearish fair value gap means shorting. But biggest mistake you make is you don't trade with the higher time frame trend. So if the higher time frame trend is bullish, a bearish fair value gap is not likely to hold. So you will see that we come back to the fair value gap and then just completely ignore it and start the continuation back upwards. That is because you need to follow the higher time frame trend. The second mistake I see traders make, especially trading the 10 AM game, that's my 1-minute scalping model, is not waiting for the third candle to form. Because when you're looking at the charts and you see this candle happening, this is also called an engulfing candle, just a massive candle to one side, this massive green candle. You're like, hey, this is nice. This is probably going to create the fair value gap and it's probably just going higher, right? But the mistake is you need to wait for that third candle to form. Because in this example, after the second candle, it just created this. There was no fair value gap created whatsoever. And that's what we want to avoid. So always wait for the third candle to form and then price comes back to that fair value gap and then moves away from it. And that means you need to have some patience when a fair value gap is forming. And the third mistake is trading fair value gaps that are created outside the kill zones. And vice versa, fair value gaps created inside the kill zones are higher probability. If you don't know what kill zones are, those are the high probability trade sessions, London session, Asia session, New York session. I have a dedicated video on kill zones here on this channel. I'll leave a link to that inside the description, together with the early mentioned market maker model videos. And on all the specific concepts I'm talking in this video, there are specific videos on this channel already. So after this video, make sure you check out the rest of the channel. There's a lot of nuggets to share. I spent thousands of dollars on courses in my 5 years of trading, and I made it my mission to put out all the information just for free so you can learn for free as quick as possible. Back to the video. You have 4 different sessions: Asia, London, New York, AM, and PM. And if you trade Forex, you need to memorize that if you trade, for example, the London session, fair value gaps created between 2 and 5 AM New York time, these times are New York time, that means EST, those are nice. But if they are created at 6 AM in between the kill zones, I wouldn't trust them too much. Same for the indices. Fair value gaps created during the kill zones are super nice, and especially in the silver bullet window. Silver bullet windows is a 1-hour window where there's the highest probability of a nice trade to form. That is between 3 and 4 for London, 10 and 11 for AM and 2 to 3 p.m. for the PM session. So now you know the 3 biggest mistakes my students have made trading for value gaps based on hundreds of data points, not trading with the trend, not waiting for the third candle to form, and trusting for value gaps that are created outside of kill zones. Now it's time to look at the exact secrets you need to start trading for value gaps like a professional trader. And the first secret is when the fair value gap is already being touched before, being traded into before, it is less strong and it could most likely fail because it already has been used. And here's an example of this. Here we're looking at NASDAQ at the 50-minute time frame, and this secret I'm sharing works on all the time frames. If you see this 15-minute bullish fair value gap, if you zoom in a bit on this, you will see that here we already traded back into it and we moved away from it. So here we can determine it has been touched already. It has been traded into and be moved away. But then there's no follow through on that trade idea. You see the price just starts consolidating and doesn't move higher. That is interesting because that gives you a hint that we maybe don't want to go higher, especially if then price comes back to the fair value gap. Like you see this sweeps a little high here and then it just starts trading lower. Then it comes back again inside the fair value gap. And here is the best secret, and also the mistake I see traders make, is to think, hey, price comes back to the fair value gap again. Now let's take another trade because the fair value gap is still there, right? Because you know the rule about fair value gaps. If we trade above the 50% of the fair value gap, the fair value gap is still valid. That is true on paper because here you see that in the first step, the first touch, we trade into it multiple times, but the bodies are closing in the top 50% of the fair value gap. That is nice. That's what we want. But you now know that if we then come back again, it is most likely not going to hold anymore because we already traded from it. It's already been used. So how you can trade that and use that is use this low as a drawn liquidity. We're most likely just going to take out this low then. So where amateur and beginner traders think, hey, let's move away from that fair value gap, you now know that you can try to then take shorts towards that exact low inside the fair value gap. But that's the first secret. When it's being used, don't trust it anymore. And that will save you a lot of losses. And the second secret is the question of what if there is multiple fair value gaps created in the same big move? Which fair value gap do you take and why? And there are 2 different strategies for this. And I want to use this as an example. Most of the time during the New York Open or during a news event, you will see massive green candles being printed. And then you have 2 fair value gaps. And you're like, hey, okay, do I enter here or do I enter here? The first strategy you can use is that you enter in the first fair value gap and you put your stop loss below the other fair value gap. In this example, if you would have done that, you would have been in the move. Price steps into it and then trades higher. It doesn't come back to the second fair value gap. The second strategy you can use is use premium and discount in the displacement range. So there's a low right here. There's a high right here, premium and discount, and you try to long from discount of the range, so the bottom 50% of the range. And based on that, you can say that probably this fair value gap then would be the entry. And keep in mind here, both 1 and 2 work like a charm. In the long run, it's almost 50-50 on what works best. It needs to work for you. And to give you some food for thought, how you can determine what works best for you, these are the pros and cons. Strategy 1 gives you less risk to reward because you need to have a pretty big stop loss. Your stop loss is here, your entry is here, but you will be in the move when you are right. If price wants to go higher, it will just tap in and goes higher. If your trade personality doesn't like to miss a move and you will get tilted fastly because of that, which is completely normal, I would suggest use the first strategy. The second strategy gives more risk to reward because you just wait longer. You can just put your entry here and your stop loss at the same place and you have a way higher risk to reward, but you can miss the move when price does not come back into discount. If you're okay with missing moves and you favor a higher risk to reward, I would recommend using strategy 2. Again, both work like a charm. It needs to fit your trade personality. And the third secret is don't just trade individual fair value gaps. Use other confluences too. Like a fair value gap is just a confluence on the market. If you just trade fair value gaps, you will be confused. Your trade idea should be based on multiple confluences. And confluences examples are liquidity sweeps, order blocks, market structure shifts, market maker models, supply and demand areas, support and resistance areas. Doesn't really matter, but there needs to be more than only a fair value gap in your trade idea before you take the trade. For example, in this trade idea, you see the fair value gap, right? But there's not only the fair value gap. There is premium and discount. So we come back to premium of the range. There is a liquidity sweep. There is a market structure shift. There's a breaker sitting here. So there's a lot of confluences supporting the fair value gap idea. So in this case, you don't just trade a fair value gap blindly, there are multiple confluences available in that same area, and that will make your trade idea way stronger. The rule of thumb is the more confluences that are present in a certain area, the more confluences you can motivate to back your idea with, the higher the probability of your trades. That also means you shouldn't wait for 20 different stars to align, because then your trade volume will be very low. But there needs to be a sweet spot. Most of my entries are with a liquidity sweep, market structure shift, fair value gaps, order blocks, and sometimes things like a inverted fair value gap inside the market maker model. But most of the time with 4 or 5 confluences, you already super high probability territory. And the fourth secret is use the second PD array rule. And let me show you what the second PD array rule means. So here we're looking at the NASDAQ at the New York Open, and we're just creating a fair value gap. Where? Right here, fair value gap. If we use the previous secret, where we need to also have multiple confluences, I see that before that we sweep a low, we take out a low right here, and we take out the last high that made the low, that's right here. So there's also a market structure shift. So there's a lot of confluences present in this area. The second PD rule is in case you are faked out a lot. And faked out means that you take the fair value gap, you take just the first fair value gap, and all the time, instead of it goes higher, it just trades lower, and that fair value gap didn't hold, and you take a lot of losses because of that. When I was starting trading fair value gaps years ago, I had this a lot. I took a fair value gap and it just didn't hold. And I was like, hey, how can I fix that exact problem? There is where the second PD array rule comes in. And what it means is you wait for the first PD array. A PD array is a fancy term for a fair value gap, an order block, a breaker, hold highs and lows. And what you wait for is price to come back to the first PD array, in this case, the fair value gap, and it moves away from it. So it gives the confirmation, this first fair value gap, that your trade idea is most likely correct. And you're most likely going to trade higher towards old highs or another obvious target. And you see that happening right here. So yes, this first fair value gap would have held. And yes, you could have had a better risk to reward. But if you care more about win rate, you just want to take more winning trades, you wait for what's now happening. Because of this down move into the first fair value gap, this down close candle trades to a fair value gap and now is traded higher in engulfing candles, big green candles. This becomes a bullish order block. So now, next to that, we have the fair value gap and the liquidity sweep. I call this fair value gap 1. We now have also a second PD array, the order block, stacking on top of this. So you can see this as different lines of defense. You have buyers and sellers, and here the buyers are in control. So next to that, this is a very nice defense for your trade. Now there's another layer of defense created by the second PD array. That is what you want. So then you can just take your entry at the second PD array, stop below the last low, 412. And inside that move, there's also another fair value gap created. So you have 2 areas here where price can move away from. So in this idea, liquidity sweep, market structure shift, fair value gap 1. We wait for fair value gap 2 because we want our win rate to be higher. And now let's see what price gives us. See, price comes back into the order block, taps in, and then it goes to the target. Now I see this another fair value gap here. So it came back to an overlapping fair value gap and order block right here before going to the target. If you trade the New York Open on NASDAQ or the other indices, this depiction you should screenshot right now, because this exact model presents itself so many times per week. So just copy this, wait for liquidity sweep, market structure shift, fair value gap 1 and 2, and you should be golden. I've dedicated videos with all my entry models here in this video, and this exact model will come back into these models as well. And the fifth secret is how you can use fair value gaps to battle FOMO trading. FOMO means that you miss a move and you feel very bad about it because your bias was good, but you are just not in. Fear of missing out. And I want to give you the FOMO protocol using fair value gaps. Here we're looking at NASDAQ at the New York Open, and we are bearish higher time frame. So we're trying to catch shorts at the New York Open. So let's fast forward to the open right here, and we try to find fair value gaps that we can use that trade back into. So we see fair value gap here, there are many fair value gaps created, but there's just no entry whatsoever. And we completely miss the move. This is what creates FOMO, because you will be sitting in the 1 minute here for minutes and minutes and minutes, and you just miss the move. And here's where the FOMO protocol comes in. Use this as your rule of thumb to completely eliminate FOMO out of your trading. When this happens, you're in the 1 minute, or you're at 5 minutes, or the 50 minutes. The time frame doesn't matter. You zoom out one time frame. So if you're at the 1 minute, go to the 5 minutes. If you're in the 5 minutes, go to the 50 minutes. If you're in the 50 minutes, go to the 1 hour. And what will happen is, because you missed the move on one time frame, it could create a fair value gap on a time frame above your position. So if we're here on the 1 minute time frame, if I now go back to the 5 minutes, what do I see here? I still see multiple fair value gaps right here, and here. But now we have more context. Like, hey, we can maybe just wait for price to come back to one of the fair value gaps and go lower. And remember, one of the secrets is if there are multiple fair value gaps, you have two options: price to come back to premium or discount of the range, or retake it in the first fair value gap. So we can literally apply that right now in this example. So let's see where there's a low created. Looks at now is a low created. Then we can do the last swing high and the last swing low. That's right here. And you see that the fair value gaps are already in premium of the range. So we should be good there if we want to trade from these fair value gaps. So then we can just say, okay, we're going to take the trade from here. If it comes back, stop loss above the last fair value gap here, and then target a 1 to 2. So where we felt a lot of FOMO on the 1 minute because we missed the initial move, zooming out one time frame fixes that. And then price comes back to the first fair value gap inside premium of the range and then goes to the profit target. But what if you trade on the 5 minute, not on the 1 minute, and you see this move and you completely miss it? You are not at 10:05 here when it happens on the charts, and you're like, no, I missed the whole move. You see price just going, and now it's just already market close, and you feel like you will never be in a trade again. Cool. Let's do the same, zooming out again. Let's say, for example, we go to the 1 hour time frame. Because in that same move where you have all these 5 minute fair value gaps, there's also a massive 1 hour fair value gap created, which is nice because this gives a trade idea that we want to trade from internal back to external, just continuing the down move. And then you just wait for price to come back there at the 1 hour and then just wait for price to move away from there. So if you miss the move, you just wait for the fair value gap that has been created to trade back into before continuing lower. And you can do that here again on the next day. So see how if you missed on the lower time frame, zoom out, FOMO protocol, zoom out a few time frames, and just get your entries on the fair value gaps above your entry time frame. And I can promise you, inside this price action on the 1 hour and then this candle on the 1 hour, you can find lower time frame entries as well. And now you know everything you need to know about fair value gaps, the biggest mistakes, the secrets. And if you got value out of this video, make sure to check out the video that's now appearing on the screen, because using this new knowledge about fair value gaps together with a very high win rate entry model will result in you getting funded and pay out faster. So make sure to check it out right now. Thanks for watching. Don't forget to subscribe, and I'll see you in the next one.
You think price moves randomly? It doesn't. Price is a delivery system. It moves from one specific level to the other, from premium to discount, from internal to external. If you don't know where price is going, you're just gambling and you are hoping for a move. You can know where price is going and predict massive daily expansions by understanding PD arrays. The frameworks I'm about to show you got me to over $1 million in funding and over 100K in payouts. And in this video, I'm going to show you exactly how to use these PD arrays to catch the big moves, by revealing the 3 PD arrays you actually need to make money and how to use them to predict your daily bias. No time to waste, let's get into the video. Let's kill the confusion first. PD array stands for premium and discount array. P is for premium, D is for discount. And you can draw premium and discount by drawing a line between the last swing high and the last swing low. That is called a range. So we have a swing high here, a swing low here, and the range is where we are in between. And it's similar if you're bullish and similar if you're bearish. Swing high, swing low, and the range is right here. If you have that swing high and swing low marked out, the midpoint is going to be the difference between premium and discount. Premium is the top 50% of the range. Price expensive and the smart money wants to sell here. Discount is when prices are cheap and the smart money wants to buy here. So usually you want to take long trades in discount of the range. And what you need to remember from premium and discount arrays is that we can only do 2 things. We are moving towards a PD array as a magnet, or we are trading away from a PD array. Most of the time, just go from discount to premium and back to discount. Your job isn't to guess the next candle. Your job is to identify the next magnet of price. And if we trade in discount and we react from it, where is the next magnet? It's probably going to be a premium array. And when you're going to look at PD arrays, you will find this exact depiction. It's called the PD array matrix. And personally, I think this is very overwhelming and you don't need this. But it's about having the dealing range. You already know what the dealing range is. It's from a swing high to a swing low, and you have the range in between. And the different PD arrays are all highs and lows, rejection blocks, order blocks, fair value gaps, liquidity voids, breakers, mitigation blocks on both the premium side and the discount side. Again, you don't need all of this to make money. Don't let anyone tell you you need to memorize these or to use them all. That's not true. This is all way too confusing and you only need 3 of those. If you're not careful, you're going to look like this, where you need to memorize all of this and all the nuances and take it all step by step. And that's what we're going to do right now. Starting with my favorite, the fair value gap. If you compare that when
when the first candle's high and the third candle's low do overlap, there's no fair value gap. You need to know the difference between the two. And of course, similar for a bearish fair value gap, also called a sell-side imbalance, buy-side inefficiency, a SIBI. The first candle's low does not overlap with the third candle's high. And the fair value gap is the most powerful magnet because price hates gaps. It wants to fill them. It's also called imbalances. Price wants to rebalance before continuing the move. So if you see a fair value gap above or below current price, price likely want to trace towards it. And this is how you can spot a fair value gap. It is a 3-candle pattern. When you see a massive candle, you see this one right here, and there is a high from the first candle and a low from the third candle. There is no overlap. So there is where the fair value gap is created right here. You see the price comes back into it and then moves away. Right here. There's another one here with a high of the first candle, low of the third candle, and it taps into it and moves away. And it creates an even bigger one right here, where it is here for a while, comes back to it, and then moves away. And you can keep doing this. If you're trending, you will see that fair value gaps will keep holding. From the 3 PD arrays, you need 1 fair value gaps and 2 is the order block. And if you know how to combine fair value gaps and order blocks, there's where I make all my money. It's so stupidly simple. So listen up. With a bullish order block, you first need to have sell-side liquidity. That is old lows. A bullish order block is a series of bearish candles that sweep the sell side liquidity before breaking structure to the upside. Your break of structure is when the last swing high before the down move is violated. That's happening right here. And when that happens, these 2 candles are the order block. So what you see is there's a liquidity sweep, then a break of structure, and then price wants to come back to the order block and then continue the move. If you look very closely here, a lot of times for your most high probability entries, there's an overlapping part between that order block and also a fair value gap. So then we already combine 2 of the 3 PD arrays together for a very nice entry. So don't think when you see this candle prints that it's gonna go higher without you. Price loves to come back to imbalances and to order blocks to then continue the move like this. If we look at that same example with the fair value gaps, you also see a series of down close candles before the move up. This down close candle is an order block. Mark at the start of the body. Then you see this candle trades into the fair value gap and then price moves away from it. So this candle also is the order block right here. And if you then go higher up in the range, we have a series of down close candles before we go higher. Again, bullish order block. And there's overlapping parts between a fair value gap and an order block. And you see how price comes back to it right here and then moves away. So now you know how to identify fair value gaps and also order blocks. And the third PD array you need to know is liquidity, swing points. If you hear liquidity, don't overcomplicate this. It's nothing more than old highs and old lows, where you need a swing high, and a swing high is a high with a lower high to the left and a lower high to the right. Why is a swing point, a swing high so important? Because there are stop orders, stop losses. So people go short here and put their stop orders below here because they think price will go lower. And same for swing lows. A swing low is a low with a higher low to the left, a higher low to the right. And there's stop losses, stop orders below these swing lows because people go long here with their stop loss below here because they think it's going to go higher. Price loves to get stop losses because there's liquidity there. And that's why we call it buy side liquidity. There's a swing high here and there's stop losses from short traders. And there's not only stop losses from short traders, but there's also breakout traders who want to go long here. So there's a lot of liquidity resting above this high. That's why it's called buy side liquidity. Same for below a swing low. You both had stop losses from long traders, but also traders who want to go short below this low. So there's sell side liquidity sitting here. So next time you hear the word liquidity, just think about old highs and lows. And the 3 most important liquidity pools are weekly highs and lows, daily highs and lows, and session highs and lows. And with session, I mean London session, the Asian session, and the New York session. Also referred to as kill zones. If you want to know more about kill zones, there's a dedicated video about that on this channel as well, together with liquidity. If you go back to the same example, but I'm talking about swing points, we have a swing low right here. There's sell side liquidity resting below here. And we sweep it before making that move, creating the fair value gap and the order block. So when you see this signature in price right here with the 3 PD arrays, with the liquidity sweep, with the fair value gap and the order block, there is where you can have a high probability reversal on your hand because this is already a very strong structure. And now we are at the 4 hour. If you look at this exact price action, but then on the lower time frame, you will find a similar structure appearing as well. So here we're not looking at the 4 hour, but on the 15-minute time frame, and price is fractal. So what happens on the higher time frame also happens on the lower time frame. So what do you see? There's a liquidity sweep, there's a swing low being taken out, then we displace, leaving a fair value gap. And there's also before series of down close candles that swept liquidity, and that's the order block. You see the price moves away from that, and then price displays again. What do you see? Fair value gaps. I also see a short-term liquidity sweep right here, swing low created before the move upwards again. And we keep doing this exact same thing over and over and over. So we briefly discussed fair value gaps, order blocks, and liquidity, but there are dedicated videos for this on this channel. So if you want to dive deeper into that, I will leave the link to that in the description and you can find them on this channel. And I'm sharing all my ideas and frameworks inside my Discord. Not only do I share all my insights together with weekly outlooks, there's a group of amazing smart traders who are just printing money. And you can find all my resources, frameworks, and everything you need to become a profitable trader. I'll leave the link to the Discord in the description, and yes, it's free, so join now. Now let's see these 3 PD arrays in action. Starting with liquidity, we're looking at NASDAQ here at the 50-minute time frames, and these concepts are fractal. That means they can be used on all the different time frames. You can use different time frames together. It's called time frame alignment. Please check out my time frame alignment video as well. So here during the Monday New York session, we sweep a alt low right here. That's a liquidity sweep. There's sell side liquidity taken. After that, there is series of up close candles, and inside these up close candles there is a fair value gap created. Zoom in on that right here, because between the first candle's high and the third candle's low there is a gap, and here price comes back here. See how clean price goes and then moves away. Another fair value gap right here. Looking at the time, if you trade NASDAQ around the New York Open, that means 9:30 a.m. EST. That's not here. We only at 8:30, so we're not there yet for an entry. But we need to use this. And also we have a series of down close candles that trade into a key level that is an order block. Also here, these series of down close candles can be marked out as an order block. And there is a fair value gap created between the first candle's high and the third candle's low. So for the open, here is where you can take potential trades, because 9:30 is coming. If we zoom out to the higher time frame, we have been pretty bullish for the past couple days, so I have a bullish bias. And then inside this 15-minute fair value gap and order block, I'm going to drop to the 1-minute time frame to find an entry around the New York Open using these 3 concepts. So we're now at the 1 minute and we are approaching the New York Open. It's now 9:28, and this is the 15-minute bullish fair value gap and order block. We're in a 1 minute and we have some short-term liquidity here. Let's see if we can run that. Going higher, and here at 9:30 exactly, we sweep that liquidity. Well, this is just liquidity. We need all 3. So we need a liquidity sweep, we need a fair value gap and an order block. After that, the next candle displaces over it, creating the order block right here. After that, we trade back to the order block 2 times and then starting moving away. What do we leave behind? A fair value gap right here. So here is the entry. So the 3 PD arrays you need: a liquidity sweep right here. We have an order block right here with this down close candle that sweep liquidity. And now we also have a fair value gap in this structure. This is a high probability trade. Take the trade in the fair value gap. Stop can be at the order block. So we already tested it. I'm not expecting it to come back before I wanted to. The price goes to TP very easily. You could even catch a 1 to 3 on this trade. All using 3 PD arrays only. So no mitigation blocks, no breakers, nothing. Just liquidity sweep, fair value gap, and order block right here. Okay, but what if we now fast forward to the next day? So this was the Monday we took this trade. What if we fast forward to Tuesday and we're going on the 4-hour to see if there is a key level? And a key level, I mean a fair value gap. So here I see a bullish fair value gap sitting right here. These are 2 key levels. So this is what I'm marking out on the chart. And then I'm going to do exactly the same. Gonna drop to the lower time frame, now to the 15 minutes. We see inside this level during the New York Open, do we get the exact same structure? And the structure is we trade into a key level, the 4-hour bullish fair value gap, and we have the 3 PD arrays. It is the liquidity sweep right here, and the break of structure with the order block, and a potential fair value gap. That's what we look for. We screenshot this because this is what we want to see at the New York Open. Now let's fast forward. And here's 9:15. So let's go to the 1 minute to see if we can find a similar setup, different day. So we're almost opening, and then we trade lower. So here we have a bullish bias, but this is not very bullish. At some point now, we are creating bullish structure. So we sweep some short-term liquidity right here into a key level, the 4-hour bullish fair value gap. And now we already create a fair value gap right here. I don't trust this yet. I want to see a little bit more. I want to see reaction from this. And we do get that here. So right now, there's not only a first fair value gap, but we have a series of down close candles that trade into a fair value gap. There's an order block sitting right here. And also a fair value gap created right here. So let's see if price comes back there and reacts from it higher. And we do. So when this happens, you already have enough to take a trade. Let's see the next candle. This is enough. So let's see you're late to the party and you're going to take your trade. In this trade, your position is defended by a 4-hour bullish fair value gap. That's the big box. Then a fair value gap, an order block, and another fair value gap. And of course, the liquidity sweep into a key level. Those are the 3 PD arrays you need. Stop below the last low, again for a 1 to 2. It'll be a bigger trade than the one on Monday. Aggressive sells, aggressive buys, fair value gaps, and order blocks. Only 3 PD arrays: liquidity sweep, order block, fair value gap. And only 40 minutes later, already TP, only based on the key levels using liquidity sweeps, fair value gaps, and order blocks. And yes, these are trades I took myself on both challenges and funded. And these exact trades added $300,000 to my collection of funded accounts. One more thing. You're probably overcomplicating this, but the market is very simple. It moves from old highs and old lows to imbalances, from external range liquidity to internal range liquidity, from premium to discount. It's all the same. If you can just identify the next PD array, you don't need to predict every candle. You just need to ride the bus to the next stop. And this way you can be a thief in the market, being in and out, and make your money very quickly. And if you want the exact checklist of PD arrays together with all my entry models and technicals I use to get over $1 million in funding, I put it all together in the Market Maker Blueprint. Link is in the description. And yes, it's free. And if you like this video, make sure you check out the video that's now appearing on the screen, because it will help you using these 3 PD arrays, because it will show you how to use time frame alignment, combining different time frames with these 3 PD arrays to filter out 90% of the false moves. So enjoy that one. Thanks for watching, and I see you in the next one. Bye-bye. Okay, listen up. You probably have been trading ICT for a while, but you just hit a wall. You wake up every single day, you think you know your buys, you know where the market is going, you know all the PD arrays, the fair value gaps, the order blocks, the breakers, but still you're losing every single day. And you just cannot get profitable. You have 4 things that tell you how to be bullish, 4 buys, you can frame both directions. Very annoying. And it makes sense. ICT did not make this easy. He created 100 PD arrays and you just need to navigate around all of these. I was at the exact same point over 3 years ago where my win rate was so low, I was losing every day. I was losing salaries in a day. But it was before I decided to take it in my own hands. And that's exactly what I'm going to do in this video. How do you simplify ICT? What are the concepts you actually need to focus on? Because there's a lot of background noise, right? Let's actually dive into simplifying ICT trading, increasing your win rates, and just rinsing prop firms. And really become consistent and hopefully down the line become a full-time trader. Without further ado, let's go ahead and look at the first concept that actually opened my eyes, simplifying ICT trading. And that's going to be the market maker model. You have 2 types of market maker models. You have market maker sell models and you have market maker buy models. And market maker models give you the direction of the market. So it starts with an original consolidation. We have the sell side of the curve where we're selling off. We see accumulation, expansion, relation, expansion. At some point in a key level, we reverse, smart money reversal, accumulate, expand, taking out the original high right there. It's called a market maker buy model, vice versa for a sell model. The price goes up, then does a smart money reversal and starts trading lower towards the lows right here. So I have a buy side of the curve, sell side of the curve. On the YouTube channel, I have a dedicated videos to understanding market maker models. I will leave the link to that inside the description, and also a little link to that right here. And the 2 concepts I'm discussing today, where one of them is the market maker model, has such a high win rate because it simplifies so many of the ICT concepts. It doesn't matter if you're trading for value gaps, order blocks, breakers, doesn't really matter because all those concepts come back into these models. So what you'll see inside a market maker model is that we are on the sell side of the curve right here, and you will see price accumulating, then expanding, accumulating, expanding, accumulating, expanding. Same here on the buy side of the curve. But what you will see before it expands, you see a little manipulation. If you know the Judas swing, the ICT power of 3, the AMD, you accumulate, manipulate, distribute. We accumulate, then manipulate, distribute. Then we accumulate, manipulate, distribute. And before the distribution, many times you have a little accumulation here as well. Accumulation, manipulation, distribution. And that's the second concept. To really simplify ICT trading, you need to combine the market maker model with the AMD. So when price starts a sell model, for example here, most amateur traders just try to catch the move here and hopefully make some money by shorting this move. But they'll get stopped out because of the manipulation. If you want a high win rate, you need to wait out that manipulation. So you see displacement, you just wait for price to come back into fair value gaps to then start a distribution of a move. And you can use market maker models on all time frames using time frame alignment. If you have a weekly level, trade a 4-hour market maker model. If you have a 1-hour level, trade a 5-minute market maker model. So what I mean by that is, let's say we are here in a 1-hour structure. If we zoom into this move right here, this is a market maker model of itself, but then on the 5 minutes. So this on the 1 hour, if you now go back to the 5 minutes, you will see this happening. You will see a little mini market maker sell model. So combining the accumulation, manipulation, then distribution, like your accumulation, manipulation, distribution, that will give you the buys every single day. But the question is, how can you combine these two? There's one part of glue you need to have to put these one together, and it is called time. If you combine time with market maker models and the power of three, you are golden, and you will see the market through a completely different lens. Let me show you. You will start to see market maker models everywhere. Here, accumulation, expanding, accumulating, manipulation, distribution, smart money reversal, accumulation, manipulation, distribution, accumulation, manipulation, distribution. You're going to see this everywhere in your charts on all the time frames. So you can use this for both your bias, but also for your entries. So in this example as well, if you're at the 1 hour right here, then when price comes back into that 1 hour value gap, then is when you drop to the 5 minute to find a mini market maker sell model. You wait for price to accumulate, manipulate, and then distribute on the 5 minutes. Same here, this little wick right here is during the New York Open. This on a lower time frame will look exactly like this, and there's where you can find your entries. So what if you now combine time together with the AMD and a market maker model? So right here, we have a sell side of the curve, accumulation, distribution, 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 leaving all these low resistant liquidity. Low resistant liquidity are swing highs that don't take out any other swing highs. After we sweep liquidity, what liquidity is swept here? It's a weekly low has been swept here. So there is a key level that has been violated, and we see some massive reaction from this. And if you look at the time, it's now 9:30, New York Open. And every day at 10 a.m., there's a new 4-hour candle opening. So my exact model, I'm using market maker models together with the AMD, accumulation, manipulation. That is right here. And now I'm anticipating a lower time frame market maker model to form. Anticipating price to aggressive sells, aggressive buys, and then start trading upwards towards at least these highs. And I'm using that by predicting the next 4-hour candle to where on the higher time frame, we see a liquidity sweep in a key level. Here's where we expect a reversal. So we're expecting here a mini market maker model to form. On the lower time frame, we want to see accumulation, manipulation, distribution right here, and then start the market maker model. You then drop to the lower time frame, you see accumulation, manipulation, and the distribution is starting. So when that's starting, look for where is the lowest liquidity, where are we most likely headed. I would say the swing highs right here. Relative equal highs is also compared with session liquidity, Asia high. That could be our draw on liquidity for this specific trade. And now combining time with this every day at 10 a.m., there's a new candle opening, a new 4-hour candle. And based on this expansion, I'm expecting the next 4-hour candle to be a bullish candle. And if you understand the autonomy of a candle, we open, then we trade lower, manipulating, setting the low of the candle, and then start trading higher towards the high of the candle, and then close. If you do that at the 4-hour, I like to place at 10 a.m. every day. You can also place at 10 p.m. for Asian session and 2 p.m. for the PM session. I'm waiting for price to open. That's going to be here at 10 to trade lower and then start distribution higher. So from that perspective, let's drop even lower to see how we can find the entry. So the new 4-hour candle just started. I'm just waiting for price to trade lower and then start creating buy structure. Here's the bearish for value gaps. And then here we start trading higher. So we see an inversion for value gap sitting here. We have bullish for value gap right there. Entry, TP at the highs, 412. Your price is now allowed to trade even into this bottom per value gap. And then you can just let price do its thing. So we have an accumulation. I'm anticipating this to be the manipulation, setting the low of the candle. And then we are supposed to start trading higher. We see there's another bullish for value gap created here with an order block. And price trades to the drawn liquidity. So here at the bottom, we see accumulation, manipulating, distribution. If we zoom out, we see the start of a market maker model being formed with the sell side of the curve right here. And now the buy side of the curve is starting. We're actually looking at the live chart right now, so I cannot show you this, but in the next couple of days and weeks, I'm going to trade this to the highs. Just like, for example, a couple of weeks ago, where we saw the exact same thing happening. It's where we take out liquidity here, aggressive sells, aggressive buys, starting from the sell side of the curve. Right here, starting the buy side of the curve. And here in these moves, you can drop to the lower time frame to find your entries. Also right here in this for value gap, lower time frame, find your entries. So find mini market maker models inside the bigger market maker models to have your bias correctly, and then use the power of three. They use time to find high probability entries. And the one I show you here is exactly one I took this week. So it's not in hindsight, it's actually taken in real time. And I'm going to hunt this exact same model the next week and the week after. It's called a 10 a.m. game. So every day at 10 a.m. we look for this power of three, the AMD, where we wait for price to open, manipulate lower, expand higher. If we are bearish, we play it vice versa. Wait for price to open, then trade higher, and then start the sell model. But this buys on lower time frame is only high probability if you understand that higher time frame picture with the market maker models, with the power of three, and then combine the 10 a.m. game to rinse prop firms and skyrocket your win rate. I created a 10 a.m. game cheat sheet with all the entry criteria that I use every single morning when I trade. I'll leave the link to that inside the description. So simplifying ICT concepts with market maker models, the AMD together with the 10 a.m. game is all you need to start making money. If you want to dive deeper into market maker models,
I'll leave the dedicated videos to market maker models somewhere around this video and definitely also in the description. So make sure after this video, you dive to the market maker models to fully master that. On this channel, there's also a video about the 10 game. I'll leave that step-by-step plan in description so you can keep learning, keep growing, and start getting payouts.
This is the market maker model, and it's the only signature in price you need. It has many different names: the V-shaped recovery, the smart money reversal, the head and shoulders. And it does not matter if you trade ICT, supply and demand, or support and resistance. All that matters if it gives you the exact bias and signal for when the market is going to reverse. In this video, I will show you how to identify a drawn liquidity, how to use market maker models to create a daily bias towards that drawn liquidity, and how to combine different time frames to create those sniper entries so you can get funded and get payouts. No time to waste, let's get into the video. Before we dive into the model, you need to understand that price only does two things. If you're confused about your bias, it's because you don't know where you are in this exact cycle. The only two things price can do is grab external liquidity, also called external range liquidity, and rebalance. That means go to an imbalance to internal range liquidity. And the golden rule here is price only trades from internal range liquidity to external range liquidity, or from external range liquidity to internal range liquidity. Let me show you what I mean with these two. External range liquidity is a fancy term for old highs and lows. So the first thing price can do is grab external range liquidity, simply going back to an old high or low. What you'll see in a classic buy structure is that we have higher highs and higher lows. And at some point we leave an old high behind and we start retracing. Where do we retrace back into? Internal range liquidity. Internal range liquidity means a fair value gap or an order block. In price, you will see that it goes from internal range liquidity back to external range liquidity. That's the first thing price does, goes to an old high or low. The second thing price can do is rebalance, and price can rebalance to two areas. One is equilibrium of the range. Equilibrium of the range means the 50%. And if you take the most recent high and the most recent low, that is the range. You go from swing high to swing low, and the 50% of that is called equilibrium. The price goes back from an old high, it trades back to equilibrium of the range. Second thing it can do is go back to an imbalance, a fair value gap. It also can be an order block. It goes back from external range liquidity, an old high, back to internal range liquidity, a fair value gap. That is the only two things price will do, or go from internal to external, or go from external to internal. In other words, it trades from a fair value gap to an old high or low, or it trades from a higher low back into a fair value gap. And all your trades must have one of these two IDs in it. If you are on the 1 minute or the 5 minute on a lower time frame execution, and you don't know from the higher time frame if you go from internal to external or vice versa, you are trading blind. So you need to have one of these two cycles in every single trade you take.
And I know how overwhelming trading can be. That's why I created the ICT Bible. It's a 500-page PDF where I go from A to Z to all the concepts you can learn about trading. I spent hundreds of hours on this document, and this document will save you thousands of hours of ICT videos and studying. It's all for free, and I will leave the link to this inside the description. If you want to skip those thousands of hours of studying, make sure you check it out right now. Back to the video.
And now you know about internal and external range liquidity. How can you frame trades around this? We need to find the highest probability trades. The highest probability trades mean that when you see your setup, that is the most likelihood that trade you take is going to be a winning trade. We want to have as many high probability trades as possible compared to low probability trades where we should not take them because we're most likely going to lose them. And the highest probability trades are with the higher time frame order flow and trend. And the higher time frame is the daily, the weekly, and the monthly. And what you want to see is higher time frame trending conditions. So when we make higher highs, higher lows on the higher time frame, we will go from internal to external, from internal to external, from internal to external. Basically from a higher time frame fair value gap or order block back to an old high. Same if you're bearish, we want to go from a bearish fair value gap, internal range liquidity back to an old low, fair value gap back to an old low. Keep doing that. If you know high probability conditions, you also need to be able to identify low probability conditions. And there is where the higher time frame is trending. Those are the lowest probability trades, higher time frame consolidations. And why they are lower probability? In consolidations, internal and external range liquidity, that means imbalances, fair value gaps, and old highs and lows are less likely to hold. So when you see a higher time frame consolidation, it doesn't really matter what you see on the 1 and the 5 minutes because it becomes low probability. If you see trending conditions on the higher time frame, for example, a long in this example, and then on the 1 and the 5 minutes, you also see very clean longs, then you're your time frames are aligned and it's very high probability. If the higher time frame is consolidating like this, and the 1 minute gives a very clean long or short entry, it becomes lower probability because this is what is behind your trade idea on the higher time frame. What you'll see is that we have an old low, and then we trade higher, creating an imbalance. So ideally, we want to trade from internal to external in trending conditions. But it fails because we go back to the old low, then we go back to the old high, back to the old low, creating a bearish fair value gap. We want to trade from internal back to external. We don't do that. And you will see that they just start failing. If you look, for example, here at gold on the daily time frame, you will see this exact thing happening. Before, in trending conditions, there was a very clear internal to external. So we have trending conditions. This was the external range liquidity up here, and we just had very easy trades towards that. There's a daily fair value gap here, and even inside here. Here we have a fair value gap, and we have an old high. We trade up internal to external. Then after that was a trade I took on a swing account. An old high sitting here. Let's make it a little bigger. Old high sitting here. We go from internal on the fair value gap back into external. Internal to external. Internal to external. Zooming out a bit. What do we have here? There is equal highs sitting here, and there is a fair value gap. And it's on the daily time frame. We can do the same on the lower time frame. We go from internal to external. It becomes fun because what do we have here? A fair value gap. We trade back into it. What's the most recent high? Right here. We go from internal to external. That is what you want to see. Trending conditions. That's the highest probability trade. And I made a lot of money inside this move. If you compare this now to the current price action on gold, and that's why I said to my students and also on socials, guys, maybe leave gold alone for a while. Higher time frame consolidation. And what you will see inside a higher time frame consolidation, and we're looking at a live chart right now. If you zoom in on that, so for example, you go from the daily to the 1 hour, your premium and discount arrays will not hold. So imagine you see this on the 1 hour right here, and you try to go to the 5 minute to find your intraday entries. It's just not going to work. Like, it's very low probability price action. So every time you take a trade on a lower time frame, make sure there's a higher time frame story behind it. We go from internal to external or vice versa on the higher time frame, and it's supported by some form of higher time frame idea. You will notice if you start doing that, one, the majority of the trades you might take are not valid anymore because it looks very sexy on the lower time frame, but it's very ugly on the higher time frame. And because of that, you take less low probability trades, meaning you take more high probability trades, and you just make more money. And you want to be reinforced, you want to be rewarded for good behavior on the charts. Start with this. It's a very easy fix to increase your win rate. And it's the exact same story on euro dollar. This is on the daily time frame. There's daily consolidation. Look at these daily candles, very small doji candles. So inside this, that's why you need to go to the higher time frame. If you want to trade inside here, inside this higher time frame, you could now go to the 5 or the 15 minutes for your entries. Like for example, right here, this looks very sexy. This looks like a very nice buy structure. And then we trade higher, right? Wrong. We just trade lower. This signature price looks like a nice reverse to the upside, and it doesn't happen. Why? Because there's a higher time frame story telling you to stay away. And that's fine. So then you know what to remove from your trading to get better results. That's awesome. And if you then go back to the highest probability trades, you're like, yeah, nice daily, weekly, monthly, the higher time frame. But how can I trade on the lower time frame using this concept? There is where market maker models come in. So in those V-shaped moves right here, there is where you go to the lower time frame. So look for market maker models inside the internal to external range move. And the V move on the higher time frame is a market maker model on the time frame below. Let me show you what that means. This is the market maker model. We're going to dive deep into this exact schematic. But what I want you to remember is that inside every V right here on the higher time frame, you can spot this on the lower time frame. The rule here is a higher time frame internal to external. There's that V shape here is a market maker model. What exact is a market maker model? Market maker model has two different stages. It has the sell side of the curve. It's when we are selling off, obviously, and it has the buy side of the curve when it's going up. And this is an example of a market maker buy model. So we will go up. First we'll go lower, then we'll go higher, and we reverse at some point. And what you will always see in a market maker model, the starting point is a original consolidation. After that original consolidation, you will see price selling off into a key level. And the key level most of the time is a higher time frame for value gap, order block, breaker, just a PD array. If you trade support and resistance or supply and demand, it can be a demand area, support area. You get the point. Into a key area where you expect on the higher time frame price to reverse from, to react from. And price will sell off most of the time in 2 or 3 stages. Just very quick, rebalance, go, until you reach that key level. And what it will leave behind is low resistance liquidity. And low resistance liquidity means liquidity that do not take out other liquidity. So for example, this high does not take out this high. So once we come back here, this low resistance liquidity, it'll be very easy for price to just trade through them, completely ignoring it. So you will see very clean, aggressive moves when we come back here in these areas. So we have the sell side of the curve, we trade to a key level, old low, bullish value gap, order block breaker. There is where we're gonna see something called the smart money reversal. And this exact schematic every day on my live stream with my students and also on the YouTube streams, this is where I look for every single day on NASDAQ, on gold, on the Forex pairs, everything I like to trade. Aggressive sells, aggressive buys in a key level. That's the schematic every single day. And that's called a smart money reversal, V-shaped recovery. That's the key in the market making model because that indicates the reversal. And what you notice is there will be a market structure shift with aggressive sells, aggressive buys into the key level. Market structure shifts in this move called a low risk buy. You will see for example, a fair value gap or an order block or an inversion fair value gap, like the PD arrays, and it can also be supply and demand areas or support and resistance areas. In this aggressive move, the V-shaped recovery, that already indicates we're probably making the reversal. And it will go from the sell side of the curve to the buy side of the curve. And also the up move, just like the sell move goes in a few stages, also the up move will not go up in one go. If you struggle with FOMO, know that the majority of the moves will not be in one go. It will be like this. It will give you 1, 2, or 3 entries to go up to the draw on liquidity. These are called a low risk buy, accumulation, and a reaccumulation. Those are fancy terms. Just remember that in a up move, in a market maker buy model, you will have more than one opportunity to get into the move, to trade back into the buy side liquidity, the draw on liquidity. And before we dive deeper into how we can use the market maker models to get actual entries, we need to dive deeper into the concepts around the smart money reversal. Those are the market structure shifts and the SMT. The SMT is a crack in correlation. There's 2 correlated pairs, and correlated pairs are, for example, NASDAQ and ES, or euro dollar and GBP US dollar, gold and silver, Bitcoin and Ethereum. And correlated means if one goes lower, the other one goes lower. If one goes higher, the other one goes higher. But what will happen with an SMT is there's a crack in that correlation. So one of them does not go lower, and it indicates a potential reversal. So if we trade back into an old low, for example, and NASDAQ makes a lower low, but ES does not make a lower low, there's a crack in correlation because ideally they both need to go lower, and it doesn't happen. And what this indicates is that we might want to reverse. You, of course, want to see this in combination with the aggressive sells, aggressive buys, also with a market structure shift. The market structure shift, very simple, is when the last swing high that made the low is violated. So if you can draw a line here, that's the last swing high that made the low. When price trades through that right here and closes above it, there we call it a market structure shift. So when you have an SMT and a market structure shift, you see the aggressive sells, aggressive buys, you know, hey, we are in a key level, we might start the reversal. And that is why a clean reversal most of the time revolves with an SMT and a market structure shift before we start the buy side of the curve, where we're gonna start discount array hunting. And with the discount array hunting, I mean, is in these areas where we're gonna find our entries, there is where we're gonna look for the fair value gaps, the lower time frame structure, to trade towards the buy side, to trade back into the original consolidation, the old high. And here is where it gets fun, because a market maker model is fractal. And what that means is what happens on one time frame also happens on the other time frames. So this is the depiction we just discussed. And inside all of these blue areas, those are also fees. So inside of areas, there are mini market maker models appearing as well. So when this original move is a market maker model, for example, a daily fair value gap to a daily high, inside that market maker model, we're going to look for lower time frame market maker models inside the market maker model. Market maker modelception, fractal. And there is where different time frames come in. I have dedicated videos on time frame alignment here on this channel. In regards to market maker models, the only thing you need to remember is this, is that if you are a swing trader and you look for a monthly internal to external, use daily market maker model. Your weekly, look for a 4-hour market maker model. If you go from daily internal to external, look for a 1-hour market maker model. And if you're a swing trader, there's where you stop. You don't need to go lower. I know most of you watching are more day traders or scalpers, especially like the NASDAQ and the 1 and 5 minutes. There is where we need to dive a little bit deeper. So if you see a 4-hour internal to external, go to the 50 minutes to find your market maker models. If you're trading a 1-hour internal to external, look for 5-minute market maker models. Or 50-minute internal to external, wait for 1-minute market maker models. So one of my favorite entry models, the 10 AM game, is a scalping model where I execute under 1 minute. The time frames, I use a 4-hour internal to external, the 4-hour. I use a 50-minute market maker model for this. So I use this one. But what I also use inside that 15-minute market maker model, so this is the 15 minutes, I use these ones, the lower time frame ones, on the 1 minute. So inside the bigger 50-minute market maker model, I wait for on the 1 minute, mini in these blue areas, look for 1-minute market maker models. Market maker model, you know the depiction. This is a lot of information. Just remember this depiction. We trade lower into a key area. We have aggressive sells, aggressive buys. Then we start trading higher. This needs to be at a key level. Needs to be a market structure shift, ideally an SMT, and look for PD arrays like a fair value value gap, order block, supply and demand areas. Just look for areas that can hold price to trade higher. And this always vice versa for bearish structure. If you go from internal to external, lower. And the fun part about these educational videos is that the majority of the viewers stop watching the second they need to put in some work. So next up, we're going to look at examples how to use these exact frameworks in the charts. And at the same time, after this video, you cannot just watch this, magically remember it, and start making money. You need to go to the chart yourself and build some case studies. That means go to the chart, see if you can recognize these market maker models, and see if you could, in hindsight, would have taken certain entries yourself as well. You can just screenshot them like a journal entry and build case studies. And with those case studies, you train your eyes to see this in the chart before it happens. And I'm going to help you build those first case studies right now on the chart. Let's go. If you look at this example on gold, there is on the daily time frame here, there's a old high sitting up here, and there's a daily bullish fair value gap. We expect on the daily time frame to go from internal to external. That's the bias we have from the higher time frame. Internal range liquidity, old fair value gap to an old high. With that idea, let's drop to the lower time frame to see if we can spot a market maker model. Going from the 1 hour, let's see what we do once we trade into the key level. This is the daily bullish fair value gap. We're now in the 1 hour, and here is where we trade into the key level right here. Do we see a smart money reversal? So if we now expect a market maker model to form, it is very nice that we have some failure swings. We have a clear draw on liquidity, and all we need to wait for is with this failure swings is an aggressive sells, aggressive buys. So we already have a liquidity sweep here. Let's see if we can see some aggressive buys. We need to see big green candles coming in. We just wait for that. If you're not on the chart, you just need to wait for this to happen. Cool. Awesome. Zoom in a little bit on this. We have some green candles. If you see this move, you already think I missed the move. But that's the power of the market maker model. Now you know you don't. Price rarely goes up or down in one move. So there's a 1 hour bullish fair value gap sitting here. So from that point, you have another internal to external on the 1 hour. Internal 1 hour to external. So we can even play inside this if you are not a person who trades on the 1 hour. You can go to the 5 minute now to see if you can find an entry from a 1 hour internal to external with 5 minute market maker model. Inside this 1 hour market maker model. That's why the market maker model is fractal. So the green line here is the 1 hour high, and here's the 1 hour bullish fair value gap. So let's see if we create a market maker model inside here. Zooming in here, we trade into the 1 hour bullish fair value gap. There's a risk consolidation. There's a mini market maker model here. We have the aggressive sells, aggressive buys. We see a fair value gap. There's another one right here. Let's see if we can trade back into that. We don't, and we just push higher. We then zoom out back from the 1 hour. We see how clean we moved away from. We are in a daily internal to external. So draw liquidity on the daily is very clear, and using it on the 1 hour and the 5 minute now. There's another fair value gap sitting right here on the another 1 hour. See if we can use that to trade to the drawn liquidity. And here you see the delivery is less clean. It takes a while. It takes a few days here. So here inside this day on the lower time frame, you most likely did not find an entry because there's no clean displacement like this candle, for example, from this 1 hour fair value gap. What we do have is an order block sitting here, which is being respected by all the candles. But that's nice. So from this point, we can just drop back from the 1 hour to the 5 minutes to see if we can find the entry. There's a big consolidation, so there's nothing going on here. So let's see if we can find an entry later. We expect price to go from 1 hour bullish fair value gap and order block towards the high here in the 5 minutes. What do we see here? Signature in price. There's a liquidity sweep. There's a market structure shift, leaving a fair value gap. There's where you could take your entry. Mini fair value gap or 1 to 2. And price delivers to that. Here on the 5 minute, all based, zoom out back to the 1 hour, all based on that daily internal to external and the 1 hour market maker model. And we're not done yet because the actual target on the daily was here. So we're not done yet. We can still try to take more trades. Because price comes back and then goes. I'm not going to bore you with 5 or 6 examples inside this price action, but this is how you can spot how fractal price is. We go from internal to external on the daily. Inside that on the 1 hour, we can find multiple 1 hour setups. And inside that on the 1, 5 or 50 minutes, you can find your intraday entries as well. And now zoom out back to the daily. All we did was trading these 4 daily candles, all looking for longs until we reach that old daily high. Here we're looking at NASDAQ at the 15-minute time frame. And let's train your eyes on the market maker model. Here up top here we have a original consolidation. Why is original consolidation? Because it consolidates. Not rocket science. So we're going to mark this out as an original consolidation. That is going to be the draw on liquidity once price starts making the smart money reversal. And here we made this sell side of the curve. So we have a fair value gap here. We trade lower, order block, trade lower and lower and lower. At some point, we stop trading lower and we see some reaction from it. We see aggressive sells, aggressive buys. And what I want to see in a smart money reversal, for example, is this is a bearish fair value gap. and it's ignored. We trade over it. It doesn't react from it. It's interesting. So this becomes an inversion fair value gap. And at the same time, there are bullish fair value gaps created. One here, also one here. The only part between a fair value gap and an inversion fair value gap is called a balanced price range. Very nice area to trade from. DPR, also an order block here. So there's a lot of PD arrays for a smart money reversal. Aggressive sells, aggressive buys. And let's see if we move away from here. We trade into this fair value gap and then we start moving away from it. That is interesting. Very interesting signature in price. So here is in this market maker model is where you already can take your entry right here. If you want to execute on a 50-minute, you can do it here. You can put your TP at the original consolidation, a high here. You want a 1 to 3, you should be good like this. This will be the first trade idea from a market maker model. This is on the 15-minute. And also we look at the time. This is during London. NASDAQ moved during New York. So probably later this day we can get a better entry. But this is already a first idea you can trade from this entry because you just expect a market maker model to form. We have an original consolidation. We create failure swings during this move. You remember the low resistance liquidity. Those are highs that do not take out other highs. So once we trade higher, this is going to be very easy. We're going to just pierce straight through. Then you fast forward a bit closer to the New York session. You will see that we already started moving. We're now approaching the New York session. So here at the New York Open at 9:30, you will see that we sweep liquidity down here and then start trading higher. So the second trade idea could already be right here. Same TP, stop below the low or 1 to 2. And then fast forward, price completes the market maker model. Two very clean trade ideas from a 15-minute market maker model. Inside this 15-minute market maker model, you can go to a lower time frame to find more entries around this. But this is how you can see this depiction. If you anticipate this to happen every time we hit a key level, you train your eyes, you see the original consolidation, you see the sell side of the curve into a key level. We made the smart money reversal with all the PD arrays. You start taking entries here, and you just trade towards the draw on liquidity. Trading doesn't have to be hard. You just need to know where to look for. If you stop chasing random candles and start waiting for the higher time frame to give you the draw on liquidity using internal and external range liquidity, then wait for market maker models to navigate you on a lower time frame, and then use high and low resistance liquidity to take your entries. You will see your consistency change overnight. And if you got value from this video, make sure to check out the video that is now appearing on the screen. This video will help you using market maker models together with high and low resistance liquidity. So you can use market maker models to get even more cleaner and precise entries. Let me know in the comments below what was your biggest takeaway, and don't forget to subscribe because I post one of these videos every single week. Thanks for watching, and I'll see you in the next one. Bye-bye.
I spent 3 years getting wigged out by random volatility. I would enter a trade, get wigged out by 1 pip, and then watch the market run exactly as I predicted. The truth is, these wicks aren't just noise. They are hidden hints. Physical evidence of price wanting to go a certain direction. And because I ignored them, I was the liquidity. In this video, I'm going to show you exactly how to use wicks to catch reversals. And the 50% rule I use to catch sniper entries that 90% of traders miss. I use this exact framework to gain over $1 million in funding and over 100K in payouts. I'm pretty confident it will work for you too. Let's get into it. What most of you don't understand is that behind a wick, there's a hidden story most of you are missing. And this is the physics of a wick. Most of you just see a line on the chart, but here is that hidden story. Price is fractal. That means a wick on the higher time frame is actually a trend on the lower time frame. Let's look at a candle with a longer, lower wick. What actually happened here? Price opened, sellers stepped in and pushed price down aggressively. Buyers stepped in, absorbed the selling and pushed price all the way back up. And then price closed. But the wick at that bottom, that is where buyers and sellers are fighting. This is where sellers try to kill the trend and they failed. And that wick represents trapped sellers. They are underwater and losing positions. So when price comes back to that wick, those sellers are praying to get out break even. Buyers are waiting to defend that territory back up. And this is why you shouldn't treat wicks just like an empty space. You should treat them like hidden order blocks. But we don't just buy blindly. We need a rule. And that rule is called the 50% rule. Or in ICT's term, consequent encroachment or equilibrium of that wick. I try to keep things simple, so I just call it a 50% of the wick. But it's all different names for exactly the same beast. It's the midpoint, the 50% of a wick. Here's the protocol. Write this down. We measure the wick from the body to the end, and we mark out the 50% line. And now we have a binary scenario. The market can only do 2 things. The first thing it can do, scenario A, is respect it. That means if price trades down into the wick, but the body of the next candle closes above the 50% line, that means the defense is holding. The buyers are strong, the reversal is valid, and this is where we can look for lower time frame entries to go long. The second thing that can happen in this binary scenario is that it doesn't get respected. And this is what nobody talks about. It's like, what happens if the wick fails and it isn't respected? If price trades into the wick and the body closes below the 50% line, it means the defense has failed and the sellers are stronger and that wick is no longer support. It is now a magnet. The market will likely want to fill the entire wick and go lower to the low of the wick. And this is where the monkey brain gets challenged, because you see price in that wick and you're like, it's probably support. Let's just buy blindly. If you really want a high win rate using this, don't do that. You wait for evidence. So that means in this buy scenario, above the 50% means you buy, below the 50% means you can look for sells or just step aside. And inside this higher time frame wick, you will find lower time frame structure. You will also see this in the examples we're going to discuss after this. We are not predicting. We are reacting to the data. We wait for the actual candles to be printed. Wicks are either barriers or they are bridges. And that 50% line tells you which one it is. Perfect. So I just gave you the secret sauce. And now you can just take it and trade profitably, right? Not even close. On this YouTube channel, I only focus on the 10% of trading, the technicals, which is what you guys want to hear. And knowing technicals is kind of like having a really cool car, but your wheels are missing and it's driven by a 7-year-old. The chances of you getting anywhere is approximately 0. And that is what I teach my students in my Inner Circle program. If you want to check it out, it's the first link in the description. Here in this first example, we're looking at ES at the 4-hour chart. And this massive wick was created after we sweep some liquidity right here. So using this framework, this wick, mark out the body to the top, 50%. And for the next candle, we want to play an open, high, low, close, where price is respecting the 50% of the wick. There's also a 4-hour bullish fair value gap sitting here. So all in all, we have a bearish bias towards this area. If we then drop to the lower time frame, for this next candle, we want price to open and not create structure above here. We want it to stay below in the bottom 50%. Price opens and we trade immediately towards it. Price comes back here inside this area, but it respects the 50% and then trades lower. In this next example, we're looking at the NASDAQ at the daily chart. And this Thursday candle made a wick. And for the next trade, we look for, do we respect the 50% of the wick? If you want this on your chart, you can go to the top left here, choose Fibonacci retracement, and then inside settings, you can just copy this where you have the 0, 0.5, and the 1 and the colors attached to it. We drop from the daily to the 1 hour. We wait for price to open on the next day. That's right here. And wait for the New York session. Why the New York session is there's where the NASDAQ moves, just like ES and YM. And we see a bullish 1 hour fair value gap. And the goal is for this day is to play an open, high, low, close where the 50% of the wick of the daily is respected. And the question, do we do that? We trade into it right here, but the body is respecting here at 10. And it's interesting. And now we can even drop to the lower time frame to play the exact same game, but then from a 1 hour wick, let's go to the 5 minutes. So here for the next candle, we want price to play an open, high, low, close where we respect the 50% of the wick. And obviously we do that. Why do we do that? Because on a lower time frame structure inside that wick, we already had aggressive sells, aggressive buys with multiple fair value gaps. Fair value gap 1 here, fair value gap 2 here. Also an order block with a breaker. So here was already where you could take your entry here at 10 and 40 with your stop loss below this fair value gap 412, and you could have TP very quickly right here. And that was all based, if you go back to the daily, all looking at how the 50% of the wick is respected. Once we see the rejected here on the 1 hour, which we did right here, we traded into the 50% of the daily wick and then rejected here at 10 during the New York Open. And then you can take a trade using that bias and that logic. In this next example, we're looking at YM at the 1 hour chart, and we just created a massive wick right here from the body to the bottom. 50% we want this to be respected. This wick not only swept liquidity right here, also traded back into a 1 hour bullish fair value gap. So for the next candle, we want the 50% as our key level to see if that's respected. And we create structure from it from an open, low, high, close perspective. We want to trade continuation. Let's drop from the 1 hour to the 5 minutes to find the structure. Here we see that same wick in action, and inside the structure of that wick, I see a massive down close candle that swept the liquidity. That is a order block. Overlapping with that order block is a fair value gap. So this is a area where you could take an entry. Is there clear drawn liquidity? Yes. There are failure swings up here. You can just pick the first swing high right here as a target. You can also pick the other highs for a 1 to 2, where your stop is even covering that 50% of the wick. And the price comes back here, all based on the 1 hour wick, where we zoom in inside that wick on a lower time frame structure where inside this lower time frame wick, we saw this exact structure forming for the entry. And this is the exact trade I took to get a 5K payout from one single trade. This is everything I had to share with you for today. If you want the exact technicals and entry models I used to get over $1 million in funding and over $100,000 in payouts, make sure you get the market maker blueprint where I explain everything in detail. It is free and link is inside the description. And if you got value out of this video, make sure you check out this video that is now appearing on the screen. It shows you step by steps on how to combine wicks with time frame alignment so you can filter out 90% of losing trades. So make sure you check it out right now. Thank you for watching, and I'll see you in the next one. Bye-bye.
Is there really an algorithm? And even if there was, the only thing you need to know to make money is if price is more likely going to go up or down. The truth is, the algo does not matter because all you need is order flow, in what direction price is going. Understanding order flow played a massive role in becoming a full-time trader, living all over the world and currently pulling up 5-figure months while living in Vietnam. In this video, I'll show you step by step how to read order flow to create a daily bias and how to use that to execute on a lower time frame. So you can just copy this to become funded and get payouts. No time to waste, let's get into the video. The first thing you need to know about order flow is very simple. Are we bullish or are we bearish? Order flow is a fancy term used by gurus to just identify bullish or bearishness. For most intraday traders and scalpers, the entry time frame will be on the 1 minute, the 5 minute, or the 15 minute. It means for the highest probability trades, your entry should align with the current structure. During this bullish structure, you want to take as many longs as you can. And if you are bearish, you want to take as many shorts as you can. And you can identify market structure very simply. In a bullish structure, you will have a high, a low, a higher low, and we'll just keep making higher highs and higher lows to the upside. In a bearish structure, a high, a low, then we have a lower high, a lower low, lower high, and we keep trading lower. Only thing you need to understand about structure. Bearish structure you can identify by making lower highs and lower lows. Once we hit a key level, we need to be able to identify a shift in structure. And what that means is that price goes from bearish to bullish. And a valid market structure shift had only 3 things. The first thing is a liquidity sweep. That's a sweep of an old low or inside a key level, a discount or a premium array. In this example, we trade into a discount array. It can be an old low, a fair value gap, an order block. And the second thing is displacement. And displacement is a fancy term for a big, energetic, one-sided move in the opposite direction. If we are bearish, this displacement means a one-sided move to the other direction, ideally leaving a fair value gap. And a market structure shift is confirmed when the last high, that is this high, that made the low, is violated. So we can make a line right here. Here is where the market structure shift happens, right here. And what you will see is price comes back to that area and then starts moving away. And what does it do? It creates higher highs, higher lows, and we have bullish structure. And here's a secret how I identify if we're going to have a change in order flow and change in structure. And that is that you will see bearish arrays, premium arrays, you will see failing, and you will see bullish arrays holding. Inside a reversal pattern, on the sell side of this curve, you will have bearish fair value gaps and bearish order blocks sitting here. Those are the premium arrays. And what I want to see in a valid change in order flow is that these arrays are filled. So for example, we have an order block here sitting as well. Whatever arrays you can find here on the bearish side, mark them out. And once you see they're completely ignored, for example, a bearish fair value gap becomes an inversion fair value gap, a bearish order block becomes a breaker. At that point, you already have a tiny hint. At the same time that you want premium arrays to fail, to be ignored, you want bullish arrays, bullish fair value gap, bullish order blocks to be created and respected. So if I look at all my winning trades, this always happens. Is when we trade into a key level, we made the aggressive sells, aggressive buys. There's a displacement, so we break structure, and then I will wait for this to happen. The price ignores premium arrays, bearish arrays. It respects bullish arrays. When I see that inside this piece of price action, I'm going in towards a obvious draw on liquidity. 90% of my trades look exactly like this. Using this small secret about how to spot changing order flows. Here on NASDAQ, you can see the secret in action on how order flow is changing. First, we have bearish structure. We have lower highs and lower lows, lower highs, lower lows. But at some point, when we trade to a key level, you see the structure shift happening. You see a liquidity sweep and displacement higher, creating a fair value gap. This is price indicating that we might want to go higher, want to change the order flow from bearish to bullish. So then we're going to create higher highs, higher lows, higher highs, higher lows. We're going to create bullish structure. But at the same time, you want to see bearish arrays failing. Here already, a bearish fair value gap filled. Bearish fair value gap filled. See how already price is hinting if you might want to go the other way. Also bearish order block filled. So this displacement already showed a lot about intention of the market from bearish to bullish. And price now displaces again another fair value gap created. And also there's an extra array created because there's a down close candle trading to in a fair value gap. That's a bullish order block. So there's where entries can be taken very easily. Here in the fair value gap, still below the low for 1 to 2. Where are we trading towards? If you go from bearish to bullish, you can target fair value gaps like this one from external to internal. You can also target the highs sitting right here because price will most likely visit them all. As you can see, price did not tap us in. Price moved away right here, tapped us in, and then went to the draw on liquidity back to the highs. So using failing bearish arrays together with supported bullish arrays is how you can spot changing order flow. And I know how overwhelming trading can be. That's why I created the ICT Bible. It's a 500-page PDF where I go from A to Z to all the concepts you can learn about trading. I spent hundreds of hours on this document, and this document will save you thousands of hours of ICT videos and studying. It's all for free, and I will leave the link to this inside the description. If you want to skip those thousands of hours of studying, make sure you check it out right now. Back to the video. But you cannot just go blindly to the 1 minute, the 5 minute, or the 50 minute, the lower time frame. Because if on the 1 and the 5 minute, the structure looks very bearish, but if you then look at the daily and the weekly, and we are super bullish, we go up very aggressively, your lower time frame structure is not likely going to hold, and you will lose. And we want to avoid that. We want to take as many winning trades as possible. So time frames play a big role in this. Write this rule down. The higher the time frame, the more reliable the structure. A daily structure is more reliable than the 1 minute. And I've dedicated videos on time frame alignment here on this channel. I'll leave the link to that in the description. The most important rule about time frames in my trade plan is the more time frames that are aligned with your trade idea, the better. So for example, if both the daily, the 1 hour, and the 5 minute supports bullish structure, higher highs, higher lows, longs are going to be the highest probability trade. If on the weekly, the 4 hour, and the 50 minute, everything goes down, we have bearish structure, lower highs and lower lows, then shorts will be the highest probability play. And to create your bias using order flow, you need to know what the most obvious draw on liquidity is. And the most obvious draw on liquidity can be found on the higher time frame. Because price only trades to two things: external range liquidity, that means old highs and old lows, and internal range liquidity. Internal range liquidity is another word for imbalances, fair value gaps. And you can use internal range liquidity as a place to trade from towards an old high, external range liquidity. That's why we say we trade from internal to external, from an imbalance to an old high, imbalance to an old low. External range liquidity, you can use as a starting point for price to trade back to internal range liquidity. That means you trade from an old high or an old low back to an imbalance. Those are the only two things price does. So once price trades into a key level, like for example, an old low on a higher time frame, for example, an old daily low or an old weekly low, and then breaks structure with displacement and a fair value gap, then we need to look for a trade from external range liquidity, an old low, back to internal range liquidity. And that's going to be a fair value gap. So then price most likely will make structure back to a fair value gap sitting right here. So here we're looking at the daily time frame, and there's a bullish fair value gap sitting here. And we just had a massive displacement, also changing structure right here, the last swing high that made the low. You see here the same profile, liquidity sweep, displacement, fair value gap. And the trade idea here on the daily, you know, we can use it as a place to trade from internal to external, back to an old high right here. This is going to be the bias on the daily, but we don't care about the daily. We want to execute on a lower time frame, but we're going to use this context to make money on the lower time frame. Let's go from the daily all the way to the 5 minutes. So here we're looking at the 5 minute time frame, and we just trade into the daily bullish fair value gap. All we wait for is these bearish arrays to start failing, bearish fair value gaps, and bullish fair value gaps to be created and supported. So here you see bullish fair value gap being respected while bearish fair value gap being ignored. Again, price trades higher. Massive bearish fair value gap being inversed right now, and from there price trades higher. After a little consolidation, you already identified that we're probably going to reverse from here. We're going to change from bearish order flow to bullish order flow here in the lower time frame, because you knew from the daily time frame we want to go from internal to external, higher towards the green line up there, and price goes from internal to external. So here you could have caught the absolute bottom, but you don't need to catch the absolute bottom, because in this whole move on the 5 minute, these were 2 entire days. So you could have found entries right here and right here, but also right here. Most of the time on the daily time frame, if you go from internal to external or from external to internal, there are 3, 4, maybe even 5 different entry possibilities for you to make money based on that bias, all using the higher time frame. Okay, now we know how a change in order flow works and how to find the next obvious draw on liquidity, but how can we combine these two to take actual trades? For that, we first need to identify what dealing ranges are. And a dealing range is the most recent swing high and the most recent swing low. And a swing high is a high with a lower high to the left and a lower high to the right. Swing low is a low with a higher low to the left and and a higher low to the right. And if you now see that logic in action, the change in order flow occurs when we have a liquidity sweep. Then we have a break in structure. The last swing low that made the high is violated with displacement. This candle can be marked as displacement, leaving a fair value gap. And if you have the dealing range, mark out premium and discount. Premium is the top 50%, discount is the bottom 50%. And ideally, you want to take shorts in premium and longs in discount. When we go from higher highs and higher lows to lower highs and lower lows, we want to look for shorts. So that means we want to short in premium of the range in the top 50% of the dealing range. And you see the price comes back here and then trades away. But that's not everything, because here we're looking at a 1 hour structure. If we zoom out here, because we need to find the most obvious draw on liquidity, if you remember the external range liquidity in old high back to internal range liquidity, there is where your eyes should go. So the bias on the daily was external to internal, and then we find the structure on the 1 hour time frame, and we can even drop lower to the 5-minute time frame to make it even more precise. So once you have your bias on the daily, you look for 1 hour structure, and you can even choose to long this towards the value gap and then short this again, but the highest probability trades will just be shorting from premium of the range. Earlier in this video, I mentioned that it's very important that your time frames are aligned. So if the daily is bearish from external to internal and the 1 hour is bearish, you already saw with the structure shift, your entry time frame, that can for example be the 5-minute, also need to align with shorts. And here comes the dangerous part, because let's zoom in on this up price action. On the 5-minute time frame, look at how clean that price action looks like. Super liquidity, structure shift, change state delivery, fair value gaps, order blocks, more fair value gaps, a perfect bullish structure. And if you see this, you're like, okay, let's hold this trade to the moon. I can hold this, we're probably going up because this is such a clean structure. It is, but you are trading against higher time frame, because you already saw that the higher time frame is bearish. We just had a liquidity sweep, change in structure, change in order flow, and we're most likely going to be bearish. But we are then trading only this, which can be a nice short-term trade, but the highest probability trades will be the shorts that come after. And let me show you this on an example on the charts. Now let's see how we can use dealing ranges together with the obvious drawn liquidity in external range liquidity to internal range liquidity in action. We just trade into external range liquidity. That's this box right here. If you then look at the current price action, we are very bullish. So we're going to trade from external back to internal, and probably on the higher time frame, we're going to do this. We're going to try to catch the retracement and then continue high. Let's focus on this price action. This is going to be the obvious draw on liquidity. There's another small fair value gap up here. And now let's drop to the 1 hour to find the dealing range. So now we look at the 1 hour at that same price action. So this is the external range liquidity up here. And we try to find the displacement range. And in this range here is where displacement came. We have a sweep sitting here. Then we have displacement leaving a fair value gap. So then we can mark out premium and discount right here. And then we want price to come back to premium of the range inside this fair value gap, and then we can take a short towards here. And this is a bias you can use intraday. If you, for example, know the AMD, the power of 3, accumulation, manipulation, distribution, that is what you can use inside this idea as well. So we can wait for manipulation here on the lower time frame and then trade lower. Now let's drop to the lower time frame to find an entry. If we look here at the lower time frame, we see accumulation, then manipulation, and we see that exact same structure, but then on the lower time frame, we see a liquidity sweep, then we see bullish arrays. Bullish for value gaps. Let me remove this 1 hour value gap. We are in premium of the range, of the dealing range. We are bearish. Bullish arrays are failing. Already hint that we might want to go lower. Bearish arrays are created right here, and a small one right here. So then you can take your entry if you want already from this small one. We want to trade towards the daily bullish for value gap sitting right here, or a 1 to 2. So we use the accumulation right here, manipulation into a key level in premium of the range. Then use that secret about order flow, change order flow on the lower time frame. We change from bullish to bearish because we see also bullish arrays fail and bearish array hold. Then use that, get tapped in right here. Use that to trade towards the obvious draw on liquidity that is right here. Order flow is just simply listening to the market. If bullish arrays start holding, the market shows its hand that it most likely wants to go up. If bearish arrays hold, price most likely wants to go down. Stop finding the flow of the market. Stop trying to predict. Just identify the dealing range, wait for premium and discount, and execute. Because if you can read the intention of the market with reading order flow, you don't need luck. You just need patience. And if you got value from this video, make sure you check out the video that's now appearing on the screen, because this video dives deeper into time frame alignment. So you can use order flow and pair it with the correct time frame so you will never feel confused again. Thank you for watching, and I'll see you in the next one. Bye-bye.
How often do you wait for a setup that you like? You wait for a market structure shift to happen and your price runs away without you. The key to fixing that is understanding the difference between a market structure shift and a change in the state of delivery. And this video, I will show you how we can use this to enter trades faster, alongside how I use this to gain over $1 million in funding and over $100,000 in payouts. With actual chart examples, so you can just copy paste this immediately into your own trading. No time to waste, let's get into the video. First, let's take a look at the industry standard. And that's the market structure shift. I have a dedicated video on market structure shifts in this channel. I'll leave the link to that in the description. This is what every trading book or video teaches you. We have a low. After that low is created, we create a high that sweeps liquidity, takes a liquidity at a key level, ideally in an old high or an old fair value gap or old order block, and then starts to move away, displacing lower. So to get a valid market structure shift, you need displacement. We need price to physically break the structure and close below this low. And price tends to come back to that area before continuing the move. And you can combine that with other arrays like a fair value gap or an order block. And the pro of a market structure shift, it is very safe because the trend has confirmed it has changed. But the con is it is slow. By the time this candle closed, price already 30, 40, 50 points away from the top where the move started. So in this case, you would have been a pretty nice entry, but there are many occasions where price just rips lower. And also your stop loss, if you need to put your stop loss above the high, can be quite big. Your risk to reward is not super nice. So it will hit the targets, but it's slow and it's more messy. So this is for your notes. A market structure shift is a change in trend defined by displacement, a one-sided candle, and a candle close above or below, in this case below a swing low. And because a market structure shift is quite slow, quite messy, it is safe, but there's a framework where you can get into trades earlier, and that's called a change in the state of delivery. And this is more like the sniper rifle because the algorithm delivers price in phases. It goes from buy side to sell side. So when we are trending into a key level right here, this is the algorithm offering buy side liquidity. And here we are not waiting for structure to break, which would be the last swing low that made the high. That's right here. Here would be the market structure shift. If you would wait for that, price would just move away without you. We need to look at the change in the state of delivery. And that change in the state of delivery happens when a single candle violates the opening price of the last sequence of up close candles. So we have 3 up close candles here. That's the sequence, and the opening price, that first candle, is where you mark out this change in delivery. So once that happens, it already happened with this candle. You can already take your trade with your stop above the high and your target down here. And when this candle is created, the market already hints at you that we're probably going lower. So for your notes, when price displaces and closes beyond the opening price of the last candle sequence that trade into a key level, validating it as an order block. We have a series of up close candles that made the high. When we close below it, there's an order block create, and that of course automatically also plays the change in the state of delivery, and you just wait for price to retest the order block and move away from it. And here's the mechanical difference. A change in state delivery happens first. It validates an order block. This here's up close candles here, and this here's down close candles here, and it gets you in already in this candle when it closes. Similar right here. And a market structure shift happens after. Secondly, it confirms the trend. It happens later, usually when the order block has already been respected. So here's the order block has been created. In this candle, we test the order block and move away from it, and then only the market structure shift is created, leaving of course a fair value gap. So your entry in a market structure shift will be right here in this candle. Then in change state delivery, it would already be in this candle. So you're in way earlier. It's for the sniper entries. So you can use the change in state delivery to be already in the move even before there's a structure break. So what I see really good traders do, and I use this myself as well, is you can get in already at the change in state delivery. And when you see the market structure shift happening, you can even choose to pyramid to add a little more contracts to your position already to make more money out of a winning trade idea. Now, seeing this happening on a video is easy, but spotting it live when NASDAQ is pushing 100 points in a few minutes, there is where it gets hard. I trade this setup live with my students every single morning inside my Discord, where not only there's a group of very smart traders, I share my own insights analysis here, together with weekly outlooks, boot camps, free resources, entry models, and way more. Link towards Discord is in the description. And yes, it's free. In this first example, we're looking at NASDAQ, and we just traded during the New York Open into a key level where we take liquidity and we start trading lower. And we want to see the difference in execution between a change in state delivery and a market structure shift. The market structure shift is when the last swing low that made the high, that is this high, is violated. That is with this candle. And usually when you have a market structure shift, you also want a fair value gap to be created and then take your entry in the overlapping part between a market structure shift and a fair value gap. The change state delivery is when the opening price of the series of up close candles that made the high is violated, an order block creation right here. And we see that after we do the change state delivery, the change state delivery already happens right here at this candle, because we already traded below the opening of the candle. So here already change state delivery occurs. After that, we see movement upwards. So for change state delivery, your entry right here, where we target the low right here, if you zoom out a bit, I think we can spot more failure swings we can target. We have these equal lows right here. We have a swing low right here. So there's many targets available, and it overlaps with these equal lows right here. There is where these change state delivery target trade would be. That's one. What if we use the market structure shift as our entry criteria, where we have the down close candle that sweeps that market structure shift low. The next candle does not create a fair value gap, which is not nice, because that's actually what we need to take that trade. Even if you want to be really precise and you just say, I'm going to take my trade at the market structure shift after the candle close right here, same target right here for a 1 to 2. This is what your trade would look like. Your stop loss is not in a very nice place. What you can use for stop loss placement is of course above an old high, but you can also use the order block that has been created with a change in state delivery, these two up close candles. You can use the 50% of the bodies there, the mean threshold, and put your stop loss above there. That should be safe. And then your TP should be a little bit lower right here. So this one is the market structure shift. This one is a change state delivery. And let's see what we do. And both would have given TP. In this next example, we're looking at YM at the 5-minute chart. During the New York Open here at 9:25, we have a swing high sitting here. I have a series of down close candles. And what happened exactly at the open is that we displace higher. The market structure shift occurs right here, also overlapping with a fair value gap right here. The change state delivery happens where the open of the series of down close candles that made the low is violated. There's an order block created because of it. So right here is the change in state delivery. For the entry on a market structure shift, you do that overlapping with a fair value gap. So your entry will be right here, stop below the low. If you zoom out a bit, there's a 1 hour bullish fair value gap sitting here. So we have a pretty big target we can target. We don't need that. But if we stop above the low for 1 to 3 or 1 to 2, will be right here. For the change state delivery, we can take the entry when the candle that created the change state delivery has closed. So that will be right here. So where market shifts right here. Change state delivery trade is right here. Stop below the low for 1 to 2. So here you see that the market structure shift trade is smaller, but you need to wait for the entry. And the change state delivery is bigger, but you are in the trade already. Looking at this, let's see what price gives us. Sweep liquidity, change structure, change state delivery, and price trades higher towards the 1 hour bearish fair value gap. The problem here is the change state delivery target has TP, but the market structure shift did not get an entry because we did not get back into this fair value gap. And that's the problem. That is why the market structure shift is more often safe, but you also will see that you will miss moves because of it. But that's why using the change state delivery and then compensating price potentially coming back into the fair value gap and then go higher, that is my preferred method for the entry, because I'm okay to sit in drawdown for a while with my stop loss in a nice place than to not be in a move at all. And this means, yes, you will feel more uncomfortable. Your psychology will play a role. You might want to take a trade off because you will think it goes to your stop loss, but you will be in the trade. And that's most important. Like, you don't need to be right all the time. You just want to make money. So I'm okay with being too early in the move like this and then sit in drawdown for a while and then go to TP to try to be fancy, figure out the algorithm for the precise entry, and then maybe not even be in the move at all. Wow, it was pretty obvious that we wanted to trade towards a certain target. And one more thing. Now you want me to tell you which one is better, the market structure shift or the change in the state delivery. But you are asking the wrong question. The change in state delivery is pure speed. It relies on trusting your daily buys completely. If you don't know where the daily candle is going, the change state delivery will destroy you. The market structure shift is pure safety. It relies on confirmation, and it works when you're insecure, and it will also cost you profits because waiting for a market structure shift could mean price will run away without you. So both work. There's no right or wrong, as long as you choose the one that fits your personality and trade style the most, and then execute it consistently. Just master one of the two and do not strategy hop. And if you want to get the exact technicals and entry models I use in my trading to gain over $1 million in funding and over $100,000 in payouts, it is all inside my market maker blueprint. It is all free. I will leave the link to that inside the description. And if you got value from this video, make sure you check out the video that's now appearing on the screen, because in this video I will break down how I turned $500 into $8,000 only using one simple entry model. And yes, the frameworks from today's video will come back into this. So thank you for watching, and I'll see you in the next one. Bye-bye. You've been there. You analyze the chart, you find the bias, you enter the trade, and then the market wicks you out by 2 ticks and then proceeds to run 100 points in your direction without you. And you sit there thinking the market is rigged. And you think it's manipulation, but it isn't. The problem is very simple. You treated a weak high like a strong high. And in this video, I'm pulling down the curtains on how to identify strong and weak highs using high and low resistance liquidity. And I'm going to teach you exactly which highs and lows are engineered to break and which highs and lows are engineered to hold. I use this exact framework to skyrocket my win rate and get consistent payouts. No time to waste, let's get into the video. Before we go over why a high or low is strong or weak, we need to speak the same language. Most of you look at the chart and see random swing points, random highs and lows. And that is why you lose. You need to distinguish 2 types of swing points. The one is relevant to making money. The other one is just noise to confuse you. And I'm talking about intermediate term highs and lows and short term highs and lows. Let's look at an intermediate term high. This is a swing high with a lower swing high to the left and a lower swing high to the right. This is the boss. And in a bearish market, in a bearish structure, this intermediate term high is respected. And what I'm sharing here is exactly the same for intermediate term lows. Then we have short term lows. This is any high that forms inside the move of an intermediate term high. Basically all the swing points you can find right here. These short term highs are not walls. They are targets. And if you place your stop loss around those, you're basically donating your money to the market makers. So don't do that. Okay, so when you know the difference between a short-term high and an intermediate term high, but how do we know if price is going to respect them or just slice right through? This brings us to the most important concept in price action: high and low resistance liquidity. We categorize liquidity in 2 buckets: high and low resistance liquidity. High resistance liquidity is when there is a liquidity sweep before the move. So there's a low being taken out in this example before the move. And in the schematic, you see that too. We have a low that has been taken out before the big move. In other words, there is a intermediate term low created before the move. If you compare it to low resistance liquidity, there is no liquidity being taken out before the move. I also refer to this as the staircase effect because we're just staircasing, stair-stepping upwards. And do these lows look like they are gonna hold once we start breaking down lower? No, of course not. Because low resistance liquidity likes to just be traded straight through. So once you know that low resistance liquidity is not nice to have your stop loss below that because we're probably going to be taken out, there is something we can use here. You can play attack and defense with these 2 types of liquidity. The high resistance liquidity, where we sweep a low and we create an intermediate term low before the move, is what you can use as defense. So your stop loss can sit below this low because it's a protected low. And at the same time, if there is low resistance liquidity as your target, you can use that. At the same time, if there's low resistance liquidity at the opposite side of your move, so if you are long and there is low resistance liquidity sitting here, you can use that as a target to have those clean, satisfying moves. And this is how that looks like on a real chart. There's liquidity sweeps before the move, so there's an intermediate term low created right here. There was another one right here created, but there was no move after, there was no displacement after. And once we had that market structure shift right here and also an order block sitting right here, there is where the market started moving very aggressively. And why does it move so clean with so big candles? Is because we are targeting low resistance liquidity. All these highs don't take out any other highs, making it an easy target. So high resistance liquidity defends your position. You should put your stop loss below that. It's gonna defend your position. Let's say you take the entry at the order block. Your TP can be at the end of low resistance liquidity. And that is how you can get the fastest profits and the cleanest moves. And I know how overwhelming trading can be. That's why I created the ICT
Bible. It's a 500-page PDF where I go from A to Z to all the concepts you can learn about trading. I spent hundreds of hours on this document, and this document will save you thousands of hours of ICT videos and studying. It's all for free, and I will leave the link to this inside the description. If you want to skip those thousands of hours of studying, make sure you check it out right now. Back to the video. That brings us to the core of profitable trading, and that's the trader pyramid, with technicals at the top, below that journaling, data building, your trade plan, and your mental game psychology. And 90% of gurus start at the top. Technicals, they sell you courses about order blocks, about fair value gaps, but they only teach you 25% of the equation. The other 75% is a foundation inside the pyramid. The trading industry only teaches you where to click the technicals because it is sexy, and unprofitable traders think that is what they need to make money. But they are wrong. I teach you how you handle the emotions of clicking the button and why you are clicking the button with a trade plan. Do you lack confidence in your trading, or your trading feels random? That is because you lack proof, data, that what you are doing actually works in the long run, so you can make money in the long run. That is where trade plan and building data on your trade plan comes in. So we build the foundation first, and then we talk about technicals. So that means for high and low resistance liquidity in your trade plan should be a very clear point that your stop loss should be below or above high resistance liquidity, and that you're going to target low resistance liquidity. This way you can increase your win rates. But it also means you need to build data on this. So you need to go to the chart and find examples, case studies for yourself. So you train your eyes to actually use this in a real-time environment when the candles are printing in a live chart. And the cool part about this is if your stop loss is below high resistance liquidity and it still breaks, your trade idea is just invalid. It's an honest loss, and you will not be sad or tilted about this. It's a good loss. It's part of your edge. But if your stop loss is defended by low resistance liquidity and it breaks, you know you just gambled. You knew you were trading a low probability environment because it was defended by a weak low, and now you know where to focus on so you can improve for your next trades. But there's one exception to this rule, that your position needs to be defended by high resistance liquidity and you need to target low resistance liquidity. An exception to that rule is called an SMT divergence. And SMT divergence is when two correlated pairs fail to follow each other, this divergence, and a SMT divergence indicates a potential reversal. And correlated pairs are, for example, the NASDAQ NES or YM, or Euro Dollar and GU, gold and silver, Bitcoin and Ethereum. And with correlated pairs, correlated means they need to follow each other. So if one makes a higher high, the other one needs to make a higher high. The other one makes a higher low, the other one needs to make a higher low. But what if that doesn't happen? So right here on the left, there's a equal low, and we sweep that low before the move. That means there is high resistance liquidity created. We create an intermediate term low before the move. Strong low, so you can put your stop loss below that. In his right example, there is low resistance liquidity being created. There's no low being taken out before the move up. And you might now say, okay, this is the correct one to trade if you want to go long, because you can just put your stop loss below this low and you can target the highs. I agree. But with SMT divergence, if, for example, this is ES and this is NASDAQ, and they must follow each other. So if ES makes a very clear buy structure, the liquidity sweep, market structure shift, and I'm anticipating it to go up, and NASDAQ is correlated, I'm expecting it to do the same. But then your stop loss is going to be below this low, and it's low resistance liquidity. Do we still trade that? And the answer is yes. And that's because we have two correlated pairs. ES shows very clean we want to go higher. That means NASDAQ is going to follow. And because NASDAQ makes a higher high and ES makes a lower low before that move higher, before displacement move higher, that indicates a potential reversal to me, with NASDAQ being the strongest one. If I want to go long, I want to long the strongest pair. And because NASDAQ did not even take out the low, I want to trade higher on the NASDAQ. And ES will also trade higher, but it's going to be a little slower because it's a little weaker, because we made a lower high here. It first want to go lower before going higher. And with this SMT divergence, that means the cracking correlation before a move happens to the other direction. It indicates a reversal. And the goal is, if you want to go long, long the strongest pair. If you want to go short, short the weakest pair. In this case, NASDAQ is the strongest pair because it did not even take out the low. And how this looks like on a real chart, on the left we have NASDAQ and on the right we have ES. Here we have a low and we have a higher low sitting here before some displacement up. Here we have the same low, but then a lower low before the move upwards. And the bias is up, so that means there's an SMT created. So once this is an hourly chart, so once the candles are here being printed, there's an SMT confirmed, and inside this SMT see, we can drop to the lower time frame to find our entry model. But it all starts with the crack and correlation. So here I would trade the NASDAQ here on the left side because the NASDAQ is stronger. So if it wants to go up, it will go up faster and cleaner. Even while your stop loss, which will be below this low, is defended by low resistance liquidity. That is the exception. Now you might say, I see those strong and weak highs everywhere. The short-term highs, the intermediate-term highs. Because if you go on the 1 minute time frame, you will see short-term highs and intermediate-term highs every few minutes. And that's why we need a very strong filter. And that filter is where time frames come in. The rule for time frames is the higher the time frame, the more reliable the structure. That means the higher the time frame, the stronger the intermediate-term highs and lows are. And a daily structure, daily high resistance liquidity, is way more likely to hold than a 1 minute high resistance liquidity. And remember this, you don't need to stare at the chart for 8 hours on a 1 minute time frame. That's how you get anxiety and you get overwhelmed. That's how you overtrade. But you need to be able to identify the higher time frame and execute on a lower time frame just in one single session, like the London session or the New York session. So if you now look at this structure on the 4-hour time frame, we see below here, if we zoom in, there is a intermediate term low created. Why? Because there is a swing low to the left and a swing low to the right. And that's going to be a starting point as well to trade towards and that's a starting point of also a high resistance liquidity being created right here. And we target, what do? We target low resistance liquidity because this high does not take out another high. See how clean we move there. But this on a 4-hour time frame. If we now drop to the 1 minute time frame, let's zoom in on this exact price action down here at the blue area. There is many more swing highs and swing lows, and you can identify intermediate term high here, also one right here, also one right here. And which one then do you pick? There's so many. And that's why the higher time frame context is so important, that you know the higher time frame structure is leading. But at the same time, price is fractal. So what we did on the 4-hour, we can do the same on the 1 minute here. Because look at what happened is we sweep liquidity down here, creating an intermediate term low, high resistance liquidity sitting here. And what is on the left side of this is low resistance liquidity. All highs that don't take out any other highs. Yes, they are intermediate term highs and they look like they need to hold. But at the same time, they are low resistance liquidity. And you see how clean we trade towards that. So that's why before you go to the 1 minute, you need to have a very clear understanding on where the higher time frame most likely wants to go. And that is also when you look at all the entry models I give you on this channel with all the technicals, is that this is the #1 profitable reversal structure where we trade lower into a key level that's in higher time frame for value gap, order block, or old low in a bullish example. Before we create that first move, we do aggressive sells, aggressive buys. You can also call this a V-shaped recovery or a smart money reversal. But the thought behind that is that there is liquidity sweep, a high resistance liquidity, the high resistance low being created before the move up, before the market structure shifts. Because if you take a long trade, you want to have high resistance liquidity defending your position. And how nice is before that high resistance low is created, after that we have a liquidity sweep, you potentially have a fair value gap, maybe it's supported by a bullish order block or a bullish breaker, and before that we might have inversion fair value gap, and then we need to identify, can we target low resistance liquidity? That is the reversal structure, and that is how you can incorporate high and low resistance liquidity inside the overall picture of this reversal model. On this channel there is a playlist called My Entry Models, and you will see this exact schematic in all my different entry models at its core, and all the nuances you can learn in those videos. You should be able to identify which highs and lows are strong and use them as your defense, as your stop loss, while at the same time attack the weak highs and lows as your targets to create those clean, satisfying moves. So now it's time to go into your charts, mark out the intermediate term highs and lows and the short term highs and lows, identify high resistance liquidity and low resistance liquidity, and train your eyes. Don't just trust me on this. Prove to yourself that this works for you. Nothing works for the person who does not want to do the work. And if you got value from this video, make sure to check out the video that's now appearing on the screen, because with your new wisdom about high and low resistance liquidity, you will now be able to master this exact entry model that got me over $150,000 in funding in just 4 days. Thank you for watching, and I see you in the next one. Bye-bye. This is my best entry model, and these are the only things you need to trade this high probability model. In part 1, I showed you this model with an 86% win rate. And in this video, you're going to learn something that no course will ever teach you. How to not blow your account in the months where the market is very hard. Because if you can survive the environment you're about to see, you can survive anything. No time to waste, let's get into the video. In part 1, we had an 86% win rate. And I know that is why people clicked on that video. And I hate that. because there's way more to become profitable than simply looking at win rate. In this video you're about to see, we're going back to May 2024, a random month my students voted for live, and I'm going to show you the exact entry model you saw in part 1 in a completely different environment. Let's go. In the first part of this series, we went over this exact model. And this exact model, what you see on the screen, is the same model you see in the 10 AM game and the FTS model. It's a whole checklist. We're going over that right now. And the first step you need to take is before 9:30 AM EST, that's the New York Open, mark out the most obvious points of liquidity. And the most obvious part of liquidity is for value gaps or old highs and lows. The goal is to trade towards the obvious point of interest or trade from it. So if we zoom out here, we have sell side liquidity, we have buy side liquidity, and this is the depiction. But if you're just going to remove the depiction like this is where we start. So after 9:30 AM EST, so after the New York Open, we wait for some form of key level to be traded into. It can be sell, but we're going to do a long example in this schematic. Of course, vice versa is going to be for shorts. After 9:30, we wait for the liquidity sweep. Then we need to see displacement. Displacement, fancy term for a big one-sided move. Energetic candles. Displacement leaves for value gaps. Always. Like 9 out of 10, it leaves for value gaps. And if you have the aggressive sells, aggressive buys, in that area, most of the time there will also be an inversion for value gap. An inversion for value gap that was, in this case, a bearish for value gap, but because we ignored it, it just changed themes to an inversion for value gap. And this was resistance to trade lower, but because it was invalidated, inversed, now we're going to use it as support to trade higher. There's also order block in this area. So the entry can be in a fair value gap, order block, inversion for value gap. You can even use a breaker. I don't use breakers too much in my trading, but you can, the breaker most of the time is in this up close candle here before the move down. But for now, we're going to focus on in the model is fair value gap entries, inversion for value gap entries, or order block entries. Target 1 to 2. Like we're not going to do fancy stuff. So let's say we want to take a trade from here and we want to put a stop below the low. It's just a 1 to 2. We're not going to trade all the way to the buy side liquidity to be fancy for 1 to 3, 1 to 4. Just base hits 1 to 2. You're going to make a lot of money with 1 to 2s. And the bonus point is for the highest win rate, wait for the second PD array rule. And the second PD array rule is not that you take it right here, because these are all the first PD array, like the test PD array, like the first for value gap or the inversion value gap or the order block. This area I like to use as the test. So do we actually move away from it, or are we just trading lower? Because if we're trading lower, we're getting stopped out. And that would suck because we don't like losing. So ideally, you then wait for another reaction from that level. With that reaction, maybe there's even a second fair value gap created, and the down close candle. If you've seen the order block secrets video, the down close candle, the trades to the fair value gap is called an order block. So where this was the test area, I call it the first PD array area. This is the second PD array. So then wait for here. And then just take your entry right here. And then you can put your stop loss below this low or below this fair value gap for 1 to 2. That's it. Let me know right now in the chat if there are questions. If there are no questions, you can press a no. I want to make it interactive. And of course, in the final cut of the YouTube video, I will cut these parts out because that's boring for the viewer, right? With that, this is what we look for every single day. Every single day. And we see here multiple ICT concepts, but also other trade languages. Like we see the accumulation, manipulation, distribution, the power of 3, the AMD. We can use the open, high, low, close of a new candle. There's a lot of different concepts inside this model, but this is at the core of all reversal models. And during the backtest, what you're going to see, and you also saw this in part 1, this is a reversal structure. But I want to add something here. Because of course, we're not going to just copy the first video. We're going to give new and more value. Because at sometimes we have the situation that before the open, with for example, a big news event, at the time of this recording, we have an NFP day. So then before the open, we could already have this liquidity sweep. And then at the open, we are here. What then? Then we need to play a continuation model, because then we expect price to not come back anymore to the low. We're going to see this during the backtest as well, that if there's already, we have a key level marked out where we expect price to move higher from, for example, for longs, if that's already been hit before 9:30 and it gives this clear structure, I will just take continuations and trust that that low will hold. It would be nice if that happens. You're gonna hear me repeat this during the backtest. If London makes this low, so that around 4:30ish a.m. EST, London low. If London low is that, and then 9:30 a.m. is this, that is very sexy. We love that. And those nuances we're gonna see back in the backtest. Cool. And then we're gonna just take continuations during the open. So what you will see at 9:30 a.m. EST, we have just a displacement higher during the open, and then we wait for most of the time for the first 15-minute fair value gap. That's what you most likely see. So that means that the opening candle retrace, boom, higher. That's going to work towards. All right, that's the framework. And now the user viewer gets now a quick cut to the backtest. We need to decide what year and what month. So drop in the chat. Let's just choose between 2024 or 2025. Drop in the chat. 2024, and then we're going to do the month. All right, now in the chat with my students who are with me during this backtest, we decided on, we had many choices. We had 2024 as a choice, 2025 as a choice. They had the quarter, they had the I'm just going to cut this out. Like every time I just stumble over words, it's going to be cut. They had the choice between the year 2024 or 2025. Then they had the choice between the first half and the second half, which quarter and which month. And after a few votes, we came towards May 2024. So now let's go to May 2024. We can do this by going to the calendar down here, and then we go to May. Of course, we need to go to April, because if we, I don't want to see the candles. Like I need to be a little bit blind. So what I want to do is do April 1st. Let's see if the candles are available. I think we are. Yeah, the candles are available. And I don't want to see the candles. Okay, I think it's good enough. Good enough. I didn't cheat here. Like I saw in the comments of the first part of the video that people said that I was just cherry picking the best month I could find. I was so insulted by that. I was like, no, I'm not gonna cheat. That's not worth it. It's just not worth it to cheat about this stuff. Cool. Let's go. First up is the higher time frame. Every day before the open, I look at a few things. I call them buckets: higher time frame and intermediate term time frame. And if you've seen my recent YouTube videos, it's also called top-down analysis. Higher time frame. Not sure why this is so ugly. Holy shit. Okay, let's make this text a little bit more sexy. There we go. Boom. Higher time frame. That means daily, weekly, monthly. And we have, well, let's make this a copy of this one because we are lazy. Boom. And the other one is the intermediate term time frame. That's the 1 and the 4 hour. There we go. If you want to determine your daily bias, it is nothing more than answering the question, where is price most likely going next? And that's just going to be an old high or a fair value gap most of the time on the intermediate term time frame or the day or the higher time frame. So what we're now going to do is very simple. We're going to mark out the old highs and lows and fair value gaps from the monthly to the weekly to the daily, all the way to the 1 hour. And it's a boring task, but those levels are super important. So let's do that now. So here in the monthly is March, and where's April? Well, I see already here that we have a monthly bullish fair value gap sitting here. That's interesting. I like that. Let's. I think we can use that for later. Monthly fair value gap on the weekly. Now I'm going to fast forward a bit towards the start of May. Is March. Okay, so April. Look at this. April trades into the monthly fair value gap. So we can expect potential higher prices from this. That's amazing. Cool. So that is going to be the start of our bias probably. Moving away. And also I see a weekly fair value gap sitting here. Down close candle as well. So a small order block here. Let's go to the daily. Daily, I'm going to fast forward a little bit towards the start of May. And this boring stuff I'm now doing live on the chart. This is what I usually just cut from the videos because this is super boring, but I need to do this at the start of a backtest. Here, April 30th. I think April has 30 days. I think the next day. Okay, awesome. So we had the monthly fair value gap. Then we basically closed almost there. So let's make it a little bigger. There's the weekly fair value gap. And now on the daily, it does look super clean, to be honest, right now. So let's just see what we have. I see that we just swept some liquidity. And I think also we trade into this daily fair value gap. Yeah, We make a low in this daily fair value gap here in May or in April 2024. They move away from there. And there's also a daily bearish fair value gap sitting here, which is open. That is very sexy, right? You see this? We have equal highs. Or do we? Oh, no. I think I'm lying. No, it's already been tapped. Never mind. But there's a high created here. And now we trade it lower. April 30th. Now let's go to the 4-hour. So we already now marked out the daily and we're gonna have a rough back. You guys knew this. You guys knew that May 2024 was a rough one. So we're gonna. So this is pretty nice as well because this looks like the current NASDAQ. The time that we record this is what is it? It's April 2026. This looks a bit like what we're now seeing. That it's ranging, big ranges, but not following through. So I think it's also a nice exercise to do that. Okay, so we see daily low here. Then there's an order block, breaker, 4-hour. Like this is a 4-hour fair value gap and order block. And we're just going to trade. One thing is, I'm not going to keep into account the news during this back test. So it could be that some trades just randomly, we're going to see like 830 big, massive expansions, of course. Then we're going to know what the news brought. But in general, I'm not going to just now go on Forex Factory and just go back to May 2024. I'm not going to do that. Usually, I would recommend that, but for time reason, I'm not going to do that. I'm good with that. We're just going to see that we think we're in a position at 10 a.m. We're just going to stop out. And we're like, oh, yeah, there's probably news. And it's fine. That's fine. Okay. So higher time frame levels are marked out. The intermediate term time frame levels are marked out. And not super clean. Not super clean. So the higher time frame, intermediate time bias is pretty neutral. And when that bias is neutral, the intraday trades, the 1-minute trades are going to be smaller. I'm not going to target fancy targets. It's going to be like a thief in the market. Short in, short out. And hopefully see what an work it is to just prepare this. So now we're almost ready to take a trade. I see also a 1-hour fair value gap here. You see 4-hour order block. Cool. Also a 1-hour order block. So when I say backtesting is boring and tedious, this is what we're going to do. It takes a while. It takes a long time. Okay. Cool. Let's go. So Tuesday, we need to go to, and what I didn't mention, we're going to, of course, just trade the New York Open. We're not going to trade London session. We're just going to only trade New York Open. And we're almost there. Almost there. Cool. This London. At London, we trade into the 1-hour bullish fair value gap. I think if you now go to the 4-hour, I think we're going to see also 4-hour bearish fair value gaps. So we could trade between here, longs towards the 4-hour. I see also in 1-hour. I'm going to move this to make it cleaner. 1 hour. I'm going to quickly peek to the 4-hour. Yeah, massive 4-hour value. Okay. So my bias for this first day of the month is going to be that I'm open that we're going to react from this area. Because at this area, we already had a liquidity sweep, market structure shift. It already traded higher. This is, of course, because we come back so aggressively. It's a lower probability trade, but I'm open just for a low-hanging fruit trade that we're going to see at the New York Open. We're going to see buy structure towards the midnight open right here. That's my drawn liquidity ideally for this first day. Cool. Let's go to the New York Open to see what we have. Okay. 8:30 is probably news. Okay. Here we go. So what do we see right now? I think this is what we saw earlier, the continuation model, where the structure is already formed before the open. So here we have a aggressive sells, aggressive buys. For like one, we're on a 15-minute time frame, not on a 1 minute, just 15-minute time frame. 15 minutes. See another 15 minutes. So based on this, during the open, I'm interested in maybe taking a trade like this. So what I want to wait for is what do we do inside this fair value gap? What do we do inside this fair value gap? So let's see. Let's drop to the 1 minute. We forget the 5 minutes. We also do the 5 minutes. I'm going through all these time frames. If you see me trade live on YouTube or during the streams, you see me doing this every single day. So I cannot skip this part. I just need to go through all these time frames and mark out all this stuff. Yeah, these highs are super sexy. So ideally, we trade lower at the open and then trade higher. So let's see. That's 9:20. Okay, let's go. Cool. No entry yet. No entry yet because the bias is higher. But this is nice. If the bias is higher, we love to see first a little bit lower. And I'm going to do candle for candle because I cannot skip the entry, unfortunately. Okay, so at the start, we have a little consolidation. This looks nice. 10 a.m. game. And I'm during this backtest, I'm also not taking into account stuff like SMTs. I'm not going to go to ES. It's a pretty naked backtest. But I'm still hoping to see a move towards the midnight high. Let's make it a little bit cleaner here. So the 50-minute bullish value gap is invalidated already. But the whole range is not super sexy here in this first day of the month. And I told this during the YouTube stream on this month as well. This time recording is April 2026. First day of the month could be choppy because the monthly candle was opening. That's cool. So let's see. Do we get displacement? Where are the fair value gaps? Not super sexy, but it is enough. It is enough. So in this move, what I see is a fair value gap, 2 actually. I'm also going to the 5-minute after this to see if there's a better structure here. The delivery is super choppy, but I like it. I like it. Order block. Quickly go to the 5-minute. Now, when I would trade this live, I'm probably not gonna take this. Okay, so what I'm eyeing for this trade is the midnight high as a target. I need a 1 to 2. So let's see if we would do that. Where would our stop loss be? So let's say this is our target. 1 to target. Is this a valid trade idea? From here. And what I do during a backtest, and also when I take a trade myself, is this the nice structure? So we can grade this as an A, B, C, or D setup. So if we have the depiction where we go from aggressive styles, aggressive buys, PD array area 1, like with all the value gaps, the order blocks, and then PD array 2, I don't see this too much. Like we don't have the clean energetic candles. Like these are the first energetic candles. Making this a B setup. I'm gonna take it just for data purposes. Like I don't care if this backtest is gonna be a super horrible month. I just want to share my thoughts. I would say this first trade, I'm gonna press the button now, is a B setup because we don't have the clear displacement, but we have such a clear target, and we have now candles moving towards that target, and we see old highs failing, bearish value gaps failing. I think that's a very nice trade to take. Cool, let's go. Exciting. And a stop loss. Cool. Well, I think the B setup played out perfectly, right? So then what I'm going to do is I'm going to make another box here, text box, with May 2024 trades taken, 1 wins, losses, and win rate. I'm going to just add it in later. Okay, losses. There we go. 0% win rate, guys, so far. We're bad traders. I like this. It's clean. And then I'm going to do the same here. I'm going to anchor it. Oh, wait. Let me do it in a better place like this. Make it a little bit bigger. Yeah, this is good. It's not super clean. Like I have a little bit OCD, like you're live with me in the stream, but I'm a little bit OCD. I like it to be a little bit cleaner here. No. When I do these videos, this takes such a long time all the time because I'm so OCD here. Let's make it blue. Yeah, this is better. This is better. Okay, awesome. Okay, and then I'm gonna now anchor it. Cool. Okay, so first trade, B setup. And this is very nice data because the reason why I take it is, of course, would I take this in a real scenario? No. But this data, we're going to reuse this later. So I'm sure that we're going to get similar trades in the coming few days. We're going to backtest. And then we're going to refer back to like, hey, remember that May 1st trade where we did not move away cleanly? So I gave you a model. And this is already nice nuance. So if price does not move away very clean with big energetic candles, it's just choppy, like big wicks, small bodies, stay away. Stay away. So take one for the team here. Okay, cool. Let's zoom out to the 15-minute time frame. And here we see that it's just failed. Do we get another trade potential? Maybe. This looks cleaner. Cleaner, aggressive sells, aggressive buys. So maybe there could even be a re-entry in this area. This looks more like the setup. Do you guys agree? So if you then compare this with this, I think this is cleaner. Aggressive sells, aggressive buys. So we have the liquidity sweep, the market structure shift, happens not here, but less swing high right there. I like this. Let's see if we can get your retracements into them. Okay, let's see. Okay, scary candle. Not super sexy, but hey, this creates an order block if the bias is still good. And the bias could be wrong here. Maybe we're on the wrong side of the market. So now if you create up close candles with their value gaps, I might want to take the trades and just the wrong side of the market. Is this then gonna be it? Like this is what I do during the session as well. Like I'm just gonna sit here, wait for this fair value gap. Do we react from it? No. Okay, wait longer. And here I want to like I think this could be the setup, but look at the time. It's already lunch. I don't like this too much, but this is sexy. I like it. Wait, just 5 minutes for value gap being traded into, and now we're already trading PM session. So this is a hard day to trade, I think, because we did not move away actually, like we just stayed in that range, creating failure swings, which is nice to use later. We can target this later, or maybe we're going lower first. It's a Monday. No, it's not a Monday. It's a Wednesday. We have a clean lows, so let's just see. But now you have this one trade. It's a loss. It sucks, but it's fine. Okay, question. The question that's asked is, when should we take into account the bias based on the daily sniper model? The daily bias sniper model is that you look at how the previous candle closed compared to the do I say this correctly? How yesterday's how yesterday's candles closed compared to the candle before. I have it in my head, but I was so let me explain it with candles. Where's my bearish candle? There we go. So the answer is I don't use that here. So let's say it's this. So at day 1, we have this candle. At day 2, we sweep the previous day high, but we fail to close over it. Then I'm expecting the next day to trade at least towards the low here. That's the daily bias sniper. And you can even use a 4th day. In a daily bias sniper, I also discussed the 4th day. So when there's a swing high created like this, and there's still a nice drawn liquidity, then the 4th day is going to be even sexier. So that is the daily bias sniper. I don't use that here. I think it's a very nice confluence, but I want to keep the rules as simple as possible. And that is just very simple. I mark out the higher time frame arrays and look at the structure, which is the most obvious drawn liquidity. I think based on this first example, that midnight high we target with this losing trade is super sexy, but unfortunately not for now. Cool. So I was not sure how to describe this in words, but yeah, this is daily buy sniper. Cool. So one of the mentorship videos. Delete. Let's go to the next day. So first day, and you see how long we already do over one day. And that's why backtesting takes just a very long time. It's very hot here. I need to, it's like 35 degrees where I'm right now in Vietnam. It just takes a long time. And it sucks. Next day. For the next day, I'm just going to go to the hourly. And then just before the open, around 8 a.m., we're going to do the same exact thing. We need to build a routine. So every day, we do the same thing at the open. Whoa, that's insane. Okay, so that's this is probably FOMC. So I think we traded before FOMC, guys, which is fine. That's what I said. We're gonna take dumb, stupid trades because of news, but this looks to me like FOMC, right? So if we're gonna now look at May 20th, we just took the loss on FOMC, which is maybe a good data point that you should not trade before FOMC. Don't do it. Don't do it. Don't do it. Because this is what happened. Because now our target is smashed, like smashed. Okay, back to the next day. 7, 8. Yeah, I'm going a little bit earlier. I'm going towards here because if I'm now, this is how to cheat yourself into backtesting. If I'm now going to the 4-hour, it prints the next 4-hour candle. And I don't want to see the next 4-hour candle because then I can see the bias of the open already. That's cheating. So at the start of the trading day, we see this. Zooming out, it is horrible. It is horrible, but we have a 4-hour bearish value gap sitting here. This is low probability price action, guys. So we're not clean trades on the lower time frame, which is fine. Yeah, so we had a big rejection from FOMC probably during the PM session here, making me most likely maybe want to trade lower towards the low here, just based on this 4-hour candle. Okay, cool. Using that bias, let's go to so I have like a small bearish bias because of that big wick right here. Nothing here. Let's see if in this candle there is fair value gaps. Yeah, that's what we look for. This is our higher time frame box. Boom. Okay. So here as well, we have this bearish fair value gap. Also, there's a 15-minute bearish fair value gap sitting here. So I'm favoring shorts right now towards these lows. It will be nice. So maybe we can cash a trade like this.
And hopefully you see what I'm doing now. This is what I do every single day. I go to Discord and I share my screenshot. This is exactly this. Highs and lows for value gaps, and then implementing the model during the open. Okay, this is London. We're not trading London, so we're going to wait until the open. It's going to be at 9:39. We are in the fair value gap. Cool. So the start of the idea is coming. And from here, one more. There we go. 9:50. Okay. From there, we go to the 5 minutes. So we have a slightly bearish bias. There is already, before the open, pay attention, there's already a liquidity sweep. The last low before that is here. So there's not a clear structure shift, but we have on the 5 minutes, we have bearish fair value gap sitting here. So we might already have set the high before going lower. So I have a bearish bias. I think this is a very nice target. It's London low. And of course, the eventual target that will be the lows right here. So I would have a bearish bias for this day. And now let's wait at the open. Super awesome. So this is the 9:30 explosion profile. You've seen it in part 1 as well. So let's drop to the 1 minute. And maybe we already missed the move. Yeah, I think we maybe missed the move. But look at this. So this, what we're now seeing, confirms like, okay, we want to go lower. Awesome. We have the liquidity sweep, the structure shift. And even here, this candle, 9:30 candle, is that nice wick. That's also a mini liquidity sweep. So we have 1 minute for value gap here. And we have an order block sitting here. There's order block. So I think we should be good. Maybe the next candle, we could even trade another value gap. Yeah. So my entry, if I would trade this, would be here. Right here. It's a very explosive profile, right? London low is already being hit almost. And we have, of course, the lows all the way at the bottom. So last swing high would be my stop for 1 to 2. That does mean if London low is swept and after London low, we're just going higher. That sucks. I'm going to take the loss again. But this would be now my trade idea. Why not be above this high? Could be. But then I think like if price comes back all the way up here, the trade idea for me is already invalidated. So I'm happy to be wrong. So I want to take my my stop loss at the high. If you were going to backtest this yourself and you notice that you have a lot of times you get stopped out before the real move, then you should change your approach a little bit more towards here and be okay with less risk to rewards or just bigger trades. But for now, let's do it like this. See if we can come back to. So we take London low. See that step? Okay. So here, what I do on stream, and you see me doing it as well. I'm not going to go blindly in here because London low has already been taken. I'm going to be a little chicken there. I want to see reaction from this level. This, boom, that's it. That's it. And now we are in. That's the reaction I want to see. So zooming out, liquidity sweep, mark structure shift for value gap 1, for value gap 2 with order blocks. A+ setup. Whatever happens, I love it. I love it. Oh. Cool. You see it? Heartbreaking. Trades taken. 2 losses. We came back one more time to the order book. Look at this. Stopped out by 1 point. So losses are normal. If you see this, like, hey, we now already have for 2 days, like losses are fine. This is why we backtest. We need to learn. So 1 was don't trade when there's no displacement. And 2 is if you get stopped out before the real move, you need to put your stop loss higher or make your stop loss bigger. Done. So we could even make a 3rd column. It's called lessons. I would say lesson 1 was displacement in the range and the other one's bigger stops. Cool, right? So the bias was amazing. The structure was amazing. The execution was not amazing. So you take the loss. And you can see in the Discord, I still have this. So this is for me, for my trading, something I'm always struggling with because I'm still a fancy ICT trader. But ideally then, you would have put your stop loss still at this high, the original high for 1 to 2 like this. And this would be your trade. And I think you would have, you would have had TP. And look at where we stop. Look at where we now stop. Exactly. Let's zoom out. Look at this. Equal lows. So maybe we're not done yet for this trade session. Maybe we can take a continuation lower. And maybe I say, let's do it. So this is a loss. Super nice trade. Super sexy. And I hope your eyes are now also being trained like the model is always there. Like this is May 2024. And we do this still to this day. So I love that. So if you now look at the 5 minutes, I see, let's, like with this naked chart, it's pretty crowded now, but there's let's zoom in a bit. I'm going to put the annotations back in a sec, but there is a fair value gap here, order block with upclose candle. And there's now also here in this area, a fair value gap and order block. That's the point of interest for the continuation trade lower. So let's put back the annotations. So there's a fair value gap right here on the 5 minute being traded into. This is such a sexy structure. Order block. So here, if you've seen the order block videos, there's a pretty big wick. So I'm putting my order block line here. Doesn't really matter. Like this. So what I now want to see for the trade on the 1 minute is price coming back here and give a similar reaction on the 1 minute as we've seen as our trade idea. Remember that's let me zoom in a bit. This reaction we saw on the 1 minute, but I said I'm gonna wait a bit, and we got that wait. Like this was the reaction. Super nice. There's also already a order book sitting here, but ideally we're gonna wait for the 5 minutes bearish value gap to be traded into, like this. And now for this ID to be valid, we need to see now, because there's bullish fair value gaps created. I don't like that. I also explained this in part 1 and also in the secrets videos. I want to see the bullish fair value gaps fading now, because maybe the bias is now already wrong. Almost nothing. Nothing. So we leave an equal low behind. Interesting, right? Cool. So bias was amazing. Execution was not good. Model is there, but stopped out before we move. Let's not cheat. Let's put it back. Yeah, right here. So next time, bigger stop. You hear me say in the past 2-3 weeks on the live chart in what we're doing is in 2026, is that on the higher time frame, it is pretty hard right now. Like not this, of course you see this chart as well, but you hear me say like, hey guys, when you see higher time frame, intermediate time frame, not super clear, you will take more losses, lower time frame. And then you have two choices. One is take less trades, or be okay with just having a lower win rate. At the start of the backtest session, I said, yo, this looks exactly what we have now. Not nice price action. And then now we have 0 out of 2 is completely normal. That's fine. And maybe if we're going to finish the backtest, we're going to have 0 out of 8 and we had a nice losing streak. And then we can say, okay, cool. What did we learn about the backtest? What lessons could we have? We already have 2 amazing lessons. And then it's going to be super fun, because then I can post a YouTube video that says part 2, 0% win rate, and nobody's going to click on it. And they miss out on all these nuggets, because I already explained in the streams about win rates that what is broken in the trading industry is that people think win rate is what you should focus on. Like a 90% win rate will make you profitable. But that is something only the marketing geniuses told you, because win rate is a broken metric for 2 reasons. 1, it is personal. I'm going to make a dedicated video about this, but win rate is personal. That means if we're going to do this the same time, everyone here is going back to May 2024 and does their own trading, same model. We're going to all have different win rates. Maybe you guys have 100%, I have 20%. Cool. Because we have just a little bit different nuances or different entries, or maybe too late. And that's fine. It's a personal metric. So if I post a video, 90% win rate, or the part 1 from this series, 86% win rate, that is my win rate. If you're going to do the same, you're probably not going to have the same. Maybe you're going to have higher, maybe even higher than 86 or lower. Both is fine. Secondly, more important, that's why I love to make this part 2. That's why I said, yo, comment for part 2, because at 86% win rate is just a random metric over a random period of time, and win rate is a changing metric. So this model, every entry model, has losing weeks, losing months, winning quarters. So that means at some months, your win rate of your model is going to be 60, 70, 80. But at some months, it's going to be 10, 20, 30, and you have a losing streak. So when you're now going back on YouTube and trying your next 90% win rate, know that you're a beginner. You're getting fooled. And I'm a slave to the algorithm. I just wanted to test, hey, if I'm going to set a ridiculous number, like 86% win rate, would people click on it? And I hate to say it, it is the most viewed video in the past couple of weeks. Dumb, right? And of course, the video is super valuable. The backtest is super valuable. We're going to do similar right now. But because the
because the title says 86% win rate, I know that's why people clicked. And it breaks my heart because that means they're going to buy more courses without making actual money on the chart. So now you know that. Limiting belief, gone. You now know, don't chase win rates. Chase a model that works for you. I think this model is super beginner friendly and for everyone, like even for advanced traders. And just do it and be okay. And that's why I said, that's why I love that you guys chose this. Maybe we're going to have a 0% win rate and we're going to laugh about this. But then we have lessons. And then we know, okay, cool. Then we're probably in the May 2024, we'd have lost a few accounts. Cool. I think I lost a few accounts, for example, in March 2026. Super hard trade environment. Cool. That's fine. Little losing streak. And there we go. Okay. But no rents anymore because you guys came here for the back test. So let's continue. But I want to give this nuggets in between because I think it's so important that you know that. That's maybe even more important than the back test. Okay, so this was Thursday. Took a loss on the Wednesday because we traded before FOMC. Nice. We shouldn't have done that. So maybe that's also, let's put it at the lesson. Displacement, lower time frame, not before FOMC. I think that's a valid lesson to put on. And of course, we don't do that. But we still have these equal lows. So hopefully before Friday, before the open, we still have these lows sitting here. Thursday, let's go to Friday. Okay, I like this. Did I cheat? Oh no, nice. Oh, it's ADM. Whew. Okay, so before the open, we already have a massive move. Look at this. Like we already traded back into this value gap when London. Remember, the continuation model of this model is when there is a London low created. Oh, and they already took out this high. Remember, that was our high from earlier. Oh, the suckers. But this is nice because then we maybe can try to catch a retracement and then a continuation. And the London low is then probably going to hold. Cool. Let's go to the lower time frame. Yeah. So this, I think this, oh yeah, it's the first Friday of the month. NFP, we know it. So cool. Now we're showing up after NFP. NFP just happened, 8:30, massive candle, first Friday of the month. And it's cool, right? That you can identify news events even when we don't look at Forex Factory, because that's how we build a routine. Okay. So yeah, ideally, just at the open, lower than higher. Monkey sees green candles. Let's just buy a nice trade. Let's go. Let's see how we open. I'm not going to the 4-hour time frame yet. I want to do it close to 10 a.m., but I think we can take a long on this trade idea today. We go a little bit lower because we already traded into that 1-hour bullish for value gap. I think we should be good here. Yeah, so there's not much to rebalance. And then the equal lows is going to stay. Like, okay, cool. Maybe there's an SMT with ES, but the equal lows will probably just be there. 50 minutes, 5 minutes. Yeah, of course, it's just NFP candle. Okay, let's fast forward to the New York Open. So ideally, we first trade lower, then higher. And this looks to me also perhaps like a little accumulation, accumulation here, manipulation into key level, and then higher, like the power of 3. So it's also on the cards here, but this idea. Cool. So let's see. I'm just going to trade higher. I'm not going to take the trade. So if that happens, so be it. Okay. Now we are at 10 a.m. So the 10 a.m. game is activated. Now I want to see what we have on the 4-hour. Oh, wait, I cannot do that yet. 1 sec. Because otherwise, I'm now going to do 4-hour. That's cheating. I'm so sorry. I don't want to cheat. What I mean by that is if I, after 10 a.m., if I then go to the 4-hour, it shows the whole 4-hour candle already. So I could see the bias. I did not. Cool. Let's go to the 4-hour. Oh, it's also a 4-hour busy, guys. Oh. Yeah. Okay. So I think this is high probability 10 a.m. game. So 10 a.m. at the start, accumulate, manipulate into key level, then distribute higher. That's it. That's what we're going to do. So back to the open. Let's just see, wait until after 10. We trade to the key level. That's now. So here, 10 a.m. game is activated. I'm going to look for longs. This looked already interesting. So we have a displacement out of that range. And this for me is going to be the first PD array rule. But because there is a lot more to rebalance, I want to wait for the second PD array rule. If I create now here, trade into, trade higher, one more. And now I'm waiting. I know what I'm doing during stream. I'm now waiting for this candle to be closed over. Then I'm going to take the trades. Low-hanging fruit will be this high. Yeah, that's it. Oh, yeah, okay. This candle's the entry. Let's say late to the party. Stop loss.
Go back to the lesson. Stop big. Big, big, big. That means we need to, I think this swing high is nice to put it on there. We can even do this one. Let's do safe. Let's do super safe. Let's see what happens. Because we had a lesson and this is a random target. Like I don't know what's on the left side here. Let's just see what happens. So what do we have? 10 a.m. game. This box, the yellow box, is an overlapping 5, 15 minutes and 4 hour, and I think also 1 hour bullish fair value gap. So if you have buy structure from there, we waited for PD array 1, and it's already PD array 2, and then we move away from there. I like that. I like that. If we take a loss here and it goes lower, I'm open for a second bullet like this. If you trade a little bit deeper into that, that's fine as well. Cool. Showtime. Trade 3. Lesson. Okay. We're still in. We're still in. Doesn't look good, by the way, but we should already be moved away. Look at the delivery. Horrible. Look at this. And I cannot state this enough, but on the higher time frame and the intermediate term time frame, you're still in difficult price. Actually, it's still consolidating. We have now some displacement higher, so the long idea is super valid, but you see that delivery is still not very sexy. But hey, we are in. We learned from the lesson. Super cool. Let's see if we can trade higher. I need to put because it's futures at the end of the trade day. I need to put it off. So it could also just be a break even or like a small win. Well, win is win, but of course we're not going to cheat and call this a win. So during the YouTube video, I'm gonna cut this. Fast forward cut. Okay, market close almost. So weird delivery, right? Market close is almost right here. Cool. Yeah, market close here. This is a win, but a small one. What do you guys think? Let me know in the chat. Is this a win? Like, I don't see this as a win. It's a small win. It is a win, but I don't know. A win is a TP. Let me know in the chat. Win or not? Win or not? Are we flexible? No TP. I love this. I love this. Cool. So we need to make a second category. Let's just call this. Let's just call this break even. Break even / small win. Cool. Awesome. What I love about this, you're going to see this a lot as well, that you just have no delivery at all. If you're now going for the past couple of weeks, I took these trades a couple of times. And here in Vietnam, that means I stayed up until 5 a.m. looking at these candles. Not fun, but it's normal. Even 2 years later than this price action. So far, first week, this was the first week of May. 3 days. 3 trades, 0 wins, 1 small win, 2 losses. Are you already discouraged? Are you ready to just give up? No, of course not. Because I have hundreds of data points on this. And every single scenario we've already seen the past couple of weeks, which is amazing. What I want to do now during this recording is take like we already 1 hour in. At the 1 hour break, I want to give you guys like, let's say 2 minutes to get something to drink. I'm going to eat this massive banana because I haven't had dinner after my 2 hour practice. But let's do 2 minutes. And then we're going to continue with the new week, second week of May. And of course, let me know if there's questions in the meantime. Stop loss placed on point. Yeah, but that's the thing. Like, when I say during the videos or during the mentorship calls, like if you make a loss, that is completely fine. And if you make a mistake, that's completely fine. But the next time, if you want to learn, is same situation, different behavior. That means in one of the trades, we got stopped up at one point before the real move. I would say you can call it unlucky. I don't believe in unlucky. I believe in execution mistakes. All right. I think we could have put our stop loss higher. You could call it also greed or whatever you want to call it. The name doesn't really matter. But that means the next time a similar situation occurs, and we had that now, if you get stopped out before the real move, and I had that when I started out, when I was not profitable, just put your stop loss bigger. And who cares if you have a lower risk to reward for a couple of weeks, but then you can rake up some more trades. Because how stupid would it be if you would be stopped out again? Like, I would be super tilted. No, not super tilted, but if this again, right? And not tilted because of the loss, but tilted because I already been there, right? You already been there. In the book, Best Loser Wins from Tom Hoogart, there is one, like in most books, also in my videos, the best nuggets are at the end. The biggest wisdoms, the biggest frameworks are at the end of the video. Same for Best Loser Wins. In it, like the last chapter, he says, yeah, I make a PDF. Tom Hoogart, one of the best traders ever. Tom Hoogart.
He says, yo, I have a PowerPoint presentation. And in the PowerPoint presentation, it's like slides with my wins, my patterns in wins and my patterns in losses. And I put lessons there, like for the mistakes I make, I say lesson 1, this, lesson 2, this, with screenshots. If I take winning trades, I put there winner focus or like some, and then also text it, hey, this is why it won. And he calls that his book of truths, the most powerful framework ever on the last pages of the book, where the majority already put down the book and probably took another, just went back to the market and lost again. And the book of truth is so powerful. It helped me as well. And we are basically now, with the lessons here, building our small book of truths. And we only have three trades. And of course, we're not going to sit here all day. So we're not going to have like 30 trades of data. But imagine if you have 100 trades of data. And you have all these lessons. And you can use those lessons to take better trades. Weird, right? You make mistakes, you write them down, you try to make those mistakes not again. And because of that, you take better trades. That is called improvement, intentional improvement. Okay, let's go to the next day. Next week, actually. Next week. Oh, I've cheated. There we go. Let's go to the 4-hour time frame. I remember this price action. Not from this month, but we have this similar. In 2025, this exact structure appeared. So tap 4-hour, probably we have a daily for value gap 2. So now, based on this, we are at Monday. We are zooming out. We have those horrible equal lows here, traumas. We just trade into the daily bearish for value gap and the order block, but I think we can trade back to the highs here. I think we are bullish. We're just going higher. So where is the most obvious place price can go? I would say first here and then higher. And that's then, if I make a weekly outlook this Monday, that's going to be my weekly bias for the week. I'm just waiting for price to trade lower and then do for buy structure. That also means early in the week, I might favor shorts until that level is reached. So I want to first short towards 4-hour bullish or value gap and then long. And I keep repeating this. At this day, I do exactly the same. That's how I make the weekly outlook. That is how I trade. That's how I make my money. Well, let's go. So already we cheated a little bit because we already saw that candle, the first opening candle that went higher. But that's fine. That's fine. Let's fast forward. So ideally, first lower, then higher. If we now trade higher, cool. There's no trade. I'm waiting for down close candles. And I think we can already see that Monday here is a no trade day. We just had consolidation here. Maybe we're gonna, it becomes interesting. We have some, no. So I think we can all agree that this is a no trade day. We just went up only. The higher time frame buys is not okay. So this Monday, no trade. Cool. There's a lesson in that. Maybe Mondays are not the nicest. No, that's not true. Mondays are super clean, but sometimes they're just like this. Most times they're like this. And if they're not, they're clean, like very clean. For Mondays, there's almost no in between. It's or super clean or this. Okay, cool. Then we now have another 4-hour value gap for the next day. So we skip Monday. Monday, no trades. And we're already getting a little bit of a routine. And I know this, guys. We're trying to dance a little bit now. We already know the routine. We know that we go from the higher time frame to the lower time frame. Let's go to the daily finally. Look at this. After Monday, there is a massive daily for value gap created with the order block. Where is price most likely going to go higher from, right? So shorts towards the daily busy, longs from their higher time frame back to all-time high. That is the bias for the week. Cool. Let's go to the next day, to Tuesday. And it also means, very important, if this bias continues, I'm not going to take longs. Like I have weeks where I just am wrong on the bias. I'm not going to chase this price action. I'm going to wait for lower prices first. Yeah, same here. During this day, I think we could have played a 10 AM game here because it's a nice sweep, but like I already seen the 1 hour that I would not have taken this. It's very simple. And I think if we go in the lower time frame, we're going to see the same. Look at the open. Look at how horrible the open is. The open is right here. Consolidation and then random move higher and then lower again. And there's another lesson right here of this no trade, because if you see on the, I'm going to write this down right now so you can put it in your notepad. If the intermediate time frame, this means the 1 and the 4 hour, is not super clean, the lower time frame is going to be even less clean. Period. And we already saw that. I said on a 1 hour, nah, Not for me, because I'm waiting for clear lower prices, and we didn't get that. If the 1 hour is not super clean, which it was not, cool. That means let's go to Wednesday. And maybe we're going to see CPI on Wednesday, because we didn't have a CPI candle yet. So this, you see this price action most of the time before CPI. Maybe it was already here, but I think we can get bear candles. I do see a nice 15-minute sell structure forming, but it's already a market close. So let's go to the next New York Open. So the short move should come soon, right? And maybe we have a news candle coming in. 8 a.m. We have to finally the move, guys. Cool. This is nice. So we had sell structure created before the open during the after hours, which is fine. Like, this is information we're going to use during our trade. Like, we cannot pick bottoms or tops. We just need to trade with what we have. Okay, let's go to the 1 hour. These are the 4 hour bullish fair value gaps. This is the daily fair value gap. So there is so many nice downward targets. I think what would happen based on this, I look at this at the open, I think the 9 a.m. candle is also going to be a candle like this. And then maybe the 10 a.m. game can be played like this. This is what I would predict as one scenario here. Bearish candle, fair value gap like this. If not, the open will already retrace. The New York Open will already retrace. But I think we can get shorts on this price action to the daily bullish fair value gap. So let's go to 15 minutes. We're doing every day the same, guys. We're not going to deviate from our plan. There's a 15-minute bearish fair value gap here. With already an up close candle here. So maybe we're not going back there. Right here. Boom. Okay. This is marked out. So bearish erase towards lower. Then the 5 minutes overlapping 5 minute erase. Well, I think this whole area is an overlapping 5 and 15 minutes for value gap. So let's do 5 plus 15. And then during the open, let's see if we can retrace back into that and then take trades. Cool. Okay. This is nice. So this, when I see this, I'm so happy because let's go over the frameworks. We know that we want to trade lower. We have a lower bias. Before that, we have accumulation, manipulation into the areas we marked out, and we're now waiting for distribution, the AMD, the power of 3. That can happen between 9:30 and 10, the first 30 minutes after the open. That's the FTS model, or the 10 a.m. game, where it's going after 10 a.m. Both is fine. Clear bias. Yeah, the bias good, order flow is good. We have a clear draw on liquidity, and now we just need to wait for on the 1 minute to get our model. And when we get our model, we need to know that we have a big stop. We don't want to get stopped out again. So now let's go to the 1 minute to see if we can find reaction from this. So that means we need to find down close candles. We need to wait for that. I don't see down close candles here. It's now 10 a.m. If we now go to the 5 minutes, we have a lot of fair value gaps here as well. Not sexy for our trade ID, right? We have that 1 hour bullish fair value gap here. So maybe we're going lower first. But for now, it looks like the bias is wrong. And then there will be no trade because here we don't take blindly trades. We wait for a reaction lower. If it doesn't come, cool. Maybe it comes later. But now we are already in the PM session. So it means also here, low probability, clear drawn liquidity, but no trades. Awesome. Monday, no trades because it was consolidating. Tuesday, no trades because we're consolidating. Wednesday, super clear idea, but no entry. Let's go to the next day. If we go to, we still have the same bias. So I think the trade ID we now have is still the same. We even have these 4 hour busies below here, the bullish value gaps. So we're still good. Yeah, at some point, we just do more of the same. Cool. Let's go next day. So this is PM session, and I hope we're not gonna get another Asia push. It's so annoying. I hate waking up and then seeing, or not waking up. I'm in Vietnam, but opening my trading view in the evening, and then when New York starts and everything already happened. I'm like, oh guys, come on, it's so annoying. But we maybe have that. Not here today. Okay, so we just are still in the same range from Wednesday. But I think the bias is still the same. Nothing changed. We have a pretty nice 1 hour structure now, because inside this 1 hour bearish fair value gap, we have something called a turtle soup. That is a sweep of a swing high before continuing lower. It's a high probability high. So it wouldn't surprise me if you can trade lower today. So bias, daily bias is still lower towards, like, low-hanging fruit would even be these 4 hour bullish fair value gaps right here. But ideally, we're going to the daily bullish fair value gap. Okay, then we fast forward to the New York Open. There we go. There we go.
aggressive buys, aggressive sells. We have something here. And yeah, so now at 9:45, we have a 15-minute bearish value gap. This could be the start of our trade idea lower. Finally, let's go to the 5 minutes. Similar, we leave behind equal lows. So it wouldn't surprise me if you from this point are gonna trade lower. Cool. Okay, low-hanging fruit target is here. It's the first 4-hour bullish value gap. If we look at this price action, also in the 5 minutes, I think the stop loss should be like we learn from our mistakes. Hopefully, we cannot do cool fancy stops. We had one mistake. It sucks to make that again. So I think the trade is invalid if it would come here. So then this would be the trade idea. And what do we have then? We have the, before the open, the aggressive buys, aggressive sells. This is a 15-minute fair value gap. And inside that 15-minute fair value gap, we have also aggressive buys, aggressive sells, and like move away from the fair value gap. So I am happy with this trade. I think this is an A setup. Cool. Let's see. Let's see. Another loss. Cool. So 4 losses. No, not 4 losses, 3 losses. And if you then go back, this is what I do when I take a loss. The day before this recording, I took a similar loss where I took a short and it just went higher, like poof, poof. But super nice setup. And the question you should ask yourself when you take losses is, and my students here, you know, I'm gonna say already, would I take this trade tomorrow again? That's such a nice question to ask yourself. For this one, 100%. So it's an honest loss. It's good. Because look at what we had before we took the, and I think I remember this trade. I think I took, I'm almost certain I took this trade in May 2024. Like this. Look at how sexy the rejection is from the 15 minutes bullish value gap here. So would I take this trade tomorrow again? Yeah, cool. Next day. And while I'm fast forward, let me share some nuggets. Is you will have this too, where you go to a month and you just take trades and nothing works. Or nothing works. We take fucking 4 trades, but I hope you get my point. Like we're spending a lot of time on 4 trades because I want to share every single step and nuance of the model. But if you then have 4 trades, 3 losses, 1 small win, you're like, oh, this model is probably not working anymore, right? The whole self-talk is super annoying. But it's a lie. It's a lie. We are 3 trades in, 4 trades in, but the only thing that you are in is time. Nice sweep here. You lose time here. And you feel like, oh, it's probably not worth it, but it is worth it. It's so worth it doing this. You training your eyes to find setups. By now, should we reconsider? That's the question I ask myself when I have this. When I take some shorts, but I get stopped out. And it's funny actually because our small win from earlier. Look at how clean TP that went later. I see now. Well, is the bias wrong here? I would say it's still good. The bias would be still good. So let's see at 9 a.m. I want to see the 4-hour right now. Because if you're just leaving this all behind, yeah, it could just be that we're gonna leave, or maybe for some nice flash crash, first lower then higher. But the market is super bullish. You're not sure what happened here in 2024, but now low-hanging fruit would just be this high, right? At some point, my bias is just gonna be, yeah, let's just not be fancy and let's just continue with the trend, right? Instead of trying to catch your trades and then higher. So for this trading day, when I see this at the open, I would love to trade there. I'm probably going to get a 10 AM game here. So then my eyes would go to a continuation higher. So at the open, or before the open with aggressive buys, aggressive sells, we have an order block sitting here. This is nice. So then the order block, I want to see, do we create buy structure to here? We're just continuing, not finding the trend anymore. So this is the bias. Cool. Let's go to the lower time frame to see, do we get reaction from there? Also check if we have nice overlapping on the 5 minute. Yes, a small 5 minute for value gap here as well and here as well. So could be nice. Cool. So let's see, do we get, and it's also 10 AM game, do we get aggressive sells, aggressive buys? And if not, also, we could start the sell idea. So for now, doesn't look like higher. Cool. Then that 15 minutes idea is off the table. But now this one changes teams. Inversion for value gap. Inversion for value gap, bearish order block. If you know what a breaker is, bearish breaker. So now this becomes the idea all of a sudden.
So let's see. Do we trade into this fair value gap, and trade lower? If we trade lower, where to? Session lows. So that would be midnight low here, but then would be the lows right here. This candle did not close yet, did it? Now it closes. Not sure, it was a little bug in my trading view. Cool. So now, short idea is still on the table. I would not be in here. The model's not here yet. Not sure what happened with the candles. The candles are a little buggy here. Let's see. There we go. Cool. So aggressive buys, aggressive sells, inversion for value gap, order block, and then on the 5 minutes we see more as well. See if we can get some. I want to see. We're at 11, but I want to see more down close candles coming in. Ideally from here. Yeah, from here. But it's already PM session. So here as well, I was looking for a long, did not come. Cool. Then I wait for the short, did also not come. And then, well, we didn't do actually anything this day. So I think this is a pretty nice save that we didn't take a loss, because there would be a loss in both ways. If we took the long, it was a loss. If we took the short, it was also a loss because it did not move, or a small win or whatever. Cool. So no trade there. Cool. Let me know if there's questions. I see one question. Did we wait for the second PD array in the last trade? Then go back to this one. So in this case, let me go back here. It was the short. So in this case, I did not wait for the first PD array. I waited for value gap 1, this PD array 1, to be traded into and moved away from, like this. Why do I now not wait for the second PD array? Is because this is more of a reaction time frame, because the original idea is just from the 50 minutes internal range liquidity lower. That's already the whole idea. If that's my idea, if I then see this on the lower time frame, I think the same trade was 2 Fridays ago. We took also a similar short where there's a 50 minutes bearish value gap, and I'm just waiting for the 1 PD array inside that idea. So you could even say that the 15-minute bearish value gap was like the test, and then this reaction is like the second PD array, like the confirmation, basically. Let me know if that makes sense. Cool. Well, it's not a very exciting back test session so far, which is good. Cool. There we go. Okay. We are now. Oh, it was already the trade week. Cool. So trade week, pretty boring, right? Pretty boring. If you look at the weekly profile, I think we did amazing. There was no weekly profile here. It was a Wednesday low of the week at 8 a.m. Small range, consolidating most of the time. This is amazing that we managed in this week to just take one trade, one loss. I think it's pretty impressive. Same if you review your trades from, for example, last week. You look at the 1 hour, the 4 hour, and you see it ranging, and you're like, oh, that's pretty decent. Or you took so many losses and you blew some accounts, and you do the same. You're like, oh, that is why there was no follow through on bullish or bearish ideas. That is called lower probability environments. Cool. That's normal. Like, you will have months like that. This is fine. I try to normalize this. It's not always fancy and fast. I wish it would be so nice. When this happens, for example, when there's a lower time frame, not super nice on NASDAQ, I just go to other assets, gold, forex pairs, to look for something sexy. If you now look, for example, at the dollar pairs in 2026, that's super sexy. No. If you then look, for example, at the gold or NASDAQ, there were very nice trades. Not always, but you should be able to do this same trick pony on other pairs. Cool. Next week. Oh, I'm cheating again. Am I? No, I'm not cheating. It's exactly 8. Never mind. Boom. Okay. Before I do that, let's go back to Friday, because we need to take a look again at the higher time frame. Is there something we missed? Because we were waiting for the daily bullish value gap. Remember that weekly bias, where I was waiting for price to come first lower than higher, did not come. I was waiting for this. Did not come. Cool. So then it's Monday again. And when it's Monday, there needs to be a weekly outlook. Cool. Let's make the weekly outlook right now. I think the weekly outlook is pretty obvious. It's pretty obvious. One is, and it's something I missed here, there's another daily bullish value gap. Do I see it correctly? Yeah, daily bullish value gap. It's a little crowded here because of all the arrays, but cool. Missed this. So the low of the week, and it's a very funny miss, was in the delivery was horrible, but the low of the week was in a daily bullish value gap. Cool. We trade away from that, making the down close candle a order block. I take the wick. Again, if you've seen the order block secrets video, when there's a small body, big wick, I take the wick. And there is a clean high here, or multiple clean highs. So it's going to be the point of interest for this trade week. And that's what we're going to do into Monday. Monday, lower expectations because it's a Monday. We're still just going to look for trades. This is Friday. Let's go to, this is London. Okay. So here, there is a potential 4-hour bullish fair value gap created, potentially, because I know that there's a little bug here in this trading view that it doesn't, but it's cleaner. So this green line is becoming more messy, of course, because we have more lines and we need to remove some stuff, but this is the daily bullish order block. It's a 1 hour. This is a nice point of interest for a low, because we leave the Friday high intact, because we already moved away from this daily bullish fair value gap. So how nice would it be if you could trade today something like this? Let's wait closer to the open. Let's see if that's still the case. Okay. This looks nice, right? So at 9:30, like we have that idea that maybe from the 1 hour bullish fair value gap, and I also see that there's a 50 minutes bullish fair value gap, we could trade higher. I like this. To then just trade towards the highs here. What we need for that is not, of course, a bearish fair value gap. That's not nice for a bearish idea. But we're still going to look for, do we create bullish structure? At the open, massive. Like I think that because this 2 years ago, the candles are not loading anymore, but this probably just these were candles or maybe fair value gaps. Let's see what we have. So we trade away from that level, not super aggressive. A quick tip here. When it's not super aggressive, remember this one, displacement lower time frame, could be tricky here. This could be come back now in this trade. They want the lessons. On the 5 minute, there's a small 5 minute bullish fair value gap sitting here. Let's see if we trade higher. Oh, we tap into that. That's nice. Let's see if we move away from that. And I'm chilling on the 5 minute here, guys. I'm just waiting. Okay, not nice. Not nice. We need to trade higher. Not still not. Oh no, we have a consolidation again. Oh no. Okay, nice. 11. Okay, good enough. No. Guys, why did you pick this month? This is not fun. Okay, this is Monday price action. Okay. Oh, another low here. And we already, okay. So, conclusion, Monday, would you trade this? Nah, right? So no trade. Cool. This looks like PM model, by the way. This looks like PM. Like if you now look here, let's demo trade. Like this is not going to be for the stats, but this looks like PM model. If you now displace higher, for value 1. Oh no, we Monday. So this is how I see. This is a very nice example for your notes, and you can also, or when you watch this video on YouTube, you can pause the video and just screenshot this. Because when I say on Discord or on socials, like, yo, Monday could be low probability, this is what I mean. It's not that all Mondays are bad, but this is what Monday I have in my head. Like, hey, Monday is just not super nice. That is why I don't stream on Monday, because I'm just expecting this. If it doesn't come and it's nice, of course, nice. Thank you for the money. But I'm just expecting this. That's why I don't stream. Cool. Next day. So far in May, it's already May 14th and only 4 trades taken. I think it's pretty impressive that we are navigating lower probability price action like this. So we're doing almost the opposite of the part 1, where we had like a nice win streak, where we were navigating high probability price action. Now we are navigating low probability price action with a pretty decent result. And $3 doesn't sound like a decent result, but it can be really worse if you are just wanting to force trades in these environments. Trust me, I did that before when I was not profitable. Okay. Oh, okay. I think this is news. Do you guys agree? Would this be news? An ADM candle that looks like this? I think this is CPI. I'm almost sure it's CPI. But that is the sweep we love to see, because this could be the sweep that trades us higher. Because we already were at the daily bullish value gap. We already moved away from there. We don't need to trade lower. So a liquidity sweep here. And then higher, so aggressive bias. This one big wick. Yeah, so at the open, I'm curious. I would have a higher bias. So here's the nice sweep into the daily order block. Now I have 5 minute bullish value gap here. See if we trade higher from there. Yeah. If you go to the 15-minute time frame, it's probably always yeah. So sexy. Okay. So now we have a massive order block. I'm not sure why the candle's not here. I think it's because of the news, but this is the order block in total. We have an overlapping, also a fair value gap sitting here. So let's just pretend this is an overlapping fair value gap and order block. Super big sweep, probably CPI sweep. And then for 10 AM game, what I'm now going to play is, do we move away bullish from this area? So then the trade idea is going to be like this. Let's see. Oh, the 15 minute candle did not close yet. So let's just wait a bit until 10. Why is it doing it to me all the time? Yeah, there's not even a 15 minute value gap. What is this? Okay, there we go. There we go. This is what we were already expecting, but I was a little late to the party. So then I would love to take my trade from here. Stop below the swing low, and that means we need to put our TP a little higher. But I would say this is the trade. So we have a liquidity sweep, structure shift, fair value gap 1, and this fair value gap 2. Showtime. Okay, so now we have the high. This sucks because this is a nice example of what I say, like you want to be in, so your stop need to be in the right place. And again, look at where price came back to. That's fine. Let's roll down. That's fine. But now we have an awkward scenario where the target, the weekly target, is already hit. So ideally, what you could do is just put your TP here, but then your risk to reward is a 1, 2, 1, 3, which is low. But you rake in wins. I talk about this in my story video where I talk about how I became profitable in 2.5 years. This is what I did at the start when I was just wanted to rake in the wins. Not per se making a lot of money, but just getting confident on my model. Like, hey, it works. And you see it here as well. It just works. But no, we said we're just going to do this. Bigger stop, 1 to 2. And just let's see what happens. Oh, it's the market close already. So I would say, is the small win, big win? Let me know in the chat, guys. Is this a win or a small win? You guys decide. Big win, small win. I would agree because it's not a full TP. Take this a win. Yeah, but like the thing is, if we would say this is a win, but then the next trade we take a full TP, then this trade still feels a little bit like cheating, right? Like I think after 5 trades, we crave a big full TP, of course, but I think we need to be strict here and just take it as a small win. It's a bigger small win. It's a medium sized win, just like you have a whatever McDonald's medium fries. Yeah, but I'm gonna be I'm gonna be strict here, and let's do it as a small win, because then we can celebrate more when it's a full TP. But again, like what I hope to message here is that the win is not the biggest factor here. The win is seeing the fucking model in real time before the candles print. Liquidity sweep, market structure shift, fair value gap 1 and 2. Result is irrelevant in this small data set. We're literally doing like 2 weeks of backtesting. What if you're going to do a year of backtesting? Then you have, of course, more data. And what we did very well here is the alternative of this trade would be that we put our TP here, but put our stop loss in a place that would give us a 1 to 2. But we did at the start, the first mistake. And then we would have been in here again. And we learned from our mistake. So instead of getting stopped out before the real move, we got ourselves a small win. And learning from your mistakes you made earlier is a super big win in your trading in the long run. So I'm proud of that. You should be proud of that because we're building our book of truths here. Okay, next day. So let's do this week and let's see what happens. Like whatever result happens, maybe you're gonna get a backtest with 0 wins. Be fine. But let's go to the next day. Okay, so because of that expansion, I think our bias is pretty nice that we could have this Tuesday as a low of the week. I don't want to say that too loud, of course, no, but you have the classic accumulation on Monday, then Tuesday manipulation, and then distribution starts the rest of the week. That's what I have as a bias right now for the rest of the week. So I'm going to be slightly bullish towards all these highs here. Let's see it's important how we move away from here. Yeah, I think we just can play continuations here. Overlapping 1 and 4 hour fair value gap. During London being traded into. Consolidation. Oh, I was like, did I cheat? No. News. Yeah, say me what news this is, but it is news. And it's fine. We need to trade with what we have. And it means at the New York Open, I'm going to consider, this is a sweep, potentially SMT, but there's equal lows here. But I think this is an SMT with ES, probably. But this could be an area of interest. But of course, this gigantic fair value gap is going to be the point of interest for longs. So during the open, 2 candles later, let's wait for price to basically do this. If it doesn't do that, by the way, it's going to give nice sell structure, because then it gives like this whole up close candle becomes an order block to trade lower. But for now, we're just going to trade with the trend like we always do. So that means around 10 a.m. or at around the open, actually. It's right now. Trade into it. Oh, I'm going too fast. I'm going too fast. I'm cheating, but we need to at the open at the fair value gap. I'm so sorry, guys, but I need to redo this, because we wait for aggressive buys or aggressive sells, aggressive buys like this. So now we have a bearish fair value gap that got disrespected. It's an inversion fair value gap. There's a bullish fair value gap that got respected, and we move away from there. Looks interesting. Another fair value gap. I think that's enough. So stop ideally below the low, right? Target a 1 to 2. Because in an ideal scenario, if you want to scalp this, your TP is just here and your stop here. We can do both and see what happens. But I don't like this trade. Like, this is not the model. This is too small for my model. This is like scalping territory, 20 pips. But let's just put it here for. But ideally, this is the trade I want to take for the backtest. Because it's so big, I am open to put it below this order book here and if you value gap here. It's going to be risky, but I'm open for that. Like this. If it gets stopped out, I'm open for a second bullet, same like that. Cool. Showtime. Trade 6. We got it. Let's go. We got it. Trade 6. Full TP. Full TP. Imagine watching this video and you're an hour and a half in and you're just waiting for that loser who finally takes the win. But we got it. We got it. We got it. Let's go. Boom. Trades taken. 6. 1 win. Boom. Super high win rate. Let's go. Okay, but this is cool. And what I'm hoping also trying to just give you is we do everything the same. This is consistency. Executing something consistently. 6 trades, 1 win, 2 small wins. Don't forget that. 2 small wins and 3 losses. Pretty decent, right? And the small win was the first one was like 0.2 R, or maybe like a half, maybe. And the other one was like 60%. So it's not too shabby. Not too shabby. Okay, done. Next day. For me to not clear displays, I wouldn't have taken it. Okay, cool. I think this is amazing. I'm gonna add this in the video. I'm gonna add this in the video. This is amazing. Okay, let's go back to the video. One of the questions I got from my students here is, I wouldn't have taken this because there was no clear displacement. And we, of course, had that first lesson from earlier, like there needs to be more displacement on the higher time frame. And how I see displacement is fair value gaps. And there is actually 2 fair value gaps here. 1 to any inverse fair value gap. So displacement, how I see that, and the framework I can give you here is I'm looking at 2 things. One is, of course, the obvious fair value gap, but also supporting the aggressive sells, aggressive buys. And there's the inversion fair value gap. Plays a big role in that. Last year, I started using the inversion fair value gap more as an extra confluence to see like, okay, we not only have the fair value gaps, but there's an extra confluence present here as well. And that's why for me it was enough. Even I agree, because especially the candles down here are not super clean, 100%. But remember the idea where we are in, like we are in a 1 minute, very zoomed in, but we are in a 15-minute bullish fair value gap where we just wanted to take longs from. So inside that we have inversion fair value gap 1, fair value gap 2. That's enough. Also, and if we compare this to the first trade, this wasn't there. There was no inversion fair value gap and 2 very obvious fair value gaps. It was not clean enough. But it's always a balancing game. It's always a balancing game. But this is enough to take. Okay, let's go to Thursday. Okay, cool. So we displace higher. Wow. A bull run incoming. Oh yeah, look at this. We're at 18K. 2 years later. Yeah, you're hilarious. Okay. I think we're going to have an easy day on Thursday. Yeah. And with easy, I mean, we want to take longs, but we could also first take shorts. Like we can be fancy today. We can ping pong. Because I think we can agree on 4 hour, we're going to do this. So depending on how we open on the lower time frame, if you zoom in on this is the higher time frame bias. But let's say the open is more like this. Like this. Then I'm open to take a short towards the fair value gap. Lower time frame, and then long again. And then you're basically trading the retracement before the move higher. So let's go to the New York Open. I'm going to make this a massive 4-hour fair value gap. Overlapping 1-hour fair value gaps here as well. During Asia, we already have a little bit. Let's see how we open. You consolidate, that is nice. We want that. Consolidation before the open. This makes, if you see this before the open, I love that. Because then you have your accumulation, manipulation, distribution idea. There is literally buyers and sellers in the market before the open. And then the open is probably going to be an energetic move and a reversal, like we want in our model. 7, 8 a.m. Hey, what do we do? Surprise, surprise. Are we trading lower? Who would have thought? So, cool. So if you first trading lower, that's fine. I want to take longs after. Let's go to the open. This is 9:30. Yeah, so I'm first eyeing the short idea. I'm not too fan of the short idea. I think we can go lower, but I would not have taken this. Yes, I see the sweep here from 8:30. Maybe if I zoom in a little bit more, we can find a cleaner entry. No. I don't like the structure for a short. So I'm going to wait for price to sell off and then wait for buy structure, which did not come. Oh, and I made a backtest mistake here. I did not look at the 4-hour time frame. The 4-hour fair value gap was not marked out. Good. So whatever happens, this is not going to count as the win because we know the outcome now. But we trade back into the massive 4-hour fair value gap, which was different now. Let's go to the 1 hour. And again, hindsight, so it doesn't count. But I want to see, what's the model there? Like, I don't like cheating. And maybe we can even take a trade here. After. But first, let's see if we could have taken a trade here. And if we did not do, then I'm going to see, could we have taken a trade here and then go higher and from the 1 hour fair value gap. So 2 trade IDs here, a little bit cheating, but so be it. That's 5 minutes. Cool. So we trade here into the fair value gap here. There is no, remember what I said about the displacement in the question? There is no inversion fair value gap here. I don't like that too much. But then when we do this at 10 a.m., this looks more like 10 a.m. game material. Accumulation, manipulate distribution, but also here, no, I would have probably not be in this trade. Shallow fair value gaps, not clean delivery. I probably would have missed this one. See, in a 5 minutes, if I could have an entry. Oh, 5 minutes is super sexy. Yeah, but no, I cannot say with integrity that I would have taken this trade. So let's call this trade missed. Nice fair value gaps here. And let's see, based on this, we just missed this complete move. Let's say hypothetically, could we take another trade? There's a 15-minute bullish fair value gap here. So now there's no hindsight anymore. Now we're just going to catch the retracement. I think also in the 1 hour, there was one created. Yeah. So we have an overlapping 50-minute and 1 hour fair value gap here. And then the bias is this. Also an order block sitting here. Order block. Cool. So let's wait. For price to trade lower. We do. Hey, this looks like a trade idea, guys. So inside the order block and fair value gap, we now have structure. So then the question about fair value gap 1 and 2 again. We had earlier, like, hey, why would you now only take one PD array and why not wait for the second PD array? Because this first PD array is inside the 1 hour and 50 minutes bullish PD arrays. So there's already I'm waiting for this, the lower time for confirmation in the original idea. So I would be interested in taking this. Stop below the low, because we know how good stops we need to take for 1 to 2. Let's see. Showtime. I'm in here in this, tending to be higher like this. Okay, showtime. Trade 7. Nope. And we trade lower. Cool. I would have taken this trade. So it's fine. So trade 7, loss. Cool. We zoom out again. Yeah, we just started consolidating inside this fair value gap. And we didn't even go higher. So honest loss, that's fine. And we're probably seeing a obvious high being printed now, which gives us nice information for the next trade day, which is going to be the last one. Last trade day, guys, before we're going to wrap it up and go over the conclusions of our backtest session together. Cool. So that long idea was wrong, which is fine. And now we're trading lower, but we're still Let me go back to Thursday again, and I want to show the daily time frame now. There's now a massive daily bullish fair value gap created. And I think we are going to use that, right? So, and it's massive. So it's harder to find a level because it's so big, but it's probably what we're going to do. In that fair value gap, we have 4-hour bullish fair value gaps. So these are the areas for price. So the bias is going to be higher. But the question is where higher from? How deep are we going to retrace? And that answer is going to be very simple because it's going to wait. What do we have at the New York Open on let's see if the 4-hour fair value gap is still there. Yeah, it's still there. That's nice. Okay, so now we consolidate. We take liquidity on the downside and the upside. So there's nothing here in this range. Let's go to 8 a.m. And then at the open, we start to move. The highs here at 845. This is a London low. So both could be taken. There's no entry here. There's no model here. And my apologies for all the boxes. It's a lot. These are the 4-hour bullish fair value gaps. And this the daily fair value gap. But inside this range, it's not super clean. So the lower time is not super nice. So I'm waiting. This could be an SMT here. And we're now already at 11. I think there's going to be no trade day. And we are at PM session. Oh, look at this. No trade day. And also, screenshot this. Because if we trading this live, please pay attention. If we trade this live and we see this range, and we see that bullish fair value gaps and bearish fair value gaps are not being followed through. You see this sometimes multiple sessions per week. Majority of the week, it's at least one session that looks like this. Then you can anticipate it. Then you have a nice trade idea that just doesn't work out today. Awesome. It's so nice. Because then you can save yourself from losses and you can say to yourself, oh, this sucks. I cannot press the button today. Let's come back tomorrow. Because let's say you would have traded this live. And you were like, okay, London low is going to hold. This is a liquidity sweep. And then we trade higher. But how we trade higher, remember one of the lessons, there's no clear displacement here. Not very true. There's a little balanced price range here. But the only thing, but this move here should not come that deep, right? And if that was the move, then it should have moved away from this bullish fair value gap. Then it would just moved here and higher. But we don't, which is fine. Maybe we then trade lower. So that means bearish fair value gaps should then be created like this for then price to trade lower. Do we do that? A little bit, but we don't even take out a short-term low here. And then you know that you have, it's called seek and destroy, that you have low probability condition on your hand. And you just save yourself from a loss. Another lesson. So we are now in May 17th. That means we have, with the weekend, probably we had like 10-ish trade days, 12 maybe. 7 trades taken. 7 trades taken, 1 win, 2 small wins. There's no break even. So we can remove this, like small win. And 4 losses. That means the official win rate is, gonna go grab my calculator now. Win rate, 14%. It's gonna be such a fun YouTube title. 14% win rate. And but win rate is not the only metric we need to calculate here. 14%. Okay, because 7 trades taken, that means the win is +2. Loss is -4. So the result, the net result is -2. If you take the small wins into account, I think we can be closer to -1. Close to -1. I don't think there will be any course seller in the world who's going to say, buy my 14% win rate entry model. But for me, the most important part about trading is making fucking money. And if I don't make money, I want to lose as little as I can. So if I now say to you, I have a 14% win rate, you're going to laugh in my face and you think I'm going to lose all my life savings. But we traded the same model every single day for almost 2 weeks. We took 7 trades, only 1 win, but we still have such a small loss. This is not even losing a challenge because we did not have a big losing streak. So you have a 14% win rate, a very hard 2 trade weeks, and you not even lose an account. And then you see so many people failing prop firm challenges, blowing accounts, blowing life savings. Do you still believe that win rate is the only metric? I hope to break that. and I hope this video is going to be shown to a lot of people, that if you search win rate, you will lose, because it's personal. It is also it's a faulty metric, because we just took a lot of losses, but at the end of the day, we lost almost nothing. Pretty cool. Pretty cool. And I'm very happy, and I'm very excited that you guys have been with me. And I see in the chat now, yeah, you had your 86% in the previous video, now 40. This is exact 100. This is so cool. I'm gonna use this. So yeah, guys. So if you watch part 1 and 2, yeah, I have 100% win rate. No, amazing. Like if you're gonna now backtest June or July, maybe the win rate is gonna be 30 or 40, or maybe another outlier to 86, which is all good. You should calculate the rest. So the wins, how many were the wins? The losses, how many were the losses? There's where you make your money. And we did super consistent. All the entries were the same. We made even 3 lessons. Like, hey, we could maybe add some nuances to our execution here with the displays with a lower time frame, where we need to wait for not trading before big news events. Of course, during this backtest, we didn't look at news events, but we saw that we got stopped out in one trade, and then in the PM session, FOMC came and took out or trade towards the P points. And we had one loss, which could be a very sexy win if you not get stopped out by 1 point. Cool, that's a lesson. Bigger stop, and we did that in the next trades. And because we had a bigger stop, also bigger TP, that means the small wins. That's a curse from that. That you will have days where you just have a small win, not a TP. But if that makes sure that we don't lose as much, because losing sucks. I'd rather have a small win than a loss, right? It's worth it. A nice lesson. Write it down. And this is how you should backtest yourself as well. You're going to have months where you have 14% win rate, some 86, some 50. It doesn't matter. How much did you win or lose? If it's a losing week, losing month, like these are 2 losing weeks, cool. But how much you actually lose? Not a lot, which is amazing. Because it means if you're going to have some win streaks where the +2s are going to stack on top of each other, all of a sudden you are up like +10 or +15, and you're like, oh, trading is the easiest thing in the world. But then you also watch this video and you see, hey, not everything, not every week is nice. And I said it before, the current market conditions, as I'm recording April 2026, are pretty hard. Pretty hard. I'm not the only one who I talked to a lot of traders. They're like, what is happening? It's weird. And not only ICT traders, supply and demand traders, support and resistance traders, everyone, when there's a lot of stuff going on in the world, the market is just harder. Does it mean we're going to change our model? No. Does it mean we're going to risk less or we're going to do funny stuff? No. We can execute the exact same trades the exact same way, and we are okay, and we just accept to just take more losses. If you cannot handle those losses, cool. Then take less trades or don't trade. Stay out of the market. But I'm okay with just executing this model, even in harder conditions, and see what happens. Let the data build. Who cares if I have a 14% win rate? I don't. I'm super happy that in a 2 losing week, I only lost -2 or -1. So nice. So nice. I'm happy with that. And this is hopefully how you can approach trading as well, because I know a lot of traders, if they lose, they lose 86%, like a 40% win rate, they would feel like a failure, feel like a loser. Trading doesn't win. How can that Dion guy have an 86% win rate and I have a 14% win rate? No. Doesn't work like that. It's normal. It is just normal. It's a normal part of trading. And that's why when I work one-on-one with people, my first test with them is, let's build data. Let's do this a lot and see what happens, just to see how you react in losing weeks, losing streaks, winning streaks, winning weeks, and see that both sides of that spectrum is super normal. Awesome. Cool. And I hope you also see that how we traded now in May 2024 is the exact same way how we trade in April 2026 or March 2026. I hope it's inspiring. I've been doing this for so long. I've strategy hopped for so long, but this works. This works. And if you have a slightly different model, that works too. As long as you do this, just head down. And I hope you also now see, this is a very raw video. I like creating these raw videos. You see that it is all real. There are no magic indicators. It's just you predicting the market, right or wrong, that's your edge, and hope for the best. That's what speculating is. And you will have win streaks, losing streaks, but normalizing it. Because I know one of the mentorship exercises is that very big data building exercise, which is horrible. I know that. Like, it's super annoying. But it's the only way, in my opinion, how you can train your eyes on your model. And you know, okay, it's probably going to happen or not. We saw some very nice situations already in this video where we already considered like, oh, nice, lower probability conditions, but you're not going to trade. You're just going to skip this day. And now you can use that same knowledge. Well, we did it today with NFP and the Eastern weekend. But also next week, if you're going to see this price action, I'm going to refer to today and say, yo, remember the backtest? We now know. And when I say, guys, I'm probably not going to trade, you now know. It's not because I have my crystal ball is working again. No, it's very simple. It's consolidating. Look, for example, like I see someone here in the audience who trades crypto a lot, and we have a chat today. And I said, your higher time frame of your crypto looks fucking horrible. There is no even a point in executing lower time frame then. So you have two choices: not trade that, or try to use your same model on different assets. So if you, for example, like trading Bitcoin, gold moves similar, NASDAQ looks similar, the DEX moves similar. So you can try to build data on that. If you trade the dollar pairs currently, it's pretty hard to trade. Cool. Then try to, when you know it's lower probability, you know your lower time frame is not going to be hard, but you still want to push some buttons because you don't want to sit still for another 2 weeks, right? So then you're just like, okay, can I use my model on different assets? Not forcing trades, but just filtering. Like, hey, can I use this on the cat pairs or on the NASDAQ or the S or the YM or the Dow Jones? Or that's the same on the DEX, on the UK 100. Yeah, you cannot diversifying or just expanding. And it doesn't mean you're going to force a lot of trades. No, you're just going to look at the rest of the assets. If you want to know the assets, like I can put them here on the screen as well. On the right side, probably my camera is now going to be in in that screen, but I can remove this by now as well. Boom, right here. So you have the indices. Wait, I think I can make this bigger. There we go. You have the indices, NASDAQ, ESYM, the DAX, UK 100, the dollar pairs, the NCD pairs, the AUD pairs, the CAD pairs, GHF, JPY, gold, silver, oil, crypto. I don't believe that if on your favorite asset it doesn't work for now because it's just consolidating and doesn't look nice, I don't believe if you go through the whole list that you cannot find your model on a different asset sometime per week. So that means if you recently did not take a lot of trades because it was not nice, then this is your focus point for in a trade weekend. Just go to this chart, do what we do today. Just go for a few weeks and see, hey, would it be there? If I would trade this, would it be there? And let it be confidence, proof that you can do that next week as well. Put it on your list. I want to trade the DAX right now, the German index, or I want to trade gold right now because I have now proof that it also happens on this asset, my model. And then go. You just expand your trade skill. And no, I don't trade all these this whole list. I use it as a watch list. I teach you guys how to make a weekly outlook. Most weeks, my trade pairs are the same. Like it's mainly NASDAQ and gold, the dollar pairs. So sometimes something else like a JPY pair or CAD pairs, but it's like 10% of the trades. Majority is 10 EM game, an FTS model on NASDAQ. Gold is super clean as well on that. So and the dollar pairs too. It's nice, and the DEX is nice. So cool. All right. I hope you enjoyed, guys. Very cool that we had this insane long session, 2 hours and 15 minutes by now, where we go over so much. Well, I'm going to spend the rest of my weekend to edit this, but I hope you enjoyed. I hope you enjoyed that. I hope you enjoyed how real it is. I hope you enjoyed the nuggets, the thought processes, but also the reactions to losses. That is fucking normal. You're going to lose a lot. And that's okay. If you have a 50% win rate, you're going to lose 50 out of your 100 trades, and they come in sequences. That's what you see here. It's normal. It's fine. Cool. Awesome, guys. I hope you have an amazing rest of your Friday. The market is close to closing already because of the holiday weekend. So don't open your trading view, please. Don't trade. You know better. Nice backtesting session. We can do this more often if you guys are open to that. But I think for now we have a lot to chew on, to process, and it's gonna be banger of a video. And the comments, I already am so excited for the comments, guys. Oh, you sell mentorship and you have a 14% win rate. I'm sure it's gonna come, and that's okay. It's okay. And then we're gonna get thick, juicy payouts, and people are like, "Oh yeah, the Dion Trades 14% win rate, and then another 10K payout, and then oh, because then they haven't listened to my rant about win rates. I should just make a video about the scam of win rate or something, or what course sellers are not telling you, some cool clickbait, and then just tell that, because now you guys know better. The win rate is a faulty metric.
99% of traders lose money, and it's not because of their strategy. It's because they refuse to do the boring work. Today, I'm going to show you the easiest NASDAQ scalping model I've ever used. And I'm going to backtest it live in a random month so you can see it for yourself. But here's the thing, the backtest is the video. So make sure you not only write down the exact model, but stick to the end so you understand the exact ins and outs of the model so you can copy and paste it into your own trading as soon as today. No time to waste, let's get into the video. These are the rules of the model. Before 9:30 a.m. EST, mark out the most obvious points of liquidity. And don't overcomplicate this. Obvious points of liquidity are old highs and lows and fair value gaps on the higher time frame. So at all times, make sure you have them on the 1 hour, the 4 hour, daily, weekly, monthly. You have your fair value gaps and old highs and lows on your charts. And the goal is to trade towards those obvious points of liquidity or trade from it. And when we have the obvious points of liquidity, buy side and sell side liquidity, what we want to see at 9:30 a.m. EST after the open, not before, is a liquidity sweep. So a liquidity sweep taking out one of the two liquidity pools. In this example, is a sell side liquidity pool. And after we take the liquidity, we want to see displacement. Displacement is a fancy term for a big one-sided move. So if we sweep liquidity on the downside, we want displacement in the other direction, in the upside, with a market structure shift or a change in the state of delivery. Market structure shift is when the last swing high, that's this blue dot right here, is being violated. So that's right here. Here's where the market structure shift happened. For the entry in that displacement move, there will be multiple confluences, PD arrays created. That can be a fair value gap, can be inversion fair value gap, that can be an order block, breaker. There are many different PD arrays, the ICT concepts you can use here. I use the fair value gap and the order block for my entries and use the inversion fair value gap as an extra confirmation. So the inversion fair value gap is when the bearish fair value gap from this side of the move is disrespected. Inversion fair value gap. The fair value gap is most likely created here. And at the point of the market structure shift, the last down close candle that swept liquidity is a high probability bullish order block. So in this area is where I'm gonna look for longs. Stop below the low for a 1 to 2. We don't need to catch the whole range. We could, but just shoot base hits for 1 to 2. And if you shoot 1 to 2s with a 40% win rate, you are profitable. So don't make it too fancy. Just make your money and leave. Bonus points for the highest win rate. Wait for the second PD array rule. And what the second PD array rule means is that you use this first area as a test of your trade idea. So you're not getting in, but you're waiting. Do we see reaction from here? And this is to avoid being faked out, because maybe that displacement move on the lower time frame, this structure is on the 1 minute time frame, but maybe on the 50 minute or the 1 hour, this was just a retracement into a higher time frame bearish value gap, and we just go lower. So if you are faked out a lot, you think the structure is there, but we just continue lower, use this rule. So that means you wait for another move out of that first test area, and there is where you're gonna look for your entry. So in that new move, there's another fair value gap. Most likely there's another bullish order block, and you get in the second PD array rule. And then you can put your stop below here for the same 1 to 2. Both of these execution frameworks work. You will get your 1 to 2s. If price goes higher, you will be in. And it's up to trader discretion which one of these two you prefer. And when we go over the trades after this, I will show you how I use both of them to get the highest win rate possible and when I use which one. So the structure is on the 1 minute time frame during the New York kill zone. We're gonna backtest this on NASDAQ. If you want to trade London session, you can use an asset like the DAX, the German index, because that's a London mover. Sometimes you will see NASDAQ moving in London session as well, but the majority of the moves, the cleanest moves, will be at the New York Open. So that's what we're gonna focus on in this session. And the nice part about this setup is, for your mental game, it is very easy because you just need to wait for time, 9:30 a.m. EST, the New York Open, and price this exact structure to align. So it's very easy to see, okay, the setup is or there or it's not there. And for your mental game, that's nice for FOMO. That's nice guys for overtrading, for revenge trading, because it's very obvious if your setup is there or not. But here's the uncomfortable truth. This model works. I've been trading for over 5 years and it still works, but you won't use it. Because right now, 99% of people watching this video are thinking, yes, I got the rules now. Let's open TradingView at the New York Open and start pressing the button. And you will blow your account probably in the next few days because you haven't done the repetitions. And the upcoming minutes of the video are these repetitions. I'm gonna pick a random month and we're gonna execute every single setup together. The wins, the losses, the nuances to the model. And if you cannot even sit through a backtest video of someone who does it for multiple years and can you show you exactly how you can do this too, how are you going to make it work? How are you going to sit through a losing streak when it comes? You need to be able to do the boring work, to sit through it, take notes, and now let's get into the backtest. Cool, now we know the setup. Let's go to the actual random month. And what we'll do is, let's go to August, July. Let's do August. If you're trading ICT and you see some videos, everyone says, oh, you cannot make money in the summer, the banks are on holiday. So let's try August and see how true that actually is. Random month and let's go. All right, we are at Friday, August 1st, and let's go to the higher time frame because the first step of this model is to have all the relevant PD arrays ready to be traded into. So here there's a weekly bullish fair value gap. If you go to the daily, there's a daily bullish fair value gap sitting here. And because of that, the down close candle that trades into a daily bullish fair value gap is a daily bullish order block. So those PD arrays are there on the weekly and the daily. Then the 4 hour, we have some lows sitting here we could target because we just displaced big time. So with this in mind, let's start trading. And now let's fast forward to the New York Open. And here we're approaching the New York Open on August 1st. And we have that daily bullish order block sitting right here, the green line, also with some lows. We just took out a low here. We don't have much to work with on this day. There is a 1 hour bearish fair value gap. I would say their bias is going to be bearish, aggressive buys, aggressive sells. So we could see some down targets coming in. So my bias for this trade would be shorts. Maybe you can trade it from this 1 hour bearish fair value gap and let's see what we have. Here, there's another bearish fair value gap inside the 1 hour. And if you have overlapping PD arrays, that is very nice because price loves to trade towards overlapping PD arrays. And on the 5 minutes, not much. So what we wait for is some buy side liquidity to be taken and then we start creating sell structure for a 1 to 2. And it's on the 1 minute after 9:30. So now let's fast forward to 9:30. So here we are at 9:30 a.m. EST. And before that, we did not trade into the 1 hour and 50-minute bearish fair value gap yet. So that could be an entry to be going higher and then lower. But we already had a short-term liquidity sweep. We already have the sweep here. And it was probably with a news event. If you look at the time, it was around 8:40. So the liquidity sweep has already happened. So we could just see a sell-off after the open. So I'm open for this already being the high. And we're now just going to trade lower. So let's see if there is clear bearish structure created. Because before the open, we have fair value gap here. There's already fair value gap here. There's enough here already to work with lower. Like there's bearish structure created. So when there's so many bearish structure already created, we can just use this as fuel to trade lower. We don't need to trade higher here. So for that, I would say we're going bearish. And here at the open, well, there's nothing here. I'm just waiting for displacement candles lower. Let's see if we get that lower. There's nothing here. No fair value gaps, nothing. And most of the entries are between 9:30 and 10:30 a.m. EST. This is nice. Here we got something to work with. Why? Because we already assume that this is the high. So we're trading lower. And especially this candle, the 9:37 candle is very nice as a bearish order block. There's order block and an overlapping fair value gap. So for the trade idea, I would say we're gonna take a short idea from here. We're not in yet. Let's see if we get tapped in. Stop above this high for a 1 to 2. It's gonna be the trade idea for August 2nd. There's no clear structure here. So it's a little forced. And especially because the structure already formed before the open, I would say this is a B setup, but I would have taken this either way because this will still be the model. And after we just trade lower and lower, lower, there's no entry. Very important here. If we see the aggressive sells, aggressive buys, I'm not going to enter here to take shorts. It doesn't make any sense because the move here already happened. So there's no entry here. So we're gonna use it as no trade. So no win, no loss, no break even. And then here at 10 a.m., if we zoom out here, we have a big move upwards. Can we do something with that? So here at 10:30, there is a potential bearish fair value gap created. So here at 10:30, there's a potential bullish fair value gap created, but we're also in a bearish fair value gap. This says me that we're probably not gonna take any trade here during the New York session here. I'm just gonna have a low probability day on our hands in this first day of the month. Yeah, so the model did not appear here. Let's fast forward a bit into the PM session. No, so the short move we missed. So no trade. Now let's fast forward to the next day. At the next trading day, that's gonna be the Monday of the next week. There is a 4 hour bearish fair value gap created in that same area where we had that overlapping 15, 1 hour, and now the 4 hour bearish fair value gap. So there's a lot of liquidity up here. So this is gonna be the target for the Monday
Monday trade idea. If we zoom in here, there's already a 4-hour bullish fair value gap sitting here, probably being traded into in London session. So now let's go to the lower time frame, zooming in to see how we can frame a trade idea towards this area right here. So it's going to be the Friday 8 a.m. high, and of course the overlapping fair value gaps in this area up here. There's a 15-minute bullish fair value gap sitting here already. This has been trading at 8:45, and before the open we start trading higher already. We have a very clear draw on liquidity, so let's see if there's going to be, I call it a 9:30 explosion. That means at 9:30 prices rockets upwards towards a target. That's going to be on the table here because you already have a lot of nice structure. See on the 5-minute, yes, same. There's already been tapped into, so it wouldn't surprise me if at 9:30 we're going rocket upwards towards this area right here. So at the 1 minute, we need to wait for the model for a nice liquidity sweep, break of structure, and see if we got that. And here there is no entry because we just rocket upwards towards the drawn liquidity. That's fine. You just missed the move, but missing the move does not mean we cannot make money, because now we can look for, okay, can we still make money with the setup that comes after this move? Because here at the open, we had the explosion profile, but in that explosion profile, we create a massive 15-minute bullish fair value gap. And that's what we're going to use for continuations higher. So ideally now we just wait for this to happen, and we're going to use that on the lower time frame for our model. So at 10 a.m., this is also part of the 10 a.m. game entry model. It's at 10 a.m. We wait for a manipulation lower. 10 a.m. means a AMD accumulation, manipulation, distribution at 10 a.m. So this we're going to play in this. Let's see if we get some move lower. Not yet. Here at 11, we get that move. We tap into the 15-minute bullish fair value gap. Now let's see if we can get some buy structure. So this would be indicated as the liquidity sweep. Now we're going to wait for a displacement higher. Still consolidating, so there's no entry here. And then we're just going to trade higher from there. So here also no entry, because what you want to see is a clear aggressive sells, aggressive buys. And there's consolidation here. So I don't like that. So that means you missed this move. Are you going to stop hunting? No. Zoom out again. Cool. What do we have here? 5-minute bullish fair value gap now here. 2 actually. So let's see if we can use that as an entry. Price comes back there. And now we're already approaching PM session. PM session, not what we trade. We see that price wicks into that fair value gap, but already the session is done. So on Friday, no trade. Monday, also no trade. And if you have 2 trading days in a row where you don't take a trade, you're going to feel restless. You're going to feel like, I don't take too many trades. Oh, I'm now behind. I see all the Twitter gurus or the social media gurus making money. Why do I not make money? You have a model. You wait for it. If it comes, you press the button. If it doesn't come, you don't press the button. And not taking a trade on a certain day is also a win because you decided to follow your plan. So now we're going to fast forward to Tuesday, and we're going to use the movement from Monday and Friday for our trade idea, because we're going to build on top of the trade ideas. Missing moves is just information. Okay, price moved away without you. Cool. Maybe we can use those areas that we moved away from for next entries. And now we're at the next trading day, and we missed 2 days in a row of movement. Does that mean we're not trading? Of course we're gonna trade. Look at this 4-hour bullish fair value gap. I would say for this open, for this trade idea, this is gonna be the most obvious trade idea ever. So what I'm seeing here already, and with the 4-hour time frame, we're gonna execute on a 1 minute, but I already see that we sweep a high right here. We sweep the Asia high or the PM session high, and then we close lower. There's another 4-hour bullish fair value gap sitting here. But ideally, if we want to go higher from here, which I think we can, on the higher time frame, we'll probably just do this. And if we do that, then we can short towards it. It's a liquidity point where we can trade towards, then trade from it. So with that in mind, let's zoom into the 1-hour time frame. It's also a little swing low there. Let's fast forward to the New York Open. So now we're looking at the NASDAQ at the New York Open at 9:15 a.m. EST. And what do we have? We have that 4-hour bullish fair value gap sitting there, and there is a liquidity sweep already happening up there. Cool. That is at 8 a.m. After that, there is a 15-minute bearish fair value gap sitting there, which is nice. Let's see if that's gonna hold. Let's zoom in more. And we need to find areas where price could trade back into. So for now, there's nothing. So at the open, let's see how we open. So we open not very bearish, so there's no entry here. Target is going to be down here, so let's see if we can find entries towards that. So we sweep some highs here, and this is looks like bullish setup. And here it comes a very nice nuance I want to explain, because the higher time frame said clearly we're probably going lower first, right? The 4-hour bullish fair value gap. But here at the open, we have aggressive sells, aggressive buys. We have a market structure shift. We have fair value gap 1, and here fair value gap 2. So textbook model would say second PD array rule, we're going here, right? But if the 1 minute idea is long, but the 4-hour, the higher time frame says lower, you have a conflicting bias. And you need to be very careful for executing a conflicting bias on the lower time frame. Because if you're going to trade the 1 minute, it's going to be very sexy most of the times, but your higher time frame idea should match the lower time frame. And here it doesn't. So I will not be in here. And I'll explain why. So I'm actually still waiting. I'm seeing this as manipulation. So where all the Twitter gurus and all the traders go in long here, I'm going to wait. And I want to see, do we move away from here? And we don't. So you're taking a loss here, because target is very clear. It's a 4-hour bullish fair value gap. We knew this from the start start of the trading day. So when there's buy structure conflicting with the higher time frame, I'm not in. So liquidity sweep is the first step. What is the last swing low that made the high? So this is the recent high. That is right here. So I'm going to remove the erase right here. And then we're going to look for a short idea. There's a fair value gap sitting here. We already traded into a fair value gap down here. So already, this is already enough to take an entry. So I would just go in, like your entry does not need to be perfect. If the target is going to be all the way down here, it's going to be a big move. It's going to be a 150 point move. If you want the 1 to 2, you have a very nice trade idea on your hands. So I would say this would be the first entry idea. Let's see if we can get another entry idea. See if we tap into the fair value gap. No, we don't. So I say you can also take an entry here. If you miss that first move, same trade for 1 to 2. And then price goes to the target. So day 3 of the back test. Friday, no trades. Monday, no trades. And here, first trade, first win, 1 to 2. Why? We waited for the higher time frame. Let's go to the 4 hour. For the higher time frame, the 4 hour bullish fair value gap to be traded into. Now let's go to the next day. Now we're looking at the Wednesday at 7 a.m. EST. So just before the open. This is the 4 hour bullish fair value gap we traded into as a short the previous day. And now we are looking at neutral bias at the 1 hour, to be honest, because we have bearish ideas and bullish ideas. Why do I say that? I see bearish fair value gaps being respected, but I also see now bullish fair value gaps being created. My bias is still from the 4 hour. Remember the previous day that we were first lower, that was a short, and then go higher. So from that perspective, I have a bullish bias. And let's see if we have a follow through. So if that 1 hour bullish fair value gap that was created in the Asian session, is that going to be respected? And we can see a nice opening move. Let's fast forward to the New York Open, 9:30 a.m. EST. And here we just open at 9:30 a.m. EST. So down here, we already have a liquidity sweep. But again, before the open, we don't like that. Ideally, the model is after the open. There's a 5-minute bullish fair value gap there. But here on the lower time frame, there's where we're gonna put our eyes on. We have a short-term liquidity sweep right here. This move at 9:30. Then my eyes are going towards the fair value gap here. So I'm waiting. Do we see price going into that fair value gap? No. Cool. So that idea is off the table. So we wait. Do we now have an idea? I would already say, based on this movement, that we have a little choppy price action. It's just going up and down. So I don't like that. So I'm going to wait. Do we respect the second fair value gap? No, we don't. So here you see a very interesting profile occurring. When, and write this down for your trade plan. When you see bullish and bearish fair value gaps being disrespected, you can expect choppy price action. So what I mean by that, here was already the hint. So when this fair value gap is disrespected and there's a new fair value gap created, this should be a reversal pattern. So aggressive buys, aggressive sells. So that means price goes lower. And then that first fair value gap should become an inversion fair value gap to push price lower. If that second fair value gap, this one, is also not holding, like you see here, you have choppy price action on your hands. So then you wait a little bit longer for a clear model to appear. So now we are approaching 10 a.m. So 10 a.m. game territory, and it's still choppy price action. So here is where you save yourself from an unnecessary loss. Let's go to the 50-minute time frame. This is what I like to do when there's choppy price action. I'm just waiting for a little higher time frame to give some trade ideas. So here at 11, we see a movement upwards, and that's nice. So we see the displacement higher here in the 50-minute. I would say it's a very choppy day. So the exact model is not there. We don't have the clear liquidity sweep, clear break of structure. It was already down here, but this price action is just horrendous. And then we're just trading higher. So for me, this is no trade day. But the cool part is, and it's nice for the next day, is we creating in that move we missed, create 1 hour bullish fair value gaps, which we can use later. No trade on Wednesday. Let's go to the next day. Now look at the 4-hour time frame here on the next day, on Thursday. And in the Asian session, we trade already in the 4-hour bullish fair value gap that was created the day before. In the trade idea we missed here on Wednesday, we already traded into that. It's interesting. We can use the information for the next day. A 4-hour bullish fair value gap here and a 4-hour bullish fair value gap here. So with that in mind, we also in this 4-hour bearish fair value gap, I would say for the New York Open, we can try to take shorts towards or here or here. Well, of course, we even have the Asia low sitting down here. So down the higher time frame, we can use this because the move already happened before the open, the up move. I'm expecting this maybe to happen. So that we don't need to trade all the way down here or down here, but just this move, we can short towards it. If that happens already, we can maybe long from somewhere in this area. At this trade day, I'm just waiting for which move do we make at the open. Do we make the sell move at the open like this towards the fair value gaps, or do we make the aggressive sells first and then create the buy structure? I'm just waiting for that at the New York Open. So the bias is neutral. So let's see what the candles will give us. Also here we're looking at the New York Open at 9:30 a.m. EST. This yellow box is that 4-hour bullish fair value gap. That's going to be the most important level of this trade day because we can use that level as as a place to trade to or a place to trade from higher. So the long and short idea is all going to be based on that idea. So ideally at the open, we first trading lower regardless. And I don't care if we get an explosion profile lower and we just miss that short move and then wait for buy structure, or we just going to take some nice shorts toward that. Let's see what the opening candles give. So here the open is very choppy. Most days I don't trade the first candles after the open because I'm expecting this exact chop to happen. There's bullish fair value gap created here, is inverse, is disrespected. And in that move, there's another fair value gap created. Balanced price range here, overlapping part between a bullish and bearish fair value gap. Let's see if we can trade back into that. We do. Now let's see. This could be the start of a trade idea. Why? Because we have a liquidity sweep, we have aggressive buys, aggressive sells, and we have a last swing low that made the high. It's right here. This could be the start of the trade idea. Now you might wonder, do I now trade blindly here, stop at the high, target here? No. And the reason why I don't do that has to do with how we delivered into this fair value gap. This is a nuance. We delivered very aggressively. Look at these candles into this level. There's even a bullish fair value gap created right here, there as well. So if that happens, I'm waiting for a reaction and a close below this fair value gap. If you get that close, then I probably will take a trade that looks like something like this. But for now, we wait. And that has saved you a loss. You see? Cool. So we take the high. I think still that bullish fair value gap can be reached. So let's see if we can get some sells soon. And I want to see displacement lower, bearish candles lower. It's now 10 a.m. 10 a.m. game activated. And here we get some down movement. But look at this. There's no fair value gaps. And that sucks because their bias could be right, but there's no fair value gaps. And that sucks. So here we have the first fair value gap in this whole entire move. Let's zoom out to the 5-minute time frame. There's also a 5-minute bearish fair value gap here. And we had a 5-minute bearish fair value gap here. This makes me want to go short in this fair value gap from the 5-minute time frame. Because here we see the model on the 5-minute time frame, not on the 1 minute. We see liquidity sweep. We see a break of structure with fair value gap 1 and even fair value gap 2 right now here on the 5 minutes. That is enough for me to press the button. I don't like these wicks here. These are rejections, but we still have this 4-hour busy. So that is going to be the move. So let's see if we can find a nice entry down here. I think we can just take this, but the stop loss placement is going to be more difficult. So I'm probably going to short towards the consequent encroachment, the midpoint of this fair value gap, 412 like this. It's going to be a risky trade, but I think it's going to be good based on the 5-minute, not the 1 minute, the 5-minute buy structure. So let's see if this trade survives. And it does. And just after the fast forward, the actual setup becomes. So I think this entry on the 1 minute is not too clean, as it's too risky. But look at what happened after. Fair value gap, no disrespect, and we can just trade lower. All in all, again, bias was the 4-hour busy right here. And we waited for this fair value gap. This would be the best entry, to be honest. I missed that, staring at the 1 minute time frame. But after that, we zoom out a bit and we see this very clean second fair value gap. So the model, liquidity sweep, aggressive sells, aggressive buys, break of structure. And the break of structure here on the 5 minutes is in the same time as the fair value gap right here, and then we trade lower. So another trade, another win. And with this win, let's go to the next day. Here we're looking at the start of the Friday candle, the day after, and we had that massive sell, and we even sold off even more all the way towards here. So we could short even more. We just needed 1 to 2, so we had our money, but we could even get a bigger target. And after the sell-off, we even created a bullish fair value gap on the 4-hour. So let's mark it out right here. Bullish 4-hour fair value gap. That's a nice point of interest for this day. Also, there is a 1-hour bullish fair value gap here. So for this trading day, I'm gonna be bullish towards this high and this 4-hour bullish fair value gap and this 1-hour bullish fair value gap. So now let's fast forward to the New York Open. So here we're just before the New York Open at 9:20. And what do we have? We already have a London liquidity sweep. Ideally, we trade lower first and then go higher, but we don't need to. We can just go up in one go. So we could see an explosion profile again as well. So to the 1 minute, there is already a small liquidity sweep here. So let's see what we do at 9:30. So the starting point is a liquidity sweep. Let's see if we get that. Right here, we have a bullish fair value gap sitting here. There is a small sweep here, not super nice, but if we trade higher from here, we don't need to trade lower too much here. So if we now close over this down close candle, that becomes an order block, we could see a setup coming in. See next candle. Yeah. So there is where we already want to get in. So we have a small liquidity sweep. And the reason why I'm not waiting is because we're already in a 4-hour fair value gap. And there is a very clear drawn liquidity. That's the high from the day before. So I would already go in here a little late to the party, stop below this low for 1 to 2. And think you can even, it's almost that high. So I think we should be good there. So the next candle does also a fair value gap created here, fair value gap and a order block. And there, let's see what we get. Yeah, so we tap into the fair value gap here. That's the entry, 9:38, and then go to the high. So again, clean target. And the signature of the open right here is this one. We have that aggressive sell lower. And here you just wait, like this rejection, 9:34 is what gave it away. And then you just wait And it's important, like don't go blindly in this candle because we could go lower here. But you need to wait for the change in character here. Down close candle, if you close over it, it becomes an order block. And we see we tap into the fair value gap right here, 938. That's the official entry. I was a little early to the party, but that's good enough. So again, another trade, another win. And it's the end of the first week of August. So then I go to the second week of August. So now fast forward to the Monday. The TP from the Friday gave a very nice 4-hour bullish fair value gap. So we can use that. So for this day, we have a nice high sitting there. So we have internal range liquidity, a fair value gap on the 4-hour, and we have a high. So we're going to use that as a place to trade from and towards. So let's go to the New York Open. Here we're at 9:30 a.m. EST, and we have the high here, and we have the fair value gap. And I'm just going to wait until we reach one of the two. So it looks like we're going lower here, bearish fair value gap. Is not respected. So now there's a bullish fair value gap. So then with this structure, I would say we're first going higher, but none of it happens. So this wants to make me go long into the high right here for 1 to 2, stop below the low, because we have the liquidity sweep, break of structure, fair value gap 1, fair value gap 2, and even fair value gap 3. The only thing that I don't like about this setup is ideally we are bullish on the higher time frame. So ideally higher time frame, we do this. So if that happens, I might just gonna take the loss on this and then short towards the 4-hour bullish fair value gap. But let's see what we do. Go higher. Yeah, and get stopped out. So first loss here. And it's important because this loss hints that we potentially want to go lower. So see if we can find a short entry here. No, there's not. So here, stopped out, and then it goes into profit. So first loss, that's fine, can happen. The model was there, aggressive sells, aggressive buys, but just the 1 to 2 just could not happen on this trade. So that's fine, you take a loss. And now let's fast forward to the next trade day. So the editor, there's gonna be a loss, -1 on loss. Fast forward to the next trading day, we see that we traded towards that 4-hour busy after all, but then in the PM session, so it's just unlucky, you take a loss and that's fine. So now we have the same bias. We live the same bias, still in that 4-hour bullish fair value gap, and we just expected from internal to external. So we have 2 highs sitting now right there. So this is going to be the target for this trade session. So now let's go to the New York Open. And looking at the news, I think Tuesday, this is probably CPI. So we have CPI here. So just before the open all happening. So the drawn liquidity is already being met before the New York Open. So now we are around the New York Open. So the whole move, let's go to 1 hour. The entire move has already happened here. Let's see what we do at the New York Open. Because we take out the highs here and now we start displacing lower. If we do that, we take out external liquidity and we have such an aggressive move. My eyes are immediately going towards equal lows down here. There's the London low and the PM low. So let's see if we can find an entry towards that. And no, we don't get any short idea here because we don't follow through from the bearish fair value gap here. So there's no entry. Also, these lows are still intact. So weird price action here. So no trade on Tuesday. Let's go to the next day. Here on Wednesday, we see that we moved up like crazy. And in that move, we created bullish fair value gaps again on the 4-hour time frame. So there's where our eyes are going. Draws on liquidity lower. And yes, we are bullish higher time frame. But I think we can make this exact move. So that means at the New York Open, I'll be looking for shorts. And then if that happens quickly, I'll be looking for longs after back higher. Fast forward at the New York Open, we have this 4-hour bullish fair value gap. We have Asia low sitting here, London low sitting right here. So there are failure swings. These lows are nice to target, but it doesn't look very bearish yet to me. So let's see if we can get some nice price action to the downside at the New York Open. 9:30 right now. So we go higher. So no any short idea yet. We need to see down close candles. Nothing here. And here we have something. Here we start moving lower. This is a very nice candle. So zooming out here, we have accumulation, manipulation, and potentially distribution lower. Let's say low hanging fruit target would be here. It's London low, session liquidity. So now what I see is break of structure here, quit sweep, break of structure. We need to be even more precise here because this is the high and this is the last swing low that made the high. I have a small sweep up there. So then if you move away from here, close below it, yeah, so here's the entry. Here I would take a short towards the London low for 1 to 2, like this. And it hits TP. So the target was lower. Based on the higher time frame, I think we can even go lower here. The 4-hour bullish fair value gap. This is just low hanging fruit. So this is London low. We have Asia low, 2 4-hour bullish fair value gaps sitting here. And there was nice sell structure. And See that we don't call any tops here. We just wait. We just wait for price to show its hand. And this candle at 9.55 was the hint. Then we wait for a reaction from here, and there we get in. Official entry could be here in this fair value gap, together with the bearish order block that's created because we have the fair value gap here. This is an up close candle that trades into another fair value gap, making the up close candle a very nice bearish order block, and then we trade lower. Cool. Let's go to the next day, to Thursday. At the start of Thursday, we still have that 4-hour bullish fair value gap open. Also 4-hour bearish fair value gap sitting here. So we might have a bearish bias here. And the higher time frame idea is still exactly the same. From here to there. So there's where we're going to trade towards. We have this short-term high. So intraday at the 1 minute, these are the liquidity pools. So we have the 4-hour busy, and I would say the Asia high from Wednesday. Now let's go to the New York Open. And here before the open, we have another news event, probably CPI, PPI, like a big one. Big wick here at 8:30. It's a news wick. After we take out the high here, it's already taken. So from here, this is the starting point of the trade ID already before the open. I'm not going to trade before the open, but we already trade into the 4-hour bullish fair value gap. So the long idea could start here. Let's go to the 1 minute and let's see if we can find a setup here long after the New York Open. So here we look at the New York Open. We already had that news wick, so we don't need to trade lower here. This low could already be the low. So based on that, we have a 1 minute fair value gap here. And we're going to open right now. So we trade into that. And this is a nice reaction. So this is what you want to see for the trade idea. And we can just trade back towards the pre-CPI high. And here's the nuance, because you might think like, yeah, fun, this long idea, but look at that massive displacement. Is it not going to be showing us that we go lower from here? But keep in mind that is there on the 4-hour, we had that massive 4-hour bullish fair value gap, that's yellow box here. And we're just going to trade higher from there. That's the higher time frame bias. So then on the lower time from here at the New York Open, I'm just going to look for longs. If this trade idea fails and we're going lower, I'm probably going to take this, like a similar setup, but then lower. So I'm going to shoot 2 bullets. But for now, I'm looking at this and it looks nice. Let's see what the next candle does. Yeah, so this is enough for me to press the button. There's another fair value gap. Let's say I'm late to the party. I'm going to put my entry here. So it's a late entry. Stop below the recent low for 1 to 2. Another super nice trade. Let's see where our TP is now. It's not it's been a random place here. So not the cleanest trade, but you cannot have the cleanest trade. So I want to make it as real as possible. Let's say you just missed this move. Let's see. And even when it's not very clean, it still got TP. We tap into this fair value gap here at 1 point, and then we go to TP. So another day, another win. And make sure at this day, again, the same signature in price happened. We had that fair value gap here at 9:30. And don't go blindly into that, because that could fail. Like when I was trading this live, I was actually expecting this to happen, that we maybe sweep the low. But you don't, like the price doesn't care about your expectations. Like it just prints the candles. And if you want to go higher, cool, follow the buy structure. And I didn't go in right here. That will be more risky. I'm just waiting. Okay, let the candles show me its hand. And it did right here at 9:35 already. And then we just hold into profits. Cool, so with that TP, let's go to the next trading day, to Friday. Because here on this Friday, on the 4-hour time frame, we are in a weird scenario. Look at this, we are in a consolidation. Consolidation here on the 4-hour, making the higher time frame neutral, meaning lower probability. And lower probability means that the lower time frame is probably not going to be as clean as we want. So I'm not going to be very aggressive here. But what do we have? Most recent high, most recent low, and we are still inside that fair value gap. Let's go to the 1 hour to see if we can find more. Yeah, also here, still trapped here, bearish fair value gap, bullish fair value gap. So it doesn't look like a very nice day to trade, but still, let's see if we can find an entry. Also, the bias is neutral, so we're going to flying blind here. Let's see if we can find the model at 9:30. So here at 9:30, we sell off. So this could be a manipulation lower. The higher time frame is still bullish, but it's consolidating, so it's not very clean. So let's see if we can create buy structure from here. Doesn't look like it. We are now approaching the yesterday's low. That's the big news event low. And let's see if we tap into that, if we create buy structure. That'll be something I'll be interested in. So we have the last swing high that made the low. That's right here. It's now violated. So there's a market structure shift, liquidity sweep. We sweep the previous day low. And now we start trading higher. This is interesting, right? So this fair value gap is definitely respected. Also a fair value gap right here. So for the 2 PD array rule, you are good as well. This is already good for me to take a trade. Stop below the low here. So let's say I take it here. Stop below the low for a 1 to 2. See if we can get the trade. and a big fat stop loss. So cool, right? The reason why this loss is so cool, and like, Dion, do you like losing money? No, I don't. But remember what I said in the 4 hour, at the start of this trading day. The 4 hour is consolidating. That means on the lower time frame, you most likely will not see your setup being followed through. And the setup came, right? We have the rules, like we have the previous day low sweep, that is the red line. We have the break of structure for value gap 1, and we just displays higher, but no follow through whatsoever. That is because the higher time frame is not good. So this is a nice loss. In a real-time environment on these days, I will sit in my hands. But I want to show you this for the example. Just shoot the model when it's there. But for new ones, higher time frame consolidation makes the lower time frame just harder to trade. And you will just take more losses. And the rest of the session, there is nothing. So end of this trade week. Let's go to the next week. Cool. So here on this Monday, we open on Sunday very bearish. So that means we probably want to go lower a little bit more on Monday as well. We have also a relative equal high sitting up here. So that's going to be the point interest. Let's see on the 1 hour if you can find something nice. Yeah, there's a 1 hour bearish value gap that it could be used for short ideas. So we have the Friday low, we have the Sunday low. Let's see if we get that right here. But all in all, again, low probability price action. Look at the candles here on the 1 hour. It's not very nice on the lower time frame. So this is where you should be very aware that you could take more losses. Let's fast forward to the New York Open. And here at 9:30, we're just waiting for the first PD rate that's been hit. Is it the 1 hour bearish value gap, or it's going to be the Friday low? And it's going to be the 1 hour bearish value gap. So now all our eyes go to the lows here, and the red line is the Friday low. So do we get nice sell structure? Yes, we do, but there's no clear fair value gap. I don't like that. There's one here. So I'm going to wait for price to come back here and give a trade. So let's see, do we react from here? That's the most important part. If we react from here, I'm going to short towards the low. If it doesn't, I'm going to wait. And here it looks like we do not get an entry. So I'm waiting. The fair value is not respected. And all of a sudden we start trading towards the low here. And I'm like, shit, I missed the move. So I'm not in this move. I was not in this move when this was printed at August 18. I was just like, oh, well, we're going towards that Friday low right here. That's the drawn liquidity now. So just sit there in pain, just waiting for price to go to the target without you, not chasing it. But what happened here? We create buy structure all of a sudden. There's a sells, aggressive buys. There's a bullish fair value gap now. What now? It's 10 a.m. Here is where it gets interesting because we created another low here. So the liquidity pool just became bigger. Early buyers are now into the market. How nice would it to take them out? So I think the drawn liquidity is still there. And we're now at the 1 hour fair value gap still. It would be nice if this would be a sell structure. This is what I was calling on my live stream as well, like this. So now if we see this is where I want to take my entry towards the lows here. For 1 to 2, this would be the trade idea because the lows are still intact. The drawn liquidity is still there. And I cannot get tapped in. That sucks, right? No tap, no tap. And a execution mistake right here would be this one. There was another fair value gap I didn't see. So ideally, your trade would be here. Your stop loss a little lower, but then my stop loss would be in a very random place, right? It would in the middle of this fair value gap. Oh no, I would say I would have missed this trade. So no entry, no win, just a missed trade. But it's still nice that we have a clear drawn liquidity. We miss a move and we just wait, sit on our hands. Okay, cool. This would be then the move. And then we take it and miss it, and that's fine. Let's go to Tuesday, New York Open. Here at Tuesday, we are close to the London session and we are traded back into the 4 hour bearish fair value gap here. And we have now the low sitting down there. So with this price action, it's still pretty weird price action, but this is still bearish because we react from a bearish fair value gap. We're respecting bearish arrays. So my drawn liquidity is going to be the Monday low for this day. Let's fast forward to the New York Open. So here we're now at the New York Open. Here on the left, we see the Monday trade we missed. We are still in that weird consolidation, but we moved away from this 4 hour bearish fair value gap, meaning my bias is bearish. We already had a London move down here, and now my eyes are going, do we respect this 15-minute bearish fair value gap? I think we can see sells coming in. I'm bearish on this day. See on the 5 minutes, also bearish fair value gap. So now on the 1 minute, I'm just going to wait for sells at the New York Open. Let's see if we can get an entry somewhere. And it's pretty nice. This is an explosion profile. Explosion profile. So we have a liquidity sweep here. It's nice little wick. Changing character here. Wow. And now we trade lower. Cool. Very important here. FOMO protocol. If you see this happening on a chart, you're like, I missed the move. What I do then is zooming out. So from there, I just go to the 5 or the 15-minute time frame to see, is there an entry? So what that means is now at 9:45, there is a potential fair value gap created here. So at 10 a.m., as part of the 10 a.m. game, I'm just going to look for continuation short like this. On the 1 minute. Very simple idea, right? Price goes lower, monkey sees lower, monkey trades lower. That's going to be this trade. So I'm just going to wait until 10 a.m. as a 10 a.m. game to see, do we trade into that and then start trading lower? So that's going to be right now at 10 a.m. So let's see if you can get an entry. Do we get a tap here? So this is a pretty clear tap. How we deliver here is not very nice in my opinion. I'm not the person who shorts this massive green candle, so I'm gonna wait. And I want to see, do we create a bullish fair value gap here? If we don't create that, I'm gonna take shorts with my stop loss above the recent high. Next candle, let's see if we trade into it. We do, so there's no short idea here. Maybe even a long idea. But for that, this is a very important nuance. Remember what I said about if the 1 minute looks nice, but the higher time frame looks not nice, we have a problem because the higher time frame shows sells. Sells from the 4-hour SIBI, from these 50-minute SIBIs, like this, under 1 minute. Very simple idea, right? Price goes lower, monkey sees lower, monkey trades lower. That's gonna be this trade. So I'm just gonna wait until 10 a.m. as a 10 a.m. game to see, do we trade into that and then start trading lower? So that's gonna be right now at 10 a.m. So let's see if you can get an entry. Do we get a tap here? So this is a pretty clear tap. How we deliver here is not very nice in my opinion. I'm not the person who shorts this massive green candle, so I'm gonna wait. And I want to see, do we create a bullish fair value gap here? If we don't create that, I'm gonna take shorts with my stop loss above the recent high. Next candle, let's see if we trade into it. We do, so there's no short idea here. Maybe even a long idea. But for that, this is a very important nuance. Remember what I said about if the 1 minute looks nice, but the higher time frame looks not nice, we have a problem because the higher time frame shows sells. Sells from the 4-hour SIBI, from these 50-minute SIBIs. Okay, my camera just died, so let me finish this analysis. Here's when we're gonna wait for price to close over this 50-minute bearish fair value gap. So if we are closing above here, above this area, there is where I'm going to look for long entries. But for now, a higher time frame, I'm still bearish. So I'm looking for sells. And here we see that. So when I see this failing, I want to take my entry already in the inversion fair value gap. So then my entry would be at the inversion fair value gap, stop above the high for 1 to 2. And that's all based, like here on the 1 minute is like, oh yeah, it's a inversion fair value gap, a random one. No. Because we are trading. Remember on the 15 minute from the value gap back to lows, that's what we're going to do right now. And on the 1 minute, we just look for a confirmation for that. And that's going to be right now. And there you go, clean, take profit. If you want to have a fair value gap entry, there was also an entry right here, but all clear, take profit here on Tuesday. This is only 2 weeks of backtesting and you got all my insights of when I take a trade and when I don't take a trade. And as you can see, backtesting takes time and it's pretty boring. But the cool part is once you do this a couple times, you will train your eyes to see your entry model in real time before the candles have printed. If you want a part 2 where I go over the rest of the month and share more insights and frameworks on this model, make sure you comment part 2 below and I'll release it very soon. And now the question is, are you going to do this yourself or are you going to now click away and watch the next 90% win rate entry model video and keep being stuck in that unprofitable loop? I trade a setup live every day with my students inside my Discord where I share daily trade ideas and a ton of free frameworks. I'll leave a link to the Discord inside the description. Don't forget to hit the subscribe button. Thanks for watching and I'll see you in the next one.
In this video, I will walk you through my proven open, high, low, close model. And you can use this model to master your daily bias and be on the right side of the market all the time. You can use this to get funded, profitable, payouts, all that stuff. And I use this exact model to gain over $1 million in funding and over $100,000 in profits. No time to waste, let's get into it. The open, high, low, close model is all around one single candle because a bullish candle on the left side has a open, a low, a high, and a close. Just like a bearish candle has an open, a high, a low, and a close. And by anticipating the next candle to be a bullish or bearish candle, you can play the open, high, low, close model. And the goal is to trade the distribution phase, the body of the candle. So for example, here we have a open of the candle, we have accumulation, then we manipulate trading lower into a key level, making the low of the candle, and then we displace upwards, starting the distribution of the candle. If you know the classic AMD, this is exactly this. Same for a bearish candle, you have an open, accumulation, we manipulate, creating the high of the candle, and then we distribute lower, creating the low of the candle. And the key here is to wait for manipulation into a key level. And what's a key level? For a bullish candle, it's in the discount array, that means old low, bullish value gap, bullish order block, bullish breaker. Vice versa for shorts, a bearish candle, you wait for a premium level, that's an old high, or a bearish value gap, bearish order block. You get the point. When price hits that key level, you wait for market structure shift, the last swing high that made the low, or the last swing low that made the high. And bonus points if in this key level there's an SMT created, aggressive sells, aggressive buys, smart money reversal. If you're not sure what that is, I have dedicated videos to market maker models and to key levels here on the channel. And now the main question, how do you use this? You can use this for a weekly candle, a daily candle, and a 4-hour candle. And for a weekly candle, this candle is just 1 week. And that means if you have a weekly candle and you expect the next week to be a bullish week, you wait for Monday and Tuesday to be accumulating or manipulating. So on Monday or Tuesday, low of the week. You wait for the market structure shift to then trade the rest of the week into the distribution phase. Same for bearish, Monday and or Tuesday, sometimes also Wednesday. Most of the time it's Monday or Tuesday, accumulation, manipulation, and then we start distributing. Meaning that Monday in general is not the highest probability trading day of the week because you are accumulating or manipulating. And you do exactly the same when you predict the next daily candle. If you expect a daily candle to be bullish, you play a classic Judas swing. That means the Asian session is the accumulation, the London session or the New York session is the manipulation, and then we start distributing. Same for shorts, Asia, London, New York, classic Judas swing. And you can even drop to the 4-hour to play exactly the same. And this is what I do on the indices, on NASDAQ and ES. You can play the 4-hour candle because at 10 a.m. during the New York Open, there's a new 4-hour candle created. And if you anticipate the next candle to be bullish or bearish, you can play the first 30 minutes to an hour to be the accumulation or the manipulation, and then start the distribution as a scalping model. And we'll go over weekly, daily, and 4-hour examples later in this video. But first, let's answer some other questions. And the first question is how to determine key levels. So what you need to do every single week at the start of the week, you mark out the recent key levels on the daily, weekly, and monthly. And I do this as part of my weekly outlook, and I really recommend you do the same every Monday or every Sunday. Go to the higher time frame and all the pairs you like to trade. On the right side, I have my whole list. I go through all these pairs, going to the daily, weekly, monthly to see which one looks nice. And make it easy. Only focus on recent highs and lows and for value gaps. I do this every single week as part of my outlook. I go over all the Forex pairs and do exactly this. Daily, weekly, monthly, old highs and lows, and for value gaps. Because when you know where the key levels are in the higher time frame, then is where you can drop to the lower time frame to insert your favorite entry models, like this open, high, low, close model. So here on the dollar, I'm currently slightly bearish, but overall pretty neutral, because on the monthly we're rejecting, on the weekly and daily we're pretty bearish. So I would lean towards bearish, but in general, I'm not going to be engaging very aggressively into the dollar pairs right now. I want to see more displacement to the downside before I'm going to engage in shorts here. And let's pick another example. Here at Euro NTD, we are currently at the monthly time frame. And what you see is that we swept a monthly level, that is the 2020 high, and also we have a monthly bullish value gap sitting right there. Cool. So on the monthly, old high and value gap marked out. Cool. Let's drop to the weekly. Here on the weekly, on the bearish side, there's no value gaps. I see a bullish value gap there. Of course, it's the same high that's been taken also on the weekly. Here we have an overlapping weekly and monthly value gap right there. Cool. So that's marked out. Let's drop to the daily. The daily, we have some bearish value gaps here, which being tagged, but there's no follow through. It just starts consolidating. So because of that, I'm going to be neutral. I'm going to be neutral, slightly bearish towards that monthly bullish value gap, but we already traded into a weekly value gap. So there's a trade-off here between bearish and bullish. I'm neutral because we already swept external range liquidity. We already traded into internal range liquidity on a weekly. So then I'm not going to drop to the lower time frame to find my open, high, low, close model. When I would engage is when we, for example, now trading lower, sweeping these daily lows into that monthly value gap, and then we break structure. There is where I'm 100% going to engage back to this high. But for now, I'm neutral, so it's not on the list. And you go through this whole list doing exactly this to mark out the key levels. And now we know how to identify the key levels, and make sure you do this as part of your weekly outlook. You know that the goal is to trade distribution phase of the candle. You know you need to wait for manipulation to key level, for market structure shift, and ideally with SMT. Let's now answer the most important question of this video. How to anticipate if something's going to be a bullish or a bearish candle. And for that, we need to tap on the topic of liquidity. And I have a dedicated video to draw on liquidity here on this YouTube channel, but let's do a quick recap. The biggest mistakes traders make is that they trade in a consolidation. So if on a daily, weekly, or monthly, we are consolidating, it is not a good idea to drop to the lower time frame. And the single reason for this is that your PD arrays are not going to be followed through as clean as they would if there was a trending condition. So if you're not sure what consolidation is, this consolidation and this is trending, and you want trending conditions. So you want trending conditions, and you can use for value gaps and old highs or lows. You can use for value gaps as a place to trade from. So price steps to the value gap, and you use that too long. So once we are bullish, every time price trades back into a bullish value gap, there is where I'm going to use my open, low, high, close model, because we're trending and I'm anticipating a bullish candle. Same for if we're bearish. Every time we are here, I'm going to look for a bearish open, high, low, close. Trading from an old high or for value gap
back into the range or just following the continuation. Because price only does two things. It trades to internal range liquidity, imbalances for value gaps, or it trades to external range liquidity, all highs and lows. And you remember when identifying key levels, all we did was going through daily, weekly, monthly and mark out all highs and lows, external range liquidity, and for value gaps, internal range liquidity. And you use time frame alignment for your actual execution. So if you have a daily or weekly array, you can use 1 hour structures more for the swing traders. If you're 4 hour array, you can use 50-minute entries. And if you're 1 hour array, you can even go to the 1 and 5 minutes. But more on that in the examples we're gonna discuss later in this video. Bonus points is follow displacement in order flow. When bullish, go long. When bearish, go short. So if you are trading on a higher time frame, try not to short that. Try to just wait for the retracements. Same for bearish. Wait for the retracements and go short. In a trending move, the opposing arrays should fill. So if we are bullish and we just had sell side of the curve, buy side of the curve, we just tried to do a key level. What you want to see is that your discount arrays, your bullish value gap, bullish order block, bullish breakers are holding, while the premium arrays, the bearish arrays are failing. That's what you want to see. So especially here on the smart money reversal, here's where you want to see the premium arrays failing and discount arrays holding, because that's indicating that you probably have a reversal on your hands. Pair this with SMT and you should be golden. So once price taps into a fair value gap or an old low here, I'm anticipating a potential reversal or at least a reaction to take a long from. And not only can you use this to catch here at bottom here to expect a reversal from the bottom, what you also can do, use the next candle as your open high low close. So let's say this candle trades into an old high and it rejects. You can use the next candle to be anticipating that it's going to be a bearish candle back into a fair value gap. Cool. Now let's dive into some examples to see this on the chart, starting with a weekly open high low close. Here in this first example, we're looking at the open high low close model on the weekly time frame. So that means on a weekly candle, if you expect a bullish candle, you want an open, low, high, close. And ideally on Monday or Tuesday, we made the manipulation move, set a low of the week in a key level, and then trade higher. So here we're looking at this Euro US dollar daily chart and look at how bullish we are. So that means we want to continue bullish. We want to play an internal range liquidity to external range liquidity. And here on Friday, we set this high, and then on Monday, we have a doji candle. So that's overlapping with the accumulation. So on Tuesday or Wednesday, we want price to trade into this value gap or this value gap to then trade to the high. So knowing this, let's drop to the lower time frame to see if we can find an entry around this exact bias. So on Tuesday or Wednesday to set a low of the week inside these key levels. Now let's take a look at the 1 hour. Same price action then on the 1 hour, and let's see what price gives us. So here we are at Monday, Asia. Let's drop into London. And here during Tuesday in New York session, we drop into that first day for value gap. And we don't need to catch bottoms. We need to wait for price to give us the indication that we want to go long. And that means aggressive sells, aggressive buys, and potential smart money reversal. Once the displacement. And here we get that. So here we have the order block, a breaker here. We have a value gap that could be a breakaway gap right there. We have an order block right here, the series of down close candles that trade to the highs. And we're doing this on the 1 hour right now. You can also drop to the 5 minute to find a smaller entry, to find a more specific entry down here. But we're just doing this on the 1 hour. We just need to know our buys based on the open, low, high, close. Because this on Tuesday, sweeping Monday low, could be a low of the week inside the key level to trade towards these highs. Awesome. That is your bias from a weekly open, high, low, close model. So let's say you take your trade already here on the order block and breaker. You have your TP at the highs and you have your stop loss for 1 to 2 here below the lows. And let's see what price gives us. So we consolidate. This is the Asian session in London on Wednesday. So we're choppy Wednesday here. So for the whole week we're consolidating. So this is not a very nice trade, but hey, you are in. And sometimes you just don't know if you can get choppy price action. You just know your model. You know, okay, this could be a potential low of the week. Let's see if we can trade to the highs. If that's not the case, yeah, you just are in choppy price action. That's part of it. And eventually price trades to the highs. So with choppy delivery, we still caught the low of the week. Why? Based on a daily internal to external higher time frame. And around that, we play a weekly open, high, low, close. So looking back here, we have a Monday consolidation, Tuesday manipulation, and the distribution starts the rest of the week. And the cool part is here, you know how the 1 hour was so choppy. Look at how clean this daily looks. That's the power of this. So just knowing your higher time frame bias will get you the money in these kind of scenarios. Let's now take a look at a open, high, low, close model on the daily. Now we're looking at gold on the daily time frame. And there's a cool indicator. It's called power of 3. You can see it on the top left corner here. And it will give you the current candle.
here on the daily. So if you double click it, you can even go to another time frame because we're doing this on the daily. You can see here how the daily currently looks like. And what do we see? We see price trading lower, but we have a very bullish move here on gold. So I would say this is a retracement. So I want to steal long, and we're coming into this kind of the range, OT, optimal trade entry, and we are trading in a daily bullish fair value gap. And we also here have a order block, these series down close candles. Let's mark out the start, the body here. So in this area, I'm expecting price to make a low. And then you know, okay, the open high low close model, we're looking for a bullish candle after we hit this area. So we already hit this here. So then what we want to see is on the daily, Asia, London lower into the key level. That could be somewhere here. And then start to distribute towards the highs. Open, low, high, close on the daily. So let's drop to the lower time frame, let's say to the 5 minute, to see how we can frame a bias around this. Now look at gold at the 5 minute chart at the start of the London session here at 1. Let's go a little further to 2. And here we are in that area of the daily fair value gap and daily order block. From this point, you can expect some form of reaction. What we want to see is price opens, manipulates lower, and we just wait for that displacement higher, breaking structure, leaving fair value gaps. Nothing complicated here. So see what price gives us. Here we have something. Aggressive sells, aggressive buys. We break structure right here. We are in a key level. Why is it a key level? This is an overlapping daily bullish fair value gap, bullish order block. So you can already take your entry here at the start of the order block right there. Let's see if price even wants to test a discount array right here. So here we are in overlapping fair value gap and order block. See what price gives us here. It goes to the bottom fair value gap here. So in this area, you could take your entry. Most of the time, I take my entry just here, right here already. So I was in drawdown, stop below the low, target 1 to 2. So let's say these highs, open, low, high, close. I think you can even go to these failure swings. If you've seen my liquidity video, this is all low resistance liquidity, failure swings. So you can even make a monster trade out of this. This is exactly a trade I took myself. You can see the execution on my Twitter and on in the school group. But let's say low hang fruit right there, open, low, and now we're gonna see if we can get the distribution. We're still in London session, target Asia higher, and there you go. All using open, high, low, close in a key level. So zooming out, remember what we want to see? We want to see price trading into this area down the lower time frame. On the daily open, high, low, close, so Asia accumulation, London manipulation into a key level, what we saw the manipulation, we saw low being formed, aggressive sells, aggressive buys, and we took the entry accordingly. It's all based on the open, high, low, close coming into a key level right here, overlapping daily order block and fair value gap. And as you can see, the daily candle printed like this: open, low, high, close. And I do exactly the same on the 4-hour time frame. And this is one of my scalping models, and we do exactly the same, but then with a 4-hour open, high, low, close. So right here, we are really bullish here on ES, and we have an overlapping 4-hour fair value gap and order block. So that means on the 4-hour, the next 4-hour candle, I want to see an open, I want to see a low into a key level that can be somewhere here, ideally in the bullish order block, but we can already trade the fair value gap, then break structure and go to the upside. So exactly the same. Let's drop to the 1 minute, to the lower time frame, and you can do the same on the 5 minutes. Do whatever your preferred entry model is, because the execution on the 1 and the 5 minutes won't make a huge difference in your long-term win rate. So you can use both the 1 and the 5 minutes for this one. Same as you can use the 5 minute, the 1 minute for the daily open, high, low, close as well. The open, high, low, close model is based around creating a bias, a high probability bias. So the execution around that bias can be on the 1, the 5, the 50 minute, on the 2, 3, 4 minute, doesn't really matter. We're now looking at the same price action on ES at the end of the London session. We're approaching 4 a.m. and let's see if we create some structure. So what we want to see is aggressive sells, aggressive buys. We want to see a low created. So here we have some accumulation here, consolidation. I want to see aggressive sells, aggressive buys. Where do we get that? We tap the order block right now. Could be something. And this looks like we want to create a low. Why? We take some in this key level, overlapping 4-hour value gap order block. We sweep some short-term liquidity, and then we start breaking upwards. So from this point, let's see if the rates are holding. See a bullish value gap right here. Let's see if we can trade back into it or we just leave. It doesn't look like we want to trade back into this. Why? Because there's an order block sitting right here. We tap that here and we get another fair value gap. So then what I want to do is, based on this open, high, low, close, we can already take an entry right there. But the key is at the new 4-hour candle. On the indices, a new 4-hour candle is created on the 2 a.m., 6 a.m., and 10 a.m. So here we are starting with the new 6 a.m. candle to create an open, low, high, close. Because based on this move, I'm expecting this to be the low of the day. So I want this low to be protected. So my stop loss can be below this low to be protected, so we should be good. But an open, a low, and a high and a close on 4-hour. So we are now creating a low. Look at how the candle is forming. This is the current 4-hour candle. An open, low, high, close. I want to see the next fair value gap coming up. We are accumulating, we're chilling, and there we go. So there is some price action. Let's see how the 4-hour candle is printed. And I think you could already take your trade right here. Stop below the low 412. This will be the first entry. Let's see if we can get another entry. So based on this, there is some accumulation and there's not many fair value gaps. So I don't like this too much to trade. So I'm going to be later. I'm going to wait until I see some fair value gaps. This is displacement. So here at 6:30, here is where I would take my second entry right there. And what do we have as a target? Remember the liquidity video about all the failure swings? There we go. Low hanging fruit failure swings, I would say relative equal highs. So here we see series of relative equal highs. It's all pretty nice. And look at time here. This is all Asia high. So I would say you can take this as a target, this Asia high. So you target session liquidity. It's pretty fine. So right here and right here. For the stop loss placement for this candle, I want to put my stop loss below the start of the 4-hour candle. Or for 1 to 2, let's put a little upwards for 1 to 2. Ideally below the low, but let's just do it like this. Let's see what price case says. So come back into drawdown. And we're approaching New York session right now. So we're almost stopped out here. So a little lucky here. This way I need to have a good stop loss placement, ideally below these lows. And here we have another structure, so you can take another entry in the New York session right here. Stop below this low. And we are now approaching the New York Open, 9:30. And at the start of the new 4-hour candle, look at 10 a.m., new 4-hour candle, we hit the TP point on both of the trades. Exactly at 10:01. And this is more of a scalping model. Maybe less exciting because we were watching so many candles print, you need to wait for a while, but you could take an entry here, here, and here during the open, all based on a 4-hour open, high, low, close. And look again how this looks at the 4-hour. Look at that, how beautiful this candle prints. Let's remove the markers. Look at how we anticipated the low of the day right here in the overlapping order block and value gap, and the next candle prints higher. Based on this price action, I would say the 10 a.m. candle is also a bullish one. Why? Low of the day, 4-hour internal to external. Look at all the failure swings up here. So I would target the highs here. And let's see, boom. 10 a.m. candle goes to the highs. Makes sense, right? Failure swings. 4-hour internal to external. And here you have it, the open, high, low, close model. This is the exact entry model I use almost every single day to have a rock solid daily bias. And now you can use it to get funded, get payouts, get profitable. I created a free training where I break down how to get profitable and how to get to 100K and more in funding. I'll leave the link to that video in the description, so make sure to check it out right now. Thanks for watching. If you liked it, consider liking and subscribing, and I'll see you in the next one.
Alright guys, look at this. I just turned a tiny $500 account into over $8,000 in exactly 30 days. And because I finished on the top of a leaderboard of a trade competition, I won another $8,000. That's a total profit of $16,000, starting with only $500. That is a 3,200% return. Crazy, right? Now I'm gonna be honest. I didn't do this by acting like a gambler. I didn't full port, I didn't hope and pray, and I didn't trade 50 times per day. I did this by using one single entry model and ignoring 90% of the market. And in this video, I'm gonna show you exactly how I did it. So you can just copy the frameworks. We're going to speedrun this. 3 steps. First, we're going over the one model I used. Second, the risk glitch. How I survived when everyone else just started blowing their accounts. And third, the math you need to scale a small account into large numbers, which you can use on prop firms and personal accounts. Cool? Let's go. Most people treat prop firm accounts and these competitions like a lottery ticket. They let their monkey brain take over. They leverage to the max, chase every candle, and eventually just get wrecked. That's why 80% of the competition was already out by day 5. They wanted the excitement, but they got the liquidation. I didn't do that. I treated this like a casino business. I acted as the house. I realized to win this, I didn't need to be a genius. I just needed to be the only guy in the room who wasn't emotional unstable. Because here's the secret. Complexity is your enemy. And when you have only $500 to start with, you feel the urge to catch every move. That's a trap. Don't do it. To flip this account from $500 to $8,000, I stripped everything down. One entry model. And I told myself, if the setup comes, I'm going to shoot my bullet. If it's not coming, I'm sitting on my hands and just do something else with my day. Let's look at the chart. This is the model. It's part of my market maker blueprint. And it's so simple. Every beginner can do this. I look at 3 things. I look at the higher time frame bucket, the ITF bucket, and the lower time frame bucket. Higher time bucket is daily, weekly, monthly. ITF is 1 and 4 hours, stands for intermediate term time frame. And a lower time frame bucket is 1, 5, and 15. Here is your higher time frame bias. This is your lower time frame structure. Here is your execution. On the higher time frame, I'm looking for price to come back into internal range liquidity. Internal range liquidity is value gaps and order blocks. External range liquidity are all highs and lows. So I'm just waiting on, for example, the daily, go from internal to external. That is it. That's my bias. If I see that on the higher time frame, then I drop to the 1 and 4 hour to look for market maker models inside higher time frame internal to external bias. And what I mean by that is if you know what a market maker model is, it starts with an original consolidation, then it trades lower and lower and lower into a key level. That is this key level on the higher time frame. But now we're looking at a 1 or 4 hour structure. And all I then want to see is this. This is a smart money reversal. Make it easy, no fancy names. It is an aggressive sells into that fair value gap or that order block, and then aggressive buys back into the range. A break of structure is when this last high that made this low is being violated by this move. And we do this on the 1 and the 4 hour. And once we have that, once we break that structure, it will leave behind clues like inversion fair value gaps or order blocks or breakers. And inside those on the 1 and 4 hour, there is then when we drop to the lower time frame on the 1, 5, and 15 minutes to look for the structure. So from here, we can just go to the lower time frame to see, do we see the aggressive sells, aggressive buys on the 1 and 5 minutes, leaving order blocks, fair value gaps, breakers, and then take your entry right here. That is it. And I've dedicated videos to internal to external, liquidity, market maker models, and also lower time frame execution models like the 10 AM game here on this channel. I'm not going to waste your time and break them down step by step. I will also link those videos inside the description. This is the first big trade of the trade competition, where I only used a small percentage of my initial balance to get a huge head start, a huge profit on the account I can later use to compound with a 5 risk to reward. How? Let's look at the buckets. First, daily bullish fair value gap from internal to external. The initial drawn liquidity is right here. So the initial take profit point was here. The reason why I held had to do with the economic data that was coming out. Because at this point in time, there were talks about multiple rate cuts, quantitative easing, that means the money printer is going up. And if you know what it means from a fundamental perspective, you know that an asset like silver or gold or stock markets with the money printer, with quantitative easing, will run like crazy. So I was expecting a big expansion here on silver. So that's the reason why I did not close here, but held it until a 1 to 5. The reason why I closed at a 1 to 5 was because I wanted to use that money from the profits to recompound into new positions, the ones that we're going to discuss after this. From the daily internal, let's drop to the ITF to 1 and 4 hour. And here is where the entry is taken. And what do you see here on the 1 hour? Aggressive sells, aggressive buys, leaving a 1 hour fair value gap here. So this is already the first hint that we want to go higher. And once I saw this candle being printed and we rejected from this first fair value gap, right here is where I took the entry. And then in hindsight, you see another fair value gap, you see another order block being created. And if you go back to the buckets on the ITF, this is exactly what you should look for. Let me show you. This is what we saw on silver right here. And inside this price action, you can even drop like to the 1 and 5 minute to find a similar entry. So what I see here in the lower time frame, fair value gaps, just follow fair value gaps and displacement, fair value gaps, one here, with order block sitting right here, big massive order block that's being respected, and then we trade higher. So here on the 5 minute, you could also find your entries. I took this from the 1 hour and I didn't even use the 5 minute because the bias and the drawn liquidity was so clear on the HTF and the ITF. The lower time frame is not necessary. And I know majority of you watching is an intraday trader, but sometimes you don't even need the lower time frame. You can just enter with your stop loss in a good place and you should be fine. So from the internal to external on the daily, then it started running and basically traded the low of the whole session here on Friday and just expanded like crazy, like just up only, and it hit TP right there within a few hours actually. Like this trade was taken on Friday and TP was here on Monday already. So this one gave a nice $1,700 profit. This trade was the basis of the success of the trade competition. Without a big win at the start at these kind of competitions, especially when you want to compound very fast, you need a bigger win at the start like this. So you can now use the 1,700 from this trade together with the 500 that was already on account to then spread it out under multiple positions that you can compound as well. Now you don't risk 100, 200, or 300 per trade, but now you can risk 600, 700 per trade because you have more capital to play with. And yes, I'm aware that the percentage are very big compared to, for example, prop firms or a personal account where you most of the time risk between 1 and 5%, maybe 10% of the account. But there is a time element involved in these kind of trade competitions where you need to risk a little bit more because you don't have the luxury of time to let it compound because it's only 30 days. But the cool part is this model repeats multiple times per week on multiple different assets, forex, indices, metals, crypto, everything. The next bigger trade was on GBP US dollar using the exact same logic with the HTF, ITF, and LTF with the 3 buckets. This trade on a higher time frame, we see a daily bullish order block sitting here and also a bullish breaker. And this is the starting point of the idea that was taken on Tuesday, December 2nd. And I just dropped to the ITF to find the structure. Here we're looking at a 1 hour chart and the green line is the daily bullish order block. See an aggressive sells into the order block, then the aggressive buys coming in, and your eyes immediately should go to this right here, a fair value gap. Once you were there right here, there is where you could take your entry. And now based on this higher time frame logic and the ITF logic, let's drop to the lower time frame. Let's see the 15-minute and see how you could also take an entry on the lower time frame. That's exactly the same structure with fair value gap here, order block sitting there, then another fair value gap right here. And here is exactly where I took the trade, right here in this fair value gap at 32.03. Right here during the PM session. So the HDF bucket is a higher time frame order block, and then on the 1 hour time frame we did aggressive sells, aggressive buys, and here on a 15-minute time frame together with the 1 hour time frame you could take your trade. And to be completely honest with you guys, my original target was these equal highs, but when I saw this expansion without any retracement, I wanted to use that profit to compound the rest of the account even more. And with this trade, I was even in the first place for an entire week before the rest of the top 5 started to catch up with me. And also the majority of the time, you won't have these clean expansions. There's a little luck factor involved. Most of the time, it will be with more retracements like this. But this was just one big clean trade to a drawn liquidity. And here's a trade that was taken in the final week and got me to the second place of the trade competition and eventually to the $8,000 balance and the $8,000 price with $16,000 in total. Higher time frame bucket, daily, internal to external. Drawn liquidity is here, but with the time element involved, I did not hold until that. I already had like a 1 to 7 or 1 to 8. It was enough. And I didn't want to risk price retracing and then go higher. But after the competition, there was a deadline involved. It was the final few days of trade competition. So I didn't want to be at risk of price just coming back here and vaporizing the paper profits. I wanted to look in. I wanted to look in the top 3 spot at least, because before this trade, I was by far not at second or first place. I was like third, maybe fourth. I was hanging on by a thread. And the number 1 and 2 were already miles ahead of me. If I remember correctly, I was at $4,000 balance and those 1 and 2 guys were already at 7. So I need just to close this trade to secure my spot in the top 3 to be eligible for the bigger prices. So higher time frame, internal to external. Let's drop to the 4 hour to see the entry logic, see aggressive sells, aggressive buys, leaving a 4 hour fair value gap. And you guys know by now that this is the ITF 4 hour structure. And then we can just drop to the 1, 5 or 15-minute to find the entries. And if you drop to the 5-minute time frame here, you see price coming back, aggressive sells here, aggressive buys here, with an inversion fair value gap, with a bullish fair value gap. All the lower time frame structure is there as well. That is enough for me to press the button. And then price just rockets upwards with a little retracement here during the Asian session. And on the final day of the trade competition, it expanded again, locking in the final few profits of the competition. And I repeated this setup many times during these 30 days of the trade competition. No deviation, no feeling the market, just executing the data on a model that works in the long run. The one model I just showed you that is part of the market maker blueprint. But a good strategy is not enough. You need aggressive defense. You think you need to take massive risks to win the competition? Wrong. You just need to survive so you can let do the compounding do its work. My rule is very simple, the 2-bullet rule. If I take 2 losses, I'm done. Screens off, walk away, go to the beach. No revenge trading, no trying to get it back. Preserving capital is the ultimate offense. But finally, how do you turn $500 into $8,000 and with the prize money even $60,000 without reckless gambling? And it's by using the house's money. And what I mean by that, if you start with $500, if you go to 1,000 or to 2,000, you're not risking that initial 500 anymore. You're risking free money, the profit money. And this is the cheat code. I wasn't afraid to lose anymore because the principal of 500 was safe. And this allowed me to execute my one model without hesitation. While other traders were scared to pull the trigger because they were risking rent money, I was aggressively executing because I was playing with profits. If you have data on your model, you know that something works. Together with zero fear, you will get a massive ROI. So listen up. I didn't turn $500 into $16,000 because I'm a genius. I did it because I was the most bored person in the competition. I waited for one model, I respected my data, and let the other guys blow their accounts where I was sitting on my hands. The trading industry sells you excitement. I'm selling you a repeatable, boring trading business. That is the speedrun to becoming profitable. If you want to learn the exact model I used to flip $500 into $16,000, the entry criteria, the risk rules, the data points, I teach it in my new Market Maker Blueprint. I'll leave the link to the Market Maker Blueprint inside the description. And next to the Market Maker Blueprint, make sure you watch the video that's now appearing on the screen. Use this video together with this one to grow even faster. I'll put it on the screen somewhere here and you'll also find it in the description. It's time to stop gambling, start winning, and I'll see you in the next one. Bye-bye.
In this video, I'm going to walk you through a proven A+ setup with a checklist so you can follow it step by step. With this A+ setup, you can get profitable, get funded, get payouts, and I use this exact A+ setup to gain over $1 million in funding and over $100,000 in profits. No time to waste, let me show you how it works. So the first step in the checklist is a liquidity sweep in a key level. A liquidity sweep in this example is a swing low that's being ran into a key level. A key level is a old low, old high for value gaps, order blocks,
most of the time in this bullish example, I use an old low or a bullish fair value gap as my key level, and use time frame alignment with this. So if this is a weekly fair value gap or an old weekly low, then use a 4-hour structure to get this entry in. Most of you watching this are intraday traders. So let's say this is a 1-hour fair value gap. Then I use a 5-minute structure. This is a 50-minute fair value gap. Then I use a 1-minute structure. So when you see the liquidity sweep into a key level, then you want to see second is a market structure shift. Market structure shift is when the last swing high that took the low is taken out. And it is right here. So here you have a market structure shift. Then for the entry, you wait for a retracement into a fair value gap, order block, or breaker. And the more that are present in that area, the higher the probability it is. I don't have like a set PD array I'm trading. Most of my entries are around fair value gaps and order blocks. Sometimes there's a breaker as well. But use for yourself the PD array that works the best for you. So let's say in this area, there is a fair value gap that's been created because this displacement of the market structure shift. There's an order block in the area. There's a breaker in the area. So once price comes back into here, I'll also use premium discount or optimal trade entry to go from swing high to swing low to want the displacement range. When the price comes back to discount of the range in a long example. If you're in a bearish example, then you want to short into premium of the range. But here in this example, we're doing a discount of the range. And what I just did was Option I or Control I on your keyboard if you want that shortcut. And OT is from swing low to swing high. So once price comes back into the OT area, that could be a very nice point to take an entry. And finally, the structure needs to form in a kill zone. So use time in your trading. Use time and price. So let's say this is in London kill zone or New York kill zone. Let's say it's at 9:30 a.m. EST. Awesome. That's what we want. I'm not going to waste your time in this video to breaking exactly how fair value gaps work or how breakers work or how premium discount works. I have dedicated videos to all of these concepts here on this channel. I'll leave the link to them in the description. I have a full 90-minute mini course where I break down every single ICT concept very fast, very precise. So check that out after this video. And now you know the framework, let's dive into some examples to see this in real time. I spent hundreds of hours studying ICT concepts and I broke down every single concept with my own personal notes in this 500-page PDF. It goes over everything from entry models to the different concepts, from interest rates to everything you need. So if you want to save those hundreds of hours, want to get it right now, I will leave the link to this PDF in the description. Here we're looking at ES on the 1-minute chart and look at the time, it's 10 a.m. So inside the New York kill zone, we just traded into an overlapping 15-minute and a 1-hour bullish fair value gap. And we just had a liquidity sweep right there. We took out a swing low into a key level. That's the first step. Time frame alignment, 15 minutes and 1-minute structure. And now let's see for the second step is a market structure shift. What's the last swing high that took the low? That is right here. So once we broke structure here, there is where the entry comes in. For value gap here, you have an order block sitting right here. So inside this area, you could already take in a trade stop below the low for static 1 to 2. You can also target these highs, but let's say you also only want 1 to 2s. See if we find an entry. So price comes here into the value gap and then moves higher towards the area. Cool. And let's say you miss this first entry. I like to take my entries in for value gaps. So let's say here's the other value gap. Take your entry right there. TP above the highs for 1 to 2. And also the second entry would have given you TP. Why? Because the drawn liquidity was this high. For the next example, we're looking at NASDAQ at the 5-minute chart. And we just took out session liquidity inside a key level. The key level was a daily bearish fair value gap. So once we take out the liquidity into a key level, we start to break structure. Last swing low that took the high. And now we have this fair value gap. So your entry can be taken right here. Stop above the high for 1 to 2. Ideally, you can target the upcoming swing low. So I would want to do that. A little high risk to reward. It's also a bearish order block right here and also potential OTE entry. So our entry could also be here at the OTE, but when we have all those overlapping PD rates, I'm just good to take my entry on the start PD rates and let my stop loss be able to trade into them before trading lower. Like I don't need to catch the absolute top. I just want to make money. So my stop loss will cover potential trades into the OTE area. So let's see what price gives us. So we tap into it 2 times, here and here. Maybe even 3rd time. No, we don't do that. And then here we go to the draw on liquidity. That's this swing low. So if you would have waited for the order block for the OTE area, you would have missed this move. An example where price for this first entry does not come back to premium of the range. So if you would have wanted a premium discount, then you would have missed this trade, and that's fine as well. You cannot be in every single trade. The A+ setup is when price comes back to premium. If you go back here, Once price taps into here and then creates a new low down here, there's a new range created right here. And for the second entry, price comes back into premium of the range. So for this entry, one on the PM session here, there is where the A plus setup was. So the entry would have been officially right there, not here. And there the entire A plus setup was present. Liquidity sweep into a key level, market structure shift, price come back into the fair value gap in premium of the range, and it's formed inside the PM session, inside that kill zone. And then price goes lower. And in this final example, we're looking at NASDAQ on the 1 minute chart and looking at the time we are in the New York kill zone. And we have a old daily low right here. So what we want to see is a liquidity sweep. Well, we take a swing low here. And from here, you want to see a market structure shift. So do we get it already? No, because there's no last swing high be taken out. But then we have another liquidity sweep down here inside key level, the daily low. And then we break structure. The last swing high that took the low right here gets violated. And here is where your entry could be. For value gap, order book breaker. And if you miss that one, so here your first entry could be stop below the low, target the high. Entry 1. Let's say you miss this one. There's another value created here, right there. Second entry could be here. And this is a trade I actually took myself here in the second fair value gap. Stop below the low, see a bigger target. And where can we trade towards? Well, there's all these failure swings. So you can basically target all these highs here. But let's say you want to target low-hanging fruit. When I would target this high, then you see the risk reward is not worth it. So you need to or up your TP, that's what I want to do. Or make your stop loss smaller, so you can put your stop loss below this fair value gap. Let's make a bigger trade right there. And price taps into this fair value gap. So here you are in for the second entry. And there's where price starts to move. And already that first liquidity pool is taken. And why is price so fast here? Why does price not stick around here? That's because there are failure swings here. Low resistance liquidity. Those are swing highs that don't take out any liquidity. So if you watch my liquidity video on my channel, you will see exactly this happening when you have low resistance liquidity. So price chills here for a while, and just after the New York lunch, the trade hit TP. So not only that one, you could have taken 2 trades. A smaller one and a bigger one was all based on the A plus setup. You wait for liquidity sweep into a key level, the daily low in this example. You wait for a market structure shift. You use your value gaps or blocks or breakers for your entries. And the structure is forming inside time. And what you're missing here is price that comes back into discount of the range. Right here, you see price does not come back to discount of the range. And here again, when you use premium discount, you would have missed this trade again. So in bullish conditions, very trending conditions, you might want to be more flexible with the premium discount or let your stop loss be able to price to come back into the discount range before taking the long example. Based on my data, I noticed that I take my trades earlier and use my drawdown, my stop loss for price if it wants to come back deeper into the range, to OTE, to discount range, to cover that so I don't get stopped out before the real move. And there you have it, the A plus setup. Use this setup to go backtest, go journal this, and build data on what's working for you. This is the exact framework I use to get funded, to get payouts. I'm very confident you can do too. If you like this video, consider liking and subscribing. If you're not inside my free school group where I trade every single week, I share my trade ideas every single day. There's lots of free trading material available inside that. I will leave the link to my school group in the description. Thanks for watching, and I'll see you in the next one. Bye-bye. I trade the New York session every single day. I love the volatility. But let's be honest with each other. Sometimes the morning session is absolute trash. Sometimes it's just stop hunts, high impact news, chaos, or worse, it gives you absolute zero clear setups. It's just noise. Most traders panic when this happens. You stare at the screen for 3 hours, you get bored, and then force a stupid trade at the end of the session just to feel involved. That is how you blow accounts. I don't stress when the morning gives me nothing. Why? Because I know that while the AM session creates the mess, the PM session is most likely to clean this up. The PM session is not about finding for a position, it's about continuation. It is cleaner, it is slower, it's where the easiest money of the day is made because the narrative has already been revealed. But before we go further, a crucial rule. This works works for US indices. If you trade NASDAQ, ES, or YM, pay attention. If you trade Forex pairs like Euro dollar or GBP US dollar, turn this video off. Forex pairs usually die in the New York PM session. There's no volatility, but on the indices, the PM session is where the smart money balances the books. In this video, I'm going to break down the 3 phases of my PM session protocol, step by step, using the kill zones indicator to make it visual, and how to apply the protocol mechanically on a chart every single day, so you can start making money too. Before we look at candles, you need to understand the logic behind the protocol. House trades based on a framework, not random patterns. That is for gamblers. In this protocol, there are 3 phases. The first phase is the narrative and the bias. Before execution, you need to establish the narrative by identifying who is profitable currently in the move and where are still liquidity pools resting. The PM session model is most of the time a continuation move. Where the AM session already expanded, you will see that lunch most of the time retraces and then PM session just continues the move it started at the AM session. So the first step you need to do in phase 1 is look at what we did at 10 a.m. What did we do during the New York AM session? So you have a bullish bias for the PM session if price is trading above the 10 a.m. open. If you're trading below the 10 a.m. open, you probably have a bearish bias. But what is more powerful about this framework is the profit check. You need to ask yourself, who is profitable right now? So what that means is if price expanded during the AM session and we are starting the PM session like this, there are some short-term stops resting below here. So people have stop losses below this. So for the PM session, it will be very nice if it sweeps those liquidity pools and then continues. Similar, if you are bearish at the AM session, you need to look for short-term liquidity pools to be ran into before continuing the move lower towards a drawn liquidity. And next to the 10 a.m. anchor and the profit check, you really need to know how to find liquidity and make this very simple. Liquidity is nothing more than highs and lows. And the 3 best liquidity pools is session liquidity, daily liquidity, and weekly liquidity. Session liquidity, London higher low, Asia higher low, AM higher low, and of course daily and weekly are highs and lows as well. So locate the nearest liquidity pool buy or sell side that has not been tapped yet. So when a PM session model appears, we most likely still have a liquidity pool that's not been targeted yet. We still haven't met the daily drawn liquidity. Same if you're bearish. So if you are preparing yourself for the PM session model, make sure you have your session liquidity and daily liquidity marked out on your chart and see if we still can reach that. When we determined our bias and a narrative, in phase 2, we're going to look at the setup with something called spooling during lunch, and that's 12 p.m. New York time. What you'll see is that the algorithm uses the lunch hour to retrace into a PD array rather to the AM trading range. So if we're bullish, you will see that the lunch hour retraces before then the PM session continues. But the retracement is very important to look out for. So the key criteria for the setup in phase 2 is expect some form of retracement. And that retracement will form between 12 p.m. and 1:30 p.m. EST, New York time. And to validate if this still works, a little filter, if you're bullish, when price makes this retracement, the PD arrays like value gaps, order blocks, and breakers still need to hold before continuing upwards. If you see them failing, we're most likely going lower. You need to see your discount arrays holding. Same if you're bearish. You want to see your premium array holding to continue lower during that retracement. And during this PM session, there are no new extremes. What no new extreme means is ideally the lowest low for buys right here, or the high side for sell of the retracement forms before the PM session fully kicks in. So this retracement move and the low that's being set right here needs to kick in before the PM session starts. And I would say that the PM session starts at 1:30 p.m. EST and kicks off fully after 2 p.m. with a new 4-hour candle opening. So in phase 1 and 2, you want to see this. You want a clear bias. If we are bullish, ideally with also a clear drawn liquidity up here. And then in phase 2, when we do the lunch retracement before 1:30 p.m., you like to see the low being created. So then the expansion can start in the PM session and you can take your entries right here. And talking about entries, let's talk about phase 3. This is where the money is made. And you can use 2 options. You can use the silver bullet that starts at 1:45 p.m. until 3. Yes, I know ICT says from 2 to 3, but I've seen based on my data that you can take many entries already at 1:45. The focus is on the continuation of the AM trend or a run on the first liquidity target. That means we're just playing the continuation right here. And what to use for triggers, you need to wait for a fair value gap to form in the direction of your bias on a 1, 2, or 5 minute charts. That means when we have this lunch retracement, we take out some short-term liquidity, then this fair value gap you need to wait for. That there is a fair value gap created right here. And then your entries then be taken right here. And this should happen prior to 1:30 p.m. ideally, and this entry is from 1:45 p.m. and up. But again, there needs to be clear drawn liquidity, some form of session liquidity, for example. The second option is the final hour macro, the power hour. Shout out to Flux Trades. I learned this a long time ago using his YouTube video, so shout out to him. And that happens after 3, where you see the final flush. In the final hour, closer to the end of the day, is when price just aggressively reprice towards a certain area. So what you will notice is if you have a clear drawn liquidity, but this move hasn't happened before 3, you can expect potentially power hour when this move is going to happen from 3 p.m. And the best way to spot if this is going to happen, so you will see some consolidation before that, but you want to see an aggressive sells, aggressive buys. And the tell here is the aggressive sells leaves a fair value gap that is not being respected, is ignored. There's an inversion fair value gap. So when that happens, and also, of course, there's a new fair value gap formed, there is where the entry most likely is going to form. In the power hour, you then go to the draw on liquidity. The entry can be taking the fair value gap or the newly created breaker block right here. These three phases are the theory. It sounds simple because it is simple. You're suffering from a smart guy syndrome that most losing traders have, where they try to overcomplicate very simple things. Now let's go to the chart to see examples, and also I will show you an indicator how to make this very visual. Here we look at NASDAQ at the 50-minute chart, and you see the colored boxes here. These are the different sessions, the kill zones. If you go to indicators and type in ICT kill zones and pivots, this one, and then go to settings, where you can pick the London session from 2 to 5, the New York AM session from 9:30 to 11, and the PM session, the one from this protocol, from 1:30 to 4. You see the boxes here on the chart, where the purple is PM, London, New York. And this is how you can use the three phases in action. For the first phase, we need to know, okay, what does 10 AM? What do we do here? I see that we trading back into the range here, right here, also in a higher time frame for value gap, and then react from there to the upside. So for the PM session, my bias is going to be bullish based on this 10 AM game anchor. 10 AM is bullish. So I'm going to try to catch a continuation during the PM session. The profit check, who has been profitable today? Well, I guess everyone here. I think price could rebalance to imbalances for value gaps. This for value gap has already been balanced, so I don't expect it to come back. But these two, I'm expecting for lunch. Look at the time, it's 12:30 to retrace back into around 1:30 and then continue. And then identify untapped liquidity. Well, let's zoom out. What do we see right here? I see a massive fair value gap sitting here, also a high. But these two liquidity pools could still be ran into during the PM session. Cool. And then for the lunch spooling, what I want to see is a retracement closer to 1:30. So let's mark out 1:30 right here. And we see what happens here. We see there is a retracement here at 2:30 right here. So there's an accumulation here, then the manipulation back into this fair value gap. And now we start moving upwards, creating also a bullish fair value gap here on this 15-minute time frame. So here this PM session model could play out. You just play the continuation. And this is now how the 50-minute structure looks like. So from this point, we can just drop to a lower time frame to find our entries. Using option A or B, well, looking at the time, it's almost 3, so we're probably going to have a power hour today. Here at the 1 minute, we already have the liquidity sweep, break of structure, fair value gap, also fair value gap respected here. So the structure is holding. So my eyes are now going to see if we can get a reaction on this level. No, we don't. We trade from this fair value gap and then higher. Then in this structure, there's another fair value gap created. So then I'm expecting price not to come back here anymore. Then I would take the entry a little late to the party here. So let's say I take it here. Stop below this low for 1 to 2. You can also target the highs in the fair value gap, but keep in mind in the PM session, it is low hang fruits. It's boring. The ranges are small. You just want to catch base hits here. In the PM session, you won't catch massive expansions. And then price goes to the draw on liquidity. If you zoom in more on this price action, see the price comes back in this fair value gap again. You see how the structure is holding? That is what you want to see when you're inside a trade. For value gaps, order blocks, everything is holding. But now we are on the 1 minute in the power hour. But we all did that by zooming out on these three phases. Where in phase 1, we identified that AM session is expanding. So we just want to catch the retracement and continue. In phase 2, we saw the setup forming with this retracement into a key level. And then on the 1 minute, we could just find our entry during the power hour. Predictable, boring, and profitable. Now let's see if your eyes are trained already. Right here in the New York AM session, we have a bearish buy. So we expand lower at 10 AM. So the continuation move is going to be lower. If you look at the left side, we have a daily low sitting here. But that's going to be the draw on liquidity. So we have a very clear bias and narrative for this session. Then in phase 2, we want lunch to spool, want to retrace, which we see right here at 12:45. We see a retracement move back into this bearish fair value gap. I'm not going to catch bottoms or tops here. We just want to see, okay, go to a lower time frame and see, do we find an entry on the 1 minute? Do we find an entry on the lower time frame? And it doesn't look like it's right here, but we still have the liquidity pool down here. So during the PM session, there is where I'm going to hunt for setups. So let's see what price does here. So here you see the first change in character with a bearish fair value gap there. Then we start trading lower. This is the signature in price that we most likely want to go to the downside towards here. So now it's the question, we need to find a fair value gap. Do we trade somewhere in? Yeah, we do, right here. So here at 1:30, here's your entry towards the lows here. Entry in the fair value gap, target at the lows for 1 to 2. You might wonder, am I not scared that price comes back into these fair value gaps? No, because there's a mitigation block sitting right here. And see how price respects that mitigation block right here. And not only that, let's remove this purple box here. We even created some structure inside our entry right here. This fair value gap. So you could also took it right here at 1:45. And I want to show you something based on this trade. And it's about having enough. So we hit the target, and then price starts trading upwards. And notice what happens after we hit the target. The market reversed. And that brings me to the most important rule of this whole framework. Having enough. You don't need to catch the bottom. You don't need to catch the top. You don't need to catch an expansion. You're just catching base hits with this PM protocol. Most of you stay in trades too long because you're greedy. But the house isn't greedy. Only the gamblers are greedy. The casino takes a mathematically probable portion of the move and leaves the rest to the gamblers. So if you can follow this 3-phase blueprint with the 10 AM anchor with the bias, the lunch spool, and the execution frameworks during the silver bullet and the power hour, you don't need to stress about the morning chaos ever again. And this is an entry model I give my students when they're too busy with their 9 to 5 or family responsibilities. If they can't trade AM session, you can just start trading the PM session with this exact protocol. If you want to see this applied in real time, you can find it inside my Discord together with a complete technical bootcamp, prop firm frameworks, and more. So come join the Discord. It's free. It's time to stop gambling, start trading like a business. See you in the Discord. And before you go, make sure you check out this video that's now on the screen, because combining that video with the video you saw today, you can make even more money with trading. Thanks for watching, and I'll see you in the next one. Alright guys, welcome to this new video. I got a ton of requests creating this video, and today in this video I'm going to walk you through the entire 10 AM game plan checklist. I look at this exact piece of paper every day before I trade, and there's simply one rule. If I cannot check every single box for the checklist, I will simply not trade. I will not press the button, I will sit on my hands. This video is going to walk you through fully how to do this yourself in just 3 simple steps. Without further ado, let's hop to the chart to see some examples so you can copy paste this entry model to make money. Cool, so step 1 is going to be the prediction. We need to predict the next 4-hour candle. It's called 10 AM game for a reason. It's because we play the new 4-hour candle at 10 AM New York time every single day. And the simple way how you can predict the next 4-hour candle is look at the previous one and also look at higher time frame PD rays. What I see right here is a 4-hour bullish order block right here, and I see a bullish fair value gap sitting right here on the 4-hour. And here at 6 AM, that's the candle where the New York opens. We traded to that area where we could reverse form and then just continue with the trend to the upside. So because this is a rejection candle, we trade into it, but we leave a big wick to the upside. I'm predicting that the next 4-hour candle is going to be a bullish one. If you predict a bullish candle works with an open, a low, and then a high and a close. So with this bias, this is what we're going to use on the lower time frame to find our entry criteria, our entries. And this isn't just on NASDAQ and on the indices. This works on Forex, on metals, everywhere. For example, here on silver, what we did is we swept a weekly low right here, and we swept a weekly low inside a key level, a 4-hour bullish value gap, and now start to react upwards. Oh, yes, we have a 4-hour bearish value gap, but here you can play the 10 AM game as well. So with this bias, we just swept liquidity, and also we are in a pretty big uptrend on the higher time frame. My bias is definitely going to be longs. I want to see at least price trading back into this top for value gap and maybe also into the order block that is resting above it right here. Also from that, the prediction is going to be a bullish candle. Oh, you thought we were done here? Notice that even third example here on YM, the Dow Jones. Here we're trading to a 4-hour bullish fair value gap at 6 AM, so at the New York open with a bullish bias. So also this candle, I'm going to play an open, high, low, close, a bullish candle. The prediction is going to be a bullish candle at least towards these relative equal highs right here. Cool. Now you know step 1 out of 3. That's how to predict the next 4-hour candle. We need to talk about step 2. That's the actual setup on the lower time frame. So across all the 3 examples on NASDAQ, silver, and Miami, we have a bullish bias. And if you have a bullish bias, you predict that the next 4-hour candle is most likely going to be a bullish candle. And we wait for the lower time frame, if we expect a bullish candle, for a power of 3 or an AMD. So that means accumulation, manipulation lower in a key level, and then start the distribution, catching the full range of that 4-hour candle. So this is where we focus on the lower time frame. And what you will see is that price is not always as picture perfect as you see on all the YouTube videos. Sometimes there's more nuances. So with step 1 with the bias, even when you have choppy delivery at a lower time frame, you can still make money. So let's take a look at the example right now. We're looking at NASDAQ at the 1-minute chart. And the big yellow box right here is a 4-hour bullish for value gap. So already before 10 AM, we are potentially starting the aggressive sells in a key level, aggressive buys. So it means at 10 AM when the new 4-hour candle opens, I don't need price to come back into this low. This low is already good, like in a kill zone, 950. So the setup is most likely going to appear in that displacement range before 10 AM. That's this range right here. So all you need to focus on is and wait for that small accumulation. The accumulation doesn't need to be long. Remember, accumulation, manipulation, distribution. The first few minutes of the 10 AM candle needs to be some form of accumulation. Can be a few minutes. It sometimes lasts 30, even 1 hour. It depends for 10 AM. The nuance I want to show you on this exact example is that because we already traded into a key level, we will not trade back into here. So somewhere here in this range is going to be the accumulation, manipulation, distribution. I don't care if it's here or all the way down here. It doesn't really matter. So that's step 2. Predict the next 4-hour candle is 1. Now we look at the setup. We need to wait for accumulation, manipulation, what we see right here. And for the actual entry, first I want to show you the exact setup also on silver on YM. So here look at the same example on silver where we had a 4-hour bullish for value gap. And step 1, we predicted the next 4-hour candle is going to be a bullish one. So when price opens here at 10 AM, see there's already a fair value gap created here, but we're looking for that accumulation, manipulation, distribution. So we need to have some form of manipulation below that 4-hour candle because the 4-hour 4-hour candle wick needs to be put in. Every single candle has a wick. If you see a candle without a wick, that is suspect. So we need a clear 4-hour candle wick being put in. This could already be it. And before we look at the actual entry setup and how we take the entries to make the most amount of money, the similar setup will appear here on YM on the 1-minute chart. Here at 10, we already trade into a 4-hour bullish fair value gap, so a key level. So we don't need to come back to this low anymore. We're going to play a continuation into the displacement range. We already see fair value gaps here. Our setup, our manipulation will probably appear somewhere here. So we anticipate accumulation, manipulation lower, probably here. There's not much to rebend, or maybe here. Set the low of the 4-hour candle wick there and then trade higher in the distribution of the AMD. So from all the 3 examples, we now know how to predict the next 4-hour candle is bullish on all of those. And also we know how the setup is created. That means we let price come to us. We know exactly what to look for. Our eyes are trained to wait, to be patient to what's actually coming. And now let's go to step 3. Cool. And now the most exciting part, how to make the most amount of money based on these 3 simple steps. Step 3 is the signal. What actually do we need to look for before we take an entry? This example here on the NASDAQ, we already knew, okay, 4-hour candle is going to be bullish. Here at 10 a.m., we immediately sell off. So we're probably going to have a accumulation here, manipulation into here, and then start distribution. These candles already show its hand that we most likely are now going to start the distribution. So the low of the 4-hour candle is now being put in. What I'm looking for is the 2 PD array rule. I want to see 1 PD array being the test PD array, and this example is going to be this bullish fair value gap. Ideally, I also would like a inversion fair value gap to be created. So here's the test fair value gap, test PD array, and I say test PD array because it's purely to see, okay, are we actually wanting to go higher, or are we just going to trade lower and lower? And here, after we start creating the up close candles, this bearish fair value gap got completely ignored, inversed. So that means this is going to be inversion fair value gap. So this would already be the second PD array, the 2 PD array test, the second PD array for me to enter. So when we close above this inversion fair value gap, we have PD array 1, PD array 2. Here could already be the entry after this candle close. If you even want to wait more, you can just wait for a new fair value gap to be created. Let's see what we do here. It's a very choppy delivery. You could already take your entry right here after the inversion fair value gap was closed. Stop below the low for a 1 to 2. That'll be the first option here. If you rather wait for another bullish fair value gap to be created because you maybe don't like inversion fair value gaps, you could take your entry from this fair value gap here. Where you stop, then it's going to be below the last line of defense. It's going to be this bullish fair value gap or below this low. I like to put my stop loss below the last fair value gap or below the last low. But let's say we do below the last low for 1 to 2. And then we start the distribution. So a very short accumulation. You can even maybe not even call this accumulation. We go lower immediately. Why do we not accumulate for a long time here? Because before 10 a.m. at the open, at the 6 a.m. candle, we already traded to that key level where we want to move away from to the upside. And then we manipulate, test fair value gap, test PD array, inversion fair value gap for this first entry. If you want to wait a little bit longer, you can take it right here. Wait for the basically the third PD array. In my opinion, 2 PD arrays are enough. And now let's see how this works out. So you already could see how choppy this delivery was. So even when the bias is correct, this is an actual trade I took myself. The bias was so easy. The bias was so correct because we're basically just playing a 4-hour internal to external. We just wait for price to create the bias structure. And we did it right here. We stayed in this area for such a long time. And that can happen. Like, you cannot predict the actual delivery, but what you can predict is the bias. Your actual daily bias is created right here. Step 1 is predicting the next 4-hour candle. Check. Step 2 is the entry. We want to have an AMD, an accumulation, and manipulation lower into a key level. So here's 2. And for the actual entry criteria, use the 2 PD array rule. Step 3, use 1 as a test PD array. This was our test PD array. And then take your entry in the next PD array. So you are less likely to get faked out. And you might wonder, does this work every day? Yes, it does work every day. As long as there's a clear step 1. That means as long as the next 4-hour candle is pretty easy to predict, like we saw here, which is nearly every single day, you can play the whole 10 a.m. game. So when we look at the same example on silver, it's here before 10 a.m. We already traded to the key level, so we don't need to come back here per se. But at 10 a.m., we want to see an accumulation. 10 a.m. starts right here. Accumulation, manipulation lower. If I'm looking at this price action, if we zoom in on this price action, I see here is we already balanced here, but we did not balance this fair value gap yet. So we could make the manipulation into here. Not sure. We just want to see some form of manipulation outside of this consolidation range. See, we consolidate and then we trade lower. So here you see very clearly the accumulation. Now the manipulation lower, and I honestly don't care. I'm not a bottom ticker. I don't care if the manipulation is created here or we take this low one more time. I don't care. I'm just waiting for those 2 PD array rule. At that point, we have an inversion fair value gap sitting right here. That's PD array 1. So the next fair value gap that's being traded into could be here, could be here. There's where the entry is going to be here. That's it. Here's the entry. Right here, stop below last line of defense. I would say below the inversion fair value gap here for a 1 to 2. So price stays inside that fair value gap for a while. We know the bias of the 4-hour candle is very strong. And there it goes. So where we saw step 1 is predicting the next 4-hour candle is a bullish one. Step 2, the setup, is an AMD power of 3, accumulation, manipulation, distribution. And how we do that is with the 2 PD array rule. We wait for the first PD array to be created. That is right here after the manipulation, the inversion for value gap. And then the second PD array is going to be here inside this bullish for value gap. Delivery here, don't expect if you take a trade that it goes to TP in 5 minutes. Sometimes it does, but the majority of the time it happens like this. It just stays for a while. Entry was at 10:48. It started moving 30 minutes after. And then you add your TP. And in the third example on YM, we already knew 4-hour candle is going to be bullish. We know that the manipulation needs to happen probably, because here is already before 10 a.m. we already traded to the key level. It's priced to accumulate, manipulate lower, and then start distribution higher. Let's see at 10 a.m. right here, 10 a.m. starts, we accumulate. There's already a manipulation. Look at this. Accumulation, manipulation into a fair value gap right here. So with this already price showing that probably this is going to be already the low of the 4-hour candle. So then here, where the entry can be found, right here. Stop below the last line of defense right here, or it can be below the low. I like it to put it here, below this fair value gap, or I wanted to. And then price goes to a TP. And the reason why I show you 3 examples on 3 different assets, because it not only nearly happens every single day, but it also can be used across all the different asset classes. Where step 1 is predicting the next 4-hour candle. Step 2 is the setup, accumulation, manipulation after 10 a.m. and then start the distribution. And for the entries, use the 2 PD array rule to get the highest win rate and don't get faked out as much. This strategy happens constantly and it gives order in the chaos of the New York session, especially at the open. Now, I know it can be hard to remember, and that's why I created the entire 10 a.m. game cheat sheet with all the entry criteria I use every single morning when I trade. It walks you through phase 1, 2, and 3, so you never miss a step. If you want to download this exact checklist, I'm giving it away for free. Just get the link in the description or in the Discord, and it's also across all my Instagram. Just grab it and start trading on it. And if you want to see me trade this live every single day, just join my Discord and see how I make money with this together with my community. So come join us, grab the checklist, and start winning with us immediately. Thanks for watching, and before you go, make sure you check out this exact video, because watching this video about a 10 a.m. game together with this video, you not only have an insane hit rate, but you also actually going to start make money with this exact entry model. Cool. Enjoy this video. Thanks for watching, and I'll see you in the next one.
One candle will change your life. If you're tired of all those complicated ICT strategies and you work a 9 to 5, you cannot watch the chart all day, this model is going to be perfect for you. And the model I'm going to teach you today is otherwise known as the candle range theory or the next day model. Like, there's so many different names for the same beast, but I want to teach you the exact concept that laid under all these fancy names. So let's get into it. The first one we'll do on the daily, weekly, monthly, the higher time frame is marking out swing highs and swing lows. If you're not sure what swing highs and lows are, I've dedicated videos on liquidity on this channel. So every time we're going up, we mark out old highs, we mark out old lows, old highs. And our model is going to be based around those old highs and old lows. And we want to see how we close the candle around those highs and lows. And what that means is, if you have a daily, weekly, monthly extra range liquidity, so an old high, and we close over it, so you see a body that is closing over the high, then we expect the next candle to be bullish as well. Why? If you zoom in on this single candle on the higher time frame, the lower time frame, you will see this happening. You will see trending conditions to the upside. So when we have a certain pair you're watching, you see this happening. Then the next candle, so let's say this is a weekly candle, and you see this happening on the week, then the next week you're going to anticipate a bullish candle, so an open, low, high, close. And on the lower time frame, that will look like a open, a low, a high, and a close. So you can catch that move right here to take it to the upside. But what if the body does not close above the old high or low, in this case an old high? We see a rejection happening. And if you zoom in on a rejection candle like this, on the lower time frame, that looks like this. We trade upward, but then when we hit that high, we reject, breaking structure, and we probably also create a lower time for value gap or a breaker. So when you see this happening, then you can anticipate the next candle to be a bearish one. So then you play an open, high, low, close to the downside. Price goes open, high, low, close. So when you have your higher time frame highs and lows marked out, look at how they close around those so you can predict the next candle. And very important here that we're not going to blindly trade when we see this candle, we're not going to blindly short. We want to drop to the lower time frame to see these kind of structures happening for the shorts and these kind of structures happening for the upside. So from this point, when we close above a high, I'm going to frame the next candle as a continuation to the upside. We have a run on liquidity and we continue to the upside. And when we have the rejection candle, then we call it a rejection or reversal pattern. because price trades to the high and it's not strong enough to continue higher because it rejects. So that indicates weakness and we want to trade the weakness to the downside. And when you are trading this, you now know how to predict the next candle, but you also need a target. And the best targets are also highs and swing lows. So if you're bullish, just long towards the next swing high. And if you're bearish, just find the next swing low to trade towards to find your low hanging fruit targets. So you look at how candle closed above a high. If it's closed above, you predict the next candle to be a bullish candle. So you play a bullish open, high, low, close. On the higher time frame, this looks like this. On the lower time frame, it looks like with our value gaps or order blocks or breakers. And if rejected from a high, that means we are not strong and we want to go lower. The price gives a clue here that price wants to go lower. On the lower time frame, that same candle looks like this. And we need to have a market structure shift. We're not going in blindly. We want to have some form of sell structure on the lower time frame to find our trade. And it's going to be towards a target. It's going to be or external liquidity or internal liquidity. Just find the nearest liquidity pool. And if you're not sure what liquidity is, I'll leave the link to my liquidity video in the description. And I created free training on how to go from emotional trading and blowing accounts to securing over $100,000 in funded accounts and consistent monthly payouts. No fluff, just straight value. So make sure you check out the link in the description to watch the training as soon as possible. Cool. Now let's see this in action. Here we're looking at Euro US dollar on the weekly time frame. And let's look at what we do right here. So we have a high right there. And here in this candle, this doji candle, we trade into the high, but we reject from it. And yes, it's a doji, but because we trade into the high, but we fail to displace higher, we expect the next candle to be bearish. We trade lower, we trade lower, we trade lower. We see how the candles are closing in comparison to the previous candle. And here we have a small upwards candle. We also see an overlapping weekly bearish for value gap. And right here, we see a sweep of a high and then a rejection lower. So when we see this candle happening, the next candle we can predict to be a very bearish one. Trade lower, we trade lower. Then we have this massive up close candle. We have created another weekly bearish for value gap. And we do not displace higher. Also, we reject from the for value gap. So that indicates we probably want to go lower. And then we do that. And now you might wonder, like, okay, this is nice on the higher time frame, but how can I trade around this? Like maybe with a swing position from 4 hour, 1 hour, or maybe even lower to the infinite time frames. So for that, we need to zoom in. So we know the framework now on the higher time frame, like we've seen right here. So we traded to a high, but we failed to displace above that high. So we expected rejection. And in this example, we also saw some overlapping for value gaps. That also supports that clue that we might not want to go higher, but we want to go lower. We're rejecting. And now let's drop from the weekly to the 4 hour time frame. Here we're looking at that exact same price action, and let's break it down if we could find an entry. Let's start here at the top. So here we have that weekly high, and we tap this here on the Wednesday at 9 a.m. in a kill zone, so that's nice. And then we displace lower, leaving a fair value gap. What I want to see when rejecting from a high, I want to see a market structure shift. And a market structure shift is when the last swing low that created high is violated. So that would be right here. So this price I won't be engaging. I want to wait until we close lower than here, and we do that right there. So we leave a fair value gap. We cannot get tapped into it. As you can see, we just trade lower and lower and lower. So in this whole move on the 4 hour, I would not be in. So yes, you've seen the reversal. Yes, you've seen it happening, but no entries. But it gives a nice indication to what price might want to do. And you see what we do. We reject from the highs. And what are we targeting? We are targeting all these swing lows. Swing low here, here, and there. You see how clean this goes through. So when you see the rejection from the highs and you see price trading down very aggressively, we can look at premium arrays to find even lower price because we can take out all these lows. Eventually, we want to take out these relative equal lows as a part of a bigger market maker sell model. If you're not sure what a market maker model is, I'll leave the link to that also in the description. So we displace here lower, leaving a massive 4 hour fair value gap. So once price comes into this fair value gap, you can already take an entry with your stop above the recent high. And if you're not a swing trader and you can watch the market, you can even zoom in here on this 4 hour fair value gap to maybe look at the 50-minute sell structure. So here we're looking at that same 4 hour bearish value gap, but on the 50-minute time frame. And we have a aggressive sells, aggressive buys here at 4, so in the London kill zone, which is a nice time to make a high. And then we wait for the last swing low that made the high to be violated. That's right there. So once we trade below here, that is where I want to look for sells. And you see this for value that created with the structure shift. And this is where I would like to take my entry. So it would be right there, stop above the high. Low hanging fruit would be a 1 to 2 like this. And it would be a very nice trade. And that's all based on the weekly rejection up there, a 4 hour sell structure. And inside that 4 hour sell structure, we're even going lower to the 15-minute to find an entry. So let's go back to the 4 hour time frame. You knew right here that you want to go lower. Here's where there's not a clear entry. Once we displace here in this piece of price action, you could take a very clean lower time frame entry. And you don't even need the 50-minute time frame. You can just take trades from the 1 and 4 hour and you can make a lot of money. But maybe you're like, but I don't want to wait a few weeks to take a trade because this was in September and this was like over a week after this price action. Do I need to wait a week for a new trade to be taken? I would say no, because we are now doing this on Euro US dollar, but there are a lot of other pairs where you're going to do exactly the same as part of a weekly outlook. So at every start of the week, when you want to start trading, go to the higher time frame, apply this concept, look at what looks nice on the higher time frame, and frame your watch list around that. And I share my own outlook exactly like this in both the school and the Discord. So if you're struggling with this, make sure to just join. I'll leave the link in the description. But now you know how to do it too. Cool. So let's go back to the weekly time frame. So looking at the weekly, we just took a trade in this area right there. But let's continue doing this. So when you see the model, so for example, right here, you see a sweep of liquidity and also overlapping with a weekly bearish fair value gap. In this piece of price action again, drop to the lower time frame because this is your rejection candle. So for this candle, you might have a very nice trade idea on the lower time frame. Let's drop again to the 4-hour time frame. So here's that weekly bearish fair value gap where we rejected off from. Here on this Tuesday, big rejection. In these kind of moves, 99% of the time you are not in. That is fine. You don't make your money right here because this move will give you the direction, the displacement with fair value gaps and other premium arrays, and you need to trade off of that. So when this happens, big range, what I like to do is draw a premium swing high to swing low and discount and try to look for premium arrays. So there's an order block, a breaker. My eyes immediately go to this fair value gap. We have multiple fair value gaps. We have one here on the 4-hour and also one here. Because I want to short and discount, I'm going to make this fair value gap smaller. I'm only going to leave that in premium of the range. And as you can see right here, we tap into premium of the range and then we start rejecting again. So on the 4-hour, you can just have a sell limit at premium of the range. Your stop is above this high. Why above this high? Because this high created high resistance liquidity. We took liquidity before the massive move down and you can target a simple 1 to 2. And would also give you a nice trade. Let's drop again to the lower time frame to see in this piece of price action if we intraday can also find a nice trade. Here we're looking at the same area, but then on the 50-minute time frame. So we start to trade into premium of the range. We also have an overlapping 50-minute fair value gap right here and an order block right here. And look at the time where we trade into it, 10:30. That is the New York kill zone. So wait for aggressive buys, aggressive sells. We see some displacement. Ideally, again, we want to see a structure shift. I see a swing low that made the highs right there. So with this candle already, we have the structure shift. So this is a significant fair value gap. Well, if you mark it out in time, you see how it's respected. So you can already take a trade from here. And you can even take it later in another fair value gap right here, tapped in 2 times. So let's say you miss this initial move and you get in this fair value gap. Your stop is going to be above this high. And this is an intraday trade I wanted to, like this. And you would have had TP as well. So it doesn't matter if you trade from the 4-hour or the 50-minute or from the weekly. Based on the framework you just got, you know now how to trade this. You have a rejection candle on the weekly. You can drop to the lower time frame to find your structure. You can do it on the 4-hour, the 1-hour. If you work a 9 to 5, because you don't have a lot of time to watch the chart. But if you have time to watch the chart, you can go inside those 1 and 4-hour levels. You can drop to the 5 and 50-minute to find a intraday trade idea. So from the weekly fair value gap, we had 2 trade ideas that both followed the exact same bias. And this is for when you cannot watch the chart, when you work a 9 to 5. And if you can trade intraday, you can take this trade. Same trade, 1 to 2, and just find the approach that works best for your own situation. And you thought we were done with this? No, of course not, because this model keeps working. So we trade lower from this place, we expand lower, and maybe you're like, yeah, but why didn't I trade all the way back to down here? Because we're looking for low-hanging fruit targets. We just keep targeting hold lows. So here inside this weekly bearish value gap, you see that we take out some highs into a premium level and reject from there. So this candle, I'm not interested in. I'm interested in the next candle, this one. So we're gonna do exactly the same, drop to the 4-hour to see if we can find an entry. And here you have that weekly bearish fair value gap. And we see that we trade into it right there, here at Friday at 5 a.m. And then we start to trade lower with a fair value gap right there. I see a fair value gap right here. And also I see a fair value gap right here. So if you have a bearish bias, you can take your entry in one of these fair value gaps. I like to wait a little bit. I think this fair value gap is a little too small. So I want to see, do we respect it and then trade lower? So most likely, most of my trades, I will be in this fair value gap. If we trade on the 4-hour, where do I want to trade towards? Well, I see a swing low right here that I want to target, but we also had a higher time frame swing low that we could target right here that we marked out on the weekly. Either way, most of the time, I just want a 1 to 2. So stop loss above the high for 1 to 2, and it will be right here. You can even go even lower right here, but You can also do 1 to 2. Whatever your preferred risk management is, I think with a 1 to 2, you can make a lot of money. That's what I do. So you would have to trade right here. This is when you work a job. If you want to trade intraday, let's do exactly the same, but then on the 50 minutes. So it was the first trade idea. Let's drop now to the 50 minutes. So here we look at the same price action on the 50-minute time frame. Here we tap into that weekly bearish value gap. And this looks pretty clean on the 50 minutes. Aggressive buys, aggressive sells. So we have a market structure shift right there. We have that similar for value gap right here on the 50 minute. We see on the 50 minute, we don't respect this too much because we see some trading above it here during Monday, during New York session. We trade back into that original for value gap right here. So this is going to be the starting point of our trade. I mentioned on the 4-hour time frame that most of my entries are right here, but let's see where we can find our entries using the 15 minutes. So here on this Monday, this is already a separate trade idea. What I see here are failure swings, low resistance liquidity. So this is really what I want to target. When I see this happening, we have Asia low with failure swings. This is going to be a target. Then we have aggressive buys, aggressive sells. I'm going to follow for value gaps and order blocks. What I see here is a 15-minute for value gap. Let me zoom in a bit. So here's the 4-hour for value gap. Here's a 50-minute right here. Overlapping, this is your A+ setup here, guys, because you have up close candles that trend to a high, sweeping liquidity. So there's a high resistance liquidity, leaving a bearish order block. We also have a bearish breaker. So this is already an entry which I would like to take right there. Start for value gap. Target is the failure swings, the Asia low for a 1 to 2. And that's nice because the 1 to 2 even covers a potential tap into right here for a 1 to 2. This is option 1. All based on the weekly and the 4-hour bias. Cool. We trade lower. Look at the time. It's intraday, we're not trading this. This is the market close. We come back in the London session because we're on Euro US dollar. So here we start here at 2. And this is inside that other 4-hour for value gap. Let's zoom out to the 4-hour. What we're now discussing on the 50-minute is this fair value gap. Let's give it a little different color. I'm gonna give it a green color so you know which one I'm referring to right here. So we trade into a 4-hour bearish fair value gap during London session. And then on the 15-minute, we look into this fair value gap. We see in London session, we see displacement lower, leaving this fair value gap. It would also give you an entry here on Tuesday, right here. Same target, because we have not reached our target yet for a 1 to 2. It will also be same trade. So if you miss the trade on Monday, you can take a trade on Tuesday. Well, let's continue, shall we? We have another fair value gap sitting right here, and that was the original trade idea from the 4-hour time frame. Just make this one more yellow so we can recognize it. And let's see what we do when we trade to that 4-hour for value gap. We traded to that 4-hour for value gap here during the Asian session. And then we move lower. And during the New York session here at 9, we tap into it again and then sell off. So on a lower time frame, I would not have been inside this trade, which is pretty interesting. Because on the 4-hour, I would have had my limit right here. I would be in the Asian session. But if I would take this intraday, I would not be in because intraday, it did not give a lower time frame structure, which is completely fine. That's the difference between trading intraday or trading more as a swing trader like this. The cool part is both are good, both make you money as long as you use the model on the higher time frame, where you have a rejection candle, you go to the lower time frame and find your sell structure. And I think by now you get from this weekly move down, we took multiple trades, both on the 4-hour if you're working a job, but if you can trade intraday, also multiple trades. And we can keep doing this until we are in a higher time frame drawn liquidity. And from this point, when we start rejecting lower, just focus on the swing lows and see if we reject somewhere. So right here, we were rejecting, but then we continued to downside. If we now fast forward here, because I'm using the replay button, is from this low, we reject. So this swing low, we see that we create a low, then we go higher. And after this displacement from March 3rd is where you need to pay attention, because now we change structure on the weekly time frame. And then you have, of course, your weekly bullish for value gap. And when you are bullish, you want to trade to old highs. So right here and right here, the original short idea, what we discussed here. I'm not going to bore you with doing this again, but in this time frame, you look at how the candle closes. So this candle trades to a weekly for value gap, rejects. So the next candle, this one is where you go to the lower time frame to find your long ideas. Same here. And you can do exactly the same. Here, we look at the live chart here. We have a weekly bullish for value gap. We tap into it, we displace. So when this happens, you know that we want to go to the upside towards the next high. And that's right here. And this all on the weekly. You can then drop to the 4-hour time frame as a swing trader to find your entries. If you want to be an intraday trader, you can use the 4-hour as your levels and then your 5 and 50 minutes for your entries. So this far we mainly discussed the rejection model, but we also have the continuation model. So what if we traded to a high, but we trade over it? So we show willingness to continue with the current trend. So in this case, it's a bullish trend. Let's look at some examples. Here we look at a live NASDAQ chart on the daily time frame, and let's start below here. So here we trade into a volume imbalance, and then we trade higher. And we're going to mark out the value gaps because they play a big role inside this model. Because if you have this model together with a value gap, that is pretty powerful. So let's see the model in action. Right here, we trade higher, we trade higher. This candle closes over the previous candle, so we see another one higher. This candle right here, we reject. So we take the high, but we fail to displace over it. So in the next candle, we are going to look for a lower time frame sell structure. Well, in hindsight, this doesn't happen. You see, there's another buy structure. So in this day, you or have no trade or you have taken a loss. That's fine. But that same daily value gap is still on. So when price trades into the value gap here and rejects, from this point, this candle, April 30th, is where you're going to look for long scan the next days. Same here. We sweep a low, we reject, and we go higher. We close over it, close over it, close over it, until we don't. So we see some weakness coming in, we trade lower, and then we reject again. And where to reject from? We take some lows, but also an overlapping value gap, and we go higher. We trade above the high, higher, higher. Then we have a massive rejection candle. So this candle, you're going to look for shorts. Well, big doji, so a tricky day. A rejection candle from the order block. Why is it an order block? It's a down close candle. It trades to a value gap, order block, and higher, higher, higher. So based on the one candle model, you could have your whole bias for this move. And if you go to the lower time frame, you could find your 1 hour moves right here. Aggressive sells, aggressive buys. You could take your entry here in this value gap, right there. Or your entry in this value gap, right there. And if we go to the next daily value gap, we tap into it right here. This is a trade that took live with you guys on stream. Aggressive buys, aggressive sells. Very nice value gap sitting right there. If you missed that one, take the next one. So here you could have taken all trade ideas based on the daily structure, 1 hour level. And inside those 1 hour for value gaps, you could even drop to the 5 minute if you want to go intraday. But this video is getting pretty long, so I won't bore you with another lower time frame examples. I think you get the point right now. So you go for your daily structure. Based on the model, you look at how we close above old highs and lows. When you have a bias, you can drop to the 1 hour, to the 4 hour to find your entry in there. And if you are an intraday trader, you can go inside this 1 hour for value gaps right here. You drop to the lower time frame to find your buy models as well, but then on the 5 minutes. And when I say one candle will change your life, I mean it. This simple model will get you the buys, both if you work a 9 to 5 or you can trade intraday. This will give you such a clear buys on all the pairs. So now you know when not to trade a pair and when to trade a pair. And when you have a high probability pair on your hands using this model, you can take your trades and get funded, get payouts, make money. If you want to learn more or want to see me daily, I have a school and a Discord group. I will leave the link to that in the description, and make sure you check out the free training I have to get funded, get payouts within 90 days in the free training below. Thank you for watching. I hope you enjoyed. If you did, consider liking and subscribing. Make sure you check out the other videos on the channel as well, but market structure, liquidity, daily bias, all that stuff. It's all there. I'll leave the link to that in the description, and hope you enjoyed. See you later. Bye-bye.
Ever wondered why you lose so many trades? Good news, this struggle is easy to fix. My name is Dion, full-time trader with over $1 million in funding. And this video, I'm going to break down the most high probability ICT entry model, the unicorn setup. To do this, I will share the 4 puzzle pieces that create this high probability setup. No time to waste, let's get into the video. When you want to determine where to find the ICT unicorn model, you need to look at 4 puzzle pieces. 4 puzzle pieces that will rule them all. And let's go over the first one. And the first one is one of the most powerful concepts in trading, and that is called the breaker. And if you want to understand what a breaker is, you need to understand 3 key concepts. You need to understand what order blocks are, you need to understand what liquidity is, and where you can find it, and how market structure works. If you're not sure about one of these 3 concepts, I have dedicated videos on this YouTube channel, and I will leave the link to that in the description. So when we look at order blocks, we need to know what order blocks are, because breakers are order blocks, but then the different side, the other side of the curve. And how you can determine an order block is the last down close candles that swept the low before a market structure shift, come back to the order block, and then go higher. And with a breaker, what happens is price ignores the order block, and we can use it as a bearish breaker to the other side of the curve. So we are going to use it as resistance, as support. More on that in a second. Then you need to know what liquidity is, because a breaker is a breaker structure. So there needs to be some liquidity being taken before the move. This is a key part of a breaker. And also you need to understand what market structure is. When is there a market structure shift? When the last swing high that made that low, that took liquidity, is taken. When that liquidity point is taken, right here, you have a market structure shift. So order blocks, liquidity, and market structure. And what is then a breaker? A breaker, in this bullish example, is the up close candle, last up close candle before that liquidity sweep. So you can identify it by a swing low, a swing high, then that swing low is broken right here, creating a lower low. And after that, this swing high is broken, creating a higher high. So low, high, lower, higher high. And the up close candles in this bullish example will give the breaker. So if you look at it in candle format, we have your low, you have your high, you have your lower low, and you have your higher high. And then these up close candles are the breaker. And it's up to trader discretion if you want to do the top candle or you want the whole range. Preferably, I'd like to take the whole range. So from this swing low to this swing high and mark out the breaker. You can also only do this candle. Again, up to trader discretion. Same for bearish example. It's the down close candle. Last down close candles before liquid sweep. So swing high, low, higher high, lower low. And again, there needs to be a breaker structure. There needs to be liquidity taken before this move to be a valid breaker. If there's no liquidity being taken, it's not a valid breaker. So here you have a high, you have a low, a higher high, and have a lower low. The down close candles here, again, you can take from candle to candle, take the whole range, or just this candle. I prefer to take the whole range, but again, it's up to trade discretion. And as I look at an example on the charts, we are looking at NASDAQ at the 1 minute chart. And we are now at the New York Open. Look at the time, it's 9:30. And we have this down move with some further swings here that could be nice to target later. And what you see here is a breaker formation. I see a low being formed. I see a high. This should be a bearish order block, but because we're gonna break it, spoiler alert, we're gonna use it as a bullish breaker. So a bearish order block becomes a bullish breaker. Low, high, lower low. And let's see, once we take this high, then we're gonna talk about a breaker formation, and we do. So right here, from the low to the high, I like to just take the up close candles here. So I would mark out the breaker like this. And what do we see here? So we have a low, a high. The low is taken, liquidity sweep, setting a low, and now we also have created a high right there. And then you can just take your entry from the breaker, stop loss below the breaker. I'll just target the clean 1 to 2. Don't make it more complicated. And this 1 to 2 is also overlapping with these further swings up here. And let's see what the price does. So it gives a nice push, and it comes back into the breaker before eventually going to the TP point. This is only using a bearish breaker. And as you know, there are more puzzle pieces to this unicorn model. So let's now talk about puzzle piece number 2. I spent hundreds of hours studying ICT concepts, and I broke down every single concept with my own personal notes in this 500-page PDF. It goes over everything from entry models to the different concepts, from interest rates to everything you need. So if you want to save those hundreds of hours, want to get it right now, I will leave the link to this PDF in the description. So now you know how a breaker works. The second puzzle piece is one of the most important things you need to add to the unicorn model, because a breaker is only one side of the equation. The other side is the fair value gap. And the fair value gap is one of the most easy concepts in ICT concepts. It's a 3-candle pattern where there is a gap between the high of the first candle and the low of the third candle. And the goal of the unicorn setup is to combine these two. So you know how a breaker works, you know how fair value gap works. When they overlap, there is where you get the unicorn model. So in this example, you have the low, you have the high, you have the lower low, and you have the higher high. When price comes back into the range with an overlapping fair value gap and a breaker, there is where we have the unicorn setup. So not only look for breakers, also look for fair value gap. So if you have a fair value gap or fair value gaps multiple overlapping with a breaker, that is where you need to pay attention. And there is where your highest probability entries will occur. And now let's see this one in action. So you now already know how a breaker works. So we have a high, a low, a higher high, and a lower low. And now we have the breaker marked out. We also now have a fair value gap. So now you have an overlapping part between a fair value gap and a breaker, and now we have the unicorn. So we can just take an entry at the start of the breaker and fair value gap, the unicorn, stop above the high or stop above the breaker. I prefer this one. I prefer above the breaker, but if you want to be safe, go here for 1 to 2, and then let's see what price gives us. And as you see, price does not tap us in and goes to the TP point. And it's to show you like nothing 100%. With every model, you will still be left behind sometime. Now, if you look at this example on USD JPY on a 50-minute time frame, what do we see? We have a low, a high, a lower low, and a higher high. We also have a overlapping fair value gap. So what is this? This is a unicorn setup. Let's mark out the breaker. From this point, I will take my entry. I will do my entry at the start of the breaker, stop loss below the low before I static 1 to 2. And let's see what the market gives us. So it taps in, and you see how the wicks are inside the unicorn, but the bodies are closing above it, making it very bullish. And then price
comes to the TP area. So all based on a simple unicorn format. So now you know the basis of the unicorn model. It's the breaker overlapping with the fair value gap. But there are two more puzzle pieces where you can make this unicorn model even more high probability. And its third element is one of the most important thing in ICT concept, and it is time, and specifically the kill zones. And there's a difference between Forex and indices kill zone. So if you trade Forex, watch the top of this chart. And if you are trading indices, please watch the bottom. So we have Asian session, Forex from 8 till midnight, London from 2 to 5, New York AM from 7 to 10, and London close from 10 to 12. If you trade Forex, try to frame your entries inside the kill zones. If you do indices, Asia is the same, London is the same, but the New York AM session is a little different from 8:30 to 11. And then you have a PM session for the indices, for the US indices. And there's also a silver bullet window. There's where your most high probability trades will occur. That's between 3 and 4 for London, and between 10 and 11 for New York AM, and 2, 3 p.m. for New York PM session. And bonus points here, and when you have currencies and pairs that are from the region of the kill zone. So for example, the Asian pairs are AUD, JPY, NZD. Why? Because their region is in the Asian time zone. They're living in Asia. Just like countries from Europe, let's say Euro, GBP, CHF are all European pairs. They move in London, just like the USD and the CAD move in New York session because they're from the region. So if you, for example, have Euro and USD, you know they're probably moving in London and New York, not in Asia, because the regions are not there. So try to think about the region and match them to the specific kill zone. And the fourth and final element of the high probability unicorn setup, we now have a breaker overlapping with a fair value gap that makes a unicorn. If you combine a unicorn with the kill zone, with execution in the kill zone, it's even more high probability. And the fourth and final puzzle piece of the unicorn model is a draw on liquidity. Your unicorn model needs to match with where the price likely wants to go. And a draw on liquidity, there's a dedicated video on this, on liquidity, on this YouTube channel. But to give you a little heads up, price only goes to two things. It is internal range liquidity, that's basically imbalances, fair value gaps, volume imbalances. And we can use that as a place to trade from. So if we have a fair value gap, we can use it to trade higher. And price can also trade to external range liquidity, old highs and lows. So it goes from internal to external, from an imbalance to an old high or low, or going from a high back to an imbalance. There's only two things. At intraday, use a 1 hour array, let's say a 1 hour fair value gap, combine it with a 1 and 5 minute entry. Use 4 hour arrays, 4 hour fair value gaps to a 50-minute entry, and daily and weekly arrays for a 1 hour entry. And bonus points here. If you want to find your highest probability draw on liquidity, follow the displacement, follow the order flow. So that means when price is bullish on the higher time frame, frame longs, frame your bullish unicorn setups. And in a trending move, the opposing arrays should fail. And what I mean by that is if we go higher, we have on the sell side of the curve, we have bearish fair value gaps. We have bearish order blocks, bearish breakers. When we are trending to the upside, these should all fail. And that is where it's confirmed that you're gonna from bearish to bullish or vice versa. So the opposing arrays should fail. And if we go back to our previous example on USD/JPY, when we have a clean unicorn, look at where the unicorn is formed, where the low is taken at 3. This is during the London session. So the London silver bullet from 3 to 4 is where your trade idea is probably going to be set up. And the execution is here at 4:45. And let's see if there's a clear draw on liquidity. Well, if you look at the daily time frame, this structure is formed inside a daily bullish fair value gap and also in a daily bullish order block. So the higher time frame, this was already a very nice move from internal potentially to external. So if you know that, then we can safely sell on the lower time frame, and now we're doing this on the 50-minute inside this area. So now the green line is that order block and the fair value gap. In that area, there is where the structure in this unicorn is formed, making it more high probability. And when can we trade towards? We can take out all these failure swings, and that's what we also eventually do. And you see when this unicorn setup is traded, how it gives a very clean move to take out all these failure swings. And now you have it. 4 puzzle pieces to get a high probability ICT unicorn model. You now know what a breaker is. You now know what a fair value gap is. And the overlapping part is the unicorn model. If you combine that with time, with the kill zones, and you're finding your higher time frame drawn liquidity, you have a very high probability entry model on your hands, which you can use to get funded, get payouts, and get profitable. Next to the unicorn setup, you might wonder how order blocks work, or fair value gaps, or liquidity, or market structure. Good news, I got videos on all of them here on this channel. So I will leave the link to that video somewhere here, up, down, so you continue your journey learning all the ICT concepts and start making money. Thanks for watching, and I'll see you in the next one. $1 million entry models. In this video, I'm gonna break down the exact step-by-step framework that got me to over $1 million in funding and over 100K in payouts. And using this exact step-by-step framework will get you to $1 million plus in funding as well. And you can do this being a complete beginner. It's all there for the taking, so no time to waste. Let's get into the video. The framework I'm about to share with you has 4 simple steps. And the first step is finding your favorite confluences. And confluences is just a fancy term for your favorite ICT concepts. It can be for value gap, order block breaker, market structure shift, all that stuff. And what nobody tells you is you don't need 20 different PD arrays on your chart. You don't need the Reapers, the NBLOCs, the NDOCs, all that stuff on your chart to make money. Just pick a handful, master them, and combine them into one single entry model. And I built a specific playlist on my YouTube channel where I explain all the different confluences like market structure, market maker models, time and price, daily bias, order blocks for value gaps, kill zones. If you go to my YouTube channel under playlists, then if you go under build your model, there is where you can find all those videos. And I'll leave the link to that playlist also in the description. And the ones you've seen in the playlist are the ones that I use to make money. And there are a ton more PD arrays or ICT concepts you can use to make money, but these are the ones that works for me. They're very simple and I want to simplify everything for you. So when you find your favorite confluences, there's where it's time to go to step 2. And it is get an entry model with your confluences. You can build that model yourself, or you can use one of my favorite entry models. In the past couple of weeks, I created a dedicated video to all of them. You have the school model, you have 2 A+ setups, you have a turtle soup model, open, high, low, close model, and there's more entry models. And there's also a specific YouTube playlist for this. If you go back to the YouTube channel, you have your build your model where you can find the confluence from step 1, and here you can find my favorite entry models. So you can build one yourself using the confluences, or you can just use my entry models and then backtest it yourself. So step 1 and 2 is nothing special, right? You find your favorite confluences, you watch the videos, you take notes, you go to the chart and see if you can identify them, and then you build an entry model around those confluences. And I created a free training on how to go from emotional trading and blow accounts to securing over $100,000 in funded accounts and consistent monthly payouts. No fluff, just straight value. So make sure you check out the link in the description to watch this training as soon as possible. Cool. And there's a third step in this framework, and there's where 95% of traders miss it completely. They are or too lazy or they just don't want to make money. But it's the part of trading that takes the most time. It's the most tedious, and to be honest, it's just not a very fun part of trading. Everybody wants just to push buttons and then make money. But the third step is all about executing and building data. And by building data, I mean making mistakes. Go to the chart, execute, and mess up. Fail as many times as you can. Fail forward and journal all your mistakes. And there is one specific insight I want to share, and I shared it in my Discord, and it's the following. I got many DMs with a screenshot of a trade and the message, I don't understand what I'm doing wrong here. A simple message that showed a lot about what level a trader is. Because a trade is taken based on an entry model, I hope. And entry models you can find on YouTube channel here. An entry model is nothing more than X, Y, Z is happening on the chart. And based on that, you decide to press the button. And you have an edge with your entry model, and that's your win rate. That's where you need to build data for, because you need to have a certain win rate to know, okay, I can make money now. That means if you take your entry model, have a 50% win rate, you lose 5 out of 10 trades and 50 out of 100 trades. Beginners and losing traders. So if you're one of those, it's okay. Now we're gonna fix this. Beginners and losing traders think that when their entry model appears, they are going to make money. But the I don't understand what I'm doing wrong here shows a lack of understanding of probability and risk. With your entry model, for example, has a 50% win rate, you must shoot 100% of the times when you see your entry model appearing, when all the stars are aligning with your model. But even then, only 50% of the times you're gonna make money. So the I don't understand what I'm doing wrong here, maybe rephrase this. Maybe you are doing nothing wrong here. That's just your edge. You just hit one of those 5 out of 10 times you need to lose in order for you to make money. Very important framework in step 3 about building data. So you have your entry model, and let's say that's a school model. Cool. That means you need to build data on this, because you need to look, does this model work for me? If I go to the charts, you can go backtest. You can backtest on TradingView or FXView Play. There are many tools you can backtest on, does this work for me? And at the same time, go look at live price action day after day, show up every single day, every single trading day, and try to execute your model and mess up, make mistakes. And over time, in a few weeks' time, you have so many data points and you can conclude, okay, maybe this engine model has a 40% win rate or a 50% win rate for me. That's fine. If you should have wanted to, you make money. That's cool. And if you need some help with journaling or data building or your trade plan or daily bias or whatever, I have a school group where I have free courses on everything. So don't buy an expensive course, go to my school group, go to the classroom, and in that classroom, you can find everything you need to start making money yourself right now, today. I will leave the link to my school group in the description. But executing and building data is one of the most important things in your trading. Because if you lack confidence, you lack your psychology, you're very scared on a chart or lots of anxiety, that means you have no confidence. Because confidence is built on proof. But how can you be confident if you don't have any proof that something's working for you? So you need evidence, you need proof that something's working for you. And how can you build proof? By doing this, by building data. Backtest and journal. So backtest is, journaling is basically forward testing. So you're gonna actually look at live price action and try to find your setups and build data points over time. And over time, you know that, okay, if I'm going to the charts in the long run, I'm gonna lose 6 out of 10 times or 5 out of 10 times, and I'm still gonna make money. So when you are in a trade and it goes to your stop loss directly, you are okay. You are not mentally drained. You are not too anxious. You just accept it like, hey, cool, can happen. It sucks. Yes, you lose money, but in the long run, you're gonna make money. And now you know the first 3 steps of this framework. Building data on your entry model is the most important thing in the world. I want to introduce you to step 4, and it's the most powerful concept I use to skyrocket my win rate. And it's not some fancy PD array. It's not some fancy entry model concept. No, it is being a judge. I have a background in law. I've been to law school, and I want to share the framework that I use from being out of law school into trading. And it's built a case like a judge in court. So with every trade, you are the judge or you're a lawyer, and you need to make a case with bullish and bearish arguments. So you go to the chart, you see your entry model, and okay, for example, I'm bullish. Cool. You're gonna build your case around being bullish. One important thing here is that the higher time frame is more important than lower time frame when building your case. If you have a 1-minute buy structure, that is less important than a daily buy structure. Make sense? Cool. So for example, you are bullish. Example, you have a daily bullish fair value gap, you have a 1-hour market maker buy model, and you have a 5-minute structure. That is a pretty nice bullish argument, a bullish case for price going higher. So you might want to long. But it's very important to also build a bearish case and see how strong that bearish case is. Because maybe the bearish case is even more significant and you might have a short on your hands. And if you are longing against a very bearish case, that's not a nice idea because you want price to go up very cleanly if you're long. But let's say the bearish arguments are very small. You have a small 1-hour SIBIs on the sell side of the curve. Then you don't have a lot of bearish arguments against your position. And if the bullish case outweighs that bearish case by a ton, then you have a high probability setup in your hands because you didn't expect price to go down very aggressively. So that's cool because price needs to go up. And an example here is on a GPUSD